Good morning and welcome to all you watching online and on Files One News. I'm Brian Sazi.
And I'm Alexis Christoforous of Yahoo Finance. And this is the first trade for Tuesday, November 5th.
UPS and CVS team up to deliver your prescriptions by drone. We'll look into what this means for the future of drone delivery in healthcare.
Close to a deal. The U.S. and China could roll back some tariffs to close the partial trade deal that's on the table. We'll look at what both sides are giving and getting.
Peloton delivers its first earnings report as a public company. We speak to its president about how they will continue to pedal into the future.
Here's a check of those futures ahead of the opening bell on this Tuesday morning. Not too bad. Dow futures up 85. We have gains for the S&P 500 and NASDAQ futures as well.
We'll get a full look at the markets in just a bit. But first, today's big story.
A new partnership between UPS and CVS is taking off like never before. UPS drones just successfully delivered medication from a CVS pharmacy directly to 2 customers' homes. Now, the flights, which are FAA approved, by the way, are early tests of what could become a new way of shipping everything from prescriptions to shampoo. Our editor-in-chief, Andy Serwer, here with more. I have to say, I have to get used to seeing that.
Weird.
First of all, good morning.
Good morning.
But when I think about the tremendous potential here for us as consumers and the healthcare industry, it's huge.
Well, you have to ask yourself, I mean, is this out of the Jetsons?
Right.
Or is this something that's really going to come to pass soon? And I think that's still to be determined because, sure, companies can do things like this, but is it really commercially viable? I mean, there's so many questions. In other words, sure, there's one drone going up from one UPS facility, a CVS to there, and then delivering. But what happens when you start to get dozens or hundreds or thousands? How is the FAA going to even begin to cope with this? And you've got all these different kinds of companies that want to get in this business.
What happened to Amazon? They came out with a couple years ago with that big, pretty drone. I continue to see a lot of photos out there, but not much on that front since.
Yeah, I mean, they're doing a lot of testing. And, you know, one of the issues, Brian, is actually the states adjudicating versus the national government. And there's so many issues like that. And then what happens in bad weather? And then what happens in terms of property rights and air rights for individual landowners? I mean, at what point can a drone fly, over your neighbor's house to land something, deliver something to your house? I mean, there's so many things to be sorted out. I will say, China is kind of, not surprisingly, perhaps taken the lead here. If you go there and you can see movies of companies like Alibaba and Tencent that are actually doing giant drone deliveries to rural towns in China where they're delivering packages for the whole community. It's pretty amazing.
Wow, I would love to know how something like that works in a densely populated area like us here in New York City. I mean, I live in an apartment building. How does that work out? Maybe it would be that idea where like a whole bunch of packages meant for my block or my building would come.
Right. I mean, I think, this is like a lot of other technological advances that it's not going to completely displace, say, delivery by trucks and delivery people in urban areas, but it's going to be complementary and it is going to change the game. And I think the real issue is going to be making it work first in rural areas and then in suburban areas. As far as cities go, I mean, forget about it. I just don't see it happening.
I'm okay with that, by the way.
Right.
Andy, I was thinking when I saw this video, it finally makes sense to have a store open. If you're a retailer, this is one way to maximize your stores, and this is pretty cool.
Right, exactly. I mean, it becomes stores going forward, Brian, we talked about this, maybe being a showroom to walk in to see the products and then actually being a distribution point of it, which I think is what you're talking about, which is to move things, again, in different places around and by drones. Would it get there by drones? Too. I mean, so many things. And, you have to think the FAA may be ratcheting down certain parts of what they oversee, but this is obviously a growth area, not just for private sector, but for the government as well.
I guess we all should be looking up at the sky
Yeah,
very
look out.
shortly.
Right.
Andy Serwer, good to see you.
Thanks.
Let's check in with Yahoo Finance's Inez Ferre down at the New York Stock Exchange. Inez?
Yeah, Brian, and futures are pointing higher this morning. And I was just talking to some traders about this report that U.S. officials may be considering removing some tariffs on Chinese goods as early as this month in order to get that phase 1 trade deal signed with China. And this would include perhaps tariffs on Chinese goods of clothing, appliances, and flat screen monitors. And of course, the U.S. would expect things in return return as well, like the purchase of more U.S. farm products. And just talking to traders here, they were telling me that really any rollback of tariffs, the markets would certainly cheer something unlike that. Meanwhile, we're also watching a couple of tickers this morning based off of their quarterly earnings. Their Peloton came out with its quarterly results, and investors seem to be liking what Peloton came out with in their first quarterly results since the company has been public. Their revenue came in above estimates. Their net loss came in at $49.8 million. That's an improvement of almost $5 million from the same period last year.
All right, Inez, thanks so much for that. We'll see you shortly after the opening bell. It was a mixed quarter for ride-hailing giant Uber. Revenue growth improved, but the company still lost more than $1 billion last quarter. The stock sinking here in the pre-market, down about 7%. Here to break it all down is Yigal Arounian from Wedbush Securities. And Yigal, of course, CEO Khosrow Shahi now talking about path to profitability in 2021, trying to ensure investors here. Do you buy that?
Maybe. It looks like we're getting there. You know, Lyft's talked about it. This was actually a little bit of a surprise. The street was kind of expecting a $1.5 billion EBITDA loss in 2021. So this is a big.
The fact that they're saying they'll be profitable that year is a big turnaround for you.
It's a big turnaround. It's a big difference. Lyft had talked about becoming profitable exiting the year, so in 4Q of 2021, and Uber seems to be on a track that is faster than that. That does surprise us a little bit. They're in international markets, more competitive markets, food delivery. If they can get there, I think that's a really positive sign. But obviously, investors have a lot of questions around that.
Do you think Dara is doing enough hand-holding on Wall Street?
A little bit. I think Dara and Uber kind of have their own mantra and the way they run things and kind of want to move the company forward, and they're more focused on that than holding investors' hands.
There seems to be a lot of differences between the Uber management team and Lyft's management team.
Definitely.
Yeah.
You know, I think Lyft's doing a little bit of a better job and maybe more focused on that, and you know, the hand-holding aspect of it. You know, Uber's got its own style. You definitely feel the personalities coming through in different ways.
Yeah.
For the first time ever, Uber broke out numbers for Uber Freight, and it looks like they're really scaling both in the U.S. and Canada. Is that encouraging to you? And is that maybe one part of the business that will help them get to profitability by 2021?
It should be. Right now, it's a really small part of the business. It's certainly encouraging to see it scale and grow that quickly. It does face competitive pressures as well. You know, Amazon's a big player there as well. There's a lot of established.
We're talking about UPS a minute ago.
Right,
UPS
exactly.
as
There's
well.
a lot of established players. So, you know, it's nice to see them get there. Could offset some of the pressures we're seeing in Uber Eats, and that's a much bigger business for them that's seeing a lot more pressure. It helps, definitely helps.
How worried are you about the outlook, let's say the 6-month outlook for a business like Uber Eats? Grubhub seems to be ready to clobber Uber Eats with discounts.
The outlook's not great in the 6-month period. You know, we've talked about rationalization coming through, especially in rideshare. Talked about thinking about how that comes through in food delivery. We're not getting there. Grubhub is going to be discounting more. DoorDash is in the market, very promotional. I think Uber fights back, and I think you see more promotions over the next 6 months, and that's going to put more pressure on shares and those businesses.
Well, I wouldn't mind a discount on my delivery, just saying.
What about two important metrics here for Uber: gross bookings and trip totals? What was your takeaway there?
Well, gross bookings were fine. They came in ahead of expectations slightly. I think one of the areas that's concerning investors a little bit is the actual users that came in below expectations. So the amount of people that are taking rides or getting food delivered, and then at the total amount of trips, which came in below expectations too. So those are key areas. Those are, you know, the main drivers of growth over a long period, and you want to see those beat expectations and continue strong growth. And if they're coming in a little bit below expectations, I think that's one of the key reasons you're seeing shares down today.
And lastly, real quickly, the lockup expiry, potential big selling wave?
Yes.
Tomorrow, right? That happens?
It happens tomorrow. Yes, it should be a big technical headwind for shares.
Well, we will all be watching. Yigal Arounian, always good to see you. Appreciate it.
Thanks for having me.
Well, let's take a look at European markets now. A lot of green on the screen over there as well. The FTSE 100 up about 0.4%. The CAC 40 and DAX also in the green. Yahoo Finance's Tom Belger joins us now from London. Tom, a new survey shows stagnation in the UK services sector. Walk us through it.
Not much of a Brexit deal bounce. That was how one analyst described the latest PMI figures for services, showing no growth. And the apparently lukewarm reaction that Boris Johnson's Brexit deal, struck last month, seems to be getting from UK firms. You'd expect firms to be a bit more upbeat. This breakthrough was pretty unexpected to get a deal, and fears of no deal seem to be avoided for now that businesses feared. The services PMI came in at 50. That's better than expected at 49.5, but it still shows the biggest bit of the UK economy is struggling. And the Brexit chaos still seems to be deterring consumers and firms from spending. There were recession fears earlier this year, but now that does seem to look unlikely, though, with public spending and perhaps ironically Brexit stockpiling propping up the ailing private sector.
And I understand the UK retailer Primark is now blaming the volatile pound for squeezing its margins. What's going on there?
That's right. A lot of companies are having to grapple with a pretty serious impact of volatility over the past year. The pound was at 2.5-year lows over the summer. It's since recovered, but it's still well below where it was at the time of the EU referendum. It's been hovering below 130. It was at 150 in 2016. For Associated British Foods, which owns Primark, their earnings are better than expected, but they're warning lower margins could result from the weakness of the pound this first half of this financial year.
Okay, thanks so much for that. And coming up, NASA makes a new discovery on Mars. Your news bites are straight ahead. And taking another quick look at the futures, stocks rallying here into the open. We'll be right back.
Welcome back to the first trade. Taking another look at the futures here ahead of the opening bell. Lots of green on the screen yet again. Dow futures now up 100 points. The S&P 500 and NASDAQ also in the green.
Let's take a look now at today's news bites. U.S. and Chinese officials are considering rolling back certain tariffs as part of negotiations for the first phase of a trade deal. According to reports, China is asking the U.S. to drop tariffs on $360 billion worth of imports before Chinese President Xi agrees to travel to the U.S. to sign an agreement with President Trump. In return, China would drop tariffs on an equal amount of U.S. products, mostly farm goods. Lev Parnas, the Ukrainian-American businessman with ties to President Trump's personal lawyer, Rudy Giuliani, now says he's going to comply with requests for records and testimony in the impeachment inquiry of whether the president used his office for personal political gain. That's according to a Reuters exclusive. Parnas previously refused requests for documents and testimony. More than 450 Oklahoma inmates were released from prison yesterday in the largest single-day commutation in U.S. history. You are watching the former inmates tearfully reunite with their loved ones after being freed. These commutations are the result of a 2019 law that makes it easier to review inmates' sentences and figure out if their crimes are still considered a felony today. The Mars Curiosity rover took an image of a crater that NASA scientists believe could have had flowing water. The rover will now explore the image for signs of past or present life. Curiosity was sent to Mars after NASA lost contact with the Opportunity rover. And still to come on The First Trade, racing towards a big finish. We're going to break down Peloton's earnings for you with the company's president and get insights about the exercise equipment company's future. Plus, we sit down with the CEO of Trivago and get the latest on the health of the travel industry. Stay with us.
The vacation home rental market is booming right now as private equity and venture capital continues to pour into the sector. Vacasa recently announced a $300 million strategic investment round led by Silver Lake, its largest ever capital raise. Joining us now to discuss is Vacasa CEO Eric Brion. Eric, good to see you. Interesting business model for you guys. How are you making money?
Yeah, what we do for homeowners is we take care of the entire property. So when you imagine somebody, they have a second home, they don't necessarily need to be in the business of renting it out room by room or listing it for guests on VRBO or Airbnb. We take care of the whole property, rent it out, find the guests, do the housekeeping, basically everything related to that to make their life easy and to make better stays for our guests.
So you actually say that companies like Airbnb, VRBO, HomeAway, that a lot of folks might say are direct competitors to you, you call them partners on your website. Yeah. Why is that?
Very much partners. So about a third of our bookings come directly through Vacasa.com, but the other 2/3 come from sites like VRBO and Airbnb.
Eric, in the press release regarding your latest capital raise, biggest ever, you noted that you're looking at the next stage of growth. That's why you're taking this capital. What does that next stage of growth look like?
Yeah, it's really filling in the map domestically. So everywhere we do business, we have local operations, people who take care of the homes that we manage, photographers, housekeepers, maintenance, and the like. And so for us to build out that coverage across the country takes a lot of expansion. That's really what we're looking at focusing on now. Continuing to bring Vacasa to those markets where we aren't yet found, as well as continuing to expand globally.
So Vacasa is a freshly minted unicorn. You now have a valuation of over $1 billion. You and I have talked a couple of times over the years. You are growing at expanding at a really fast pace. I mean, the number of properties you have has more than doubled in just the past year to over 23,000. You're in 16 countries. Are you going to continue to expand at such a fast clip? And what's that going to mean for costs?
Very much so. So first on the opportunity to expand. The market for vacation rentals is massive. In the U.S. alone, there's over 6 million homes. About 600,000 of those are found on sites like Vrbo or Airbnb. But then so many of the homes we manage are homes that people don't currently have listed for rent. So almost unlimited opportunity ahead of us to grow into this market. And in terms of costs, our operating model is very strong and proven in all of the existing markets. So definitely expansion costs as we get into new markets, but very strong core operations.
Is Vacasa profitable on a net basis?
We're profitable on a market level basis, but not overall.
What about, we got to ask, and I'm sure you're asked it all the time, but do you see a path to an IPO anytime in the near future?
Yeah, very much so. We did just bring in a great new CFO, Jim Gruby, who was at Gruby most recently. So very much looking forward to that process.
What about a timeline? Are you looking at 2020, perhaps?
Probably not that soon. Probably about 18 to 24 months.
And what about growth going forward? Are you seeing an opportunity with more people wanting to buy homes strictly for the reason of wanting to then turn around and rent those homes?
Exactly. We're seeing massive growth on that front. We have a great tool on our website that helps people understand what a home will rent for. And we also have we've recently entered the real estate business as well. There's a ton of, historically, if you think about second homes, you didn't know how much you were going to make from buying one. If you bought a commercial property, the cap rate would be published right in the listing. But on second homes, you don't know what it's going to rent for. We now provide that information to consumers. We help them buy the perfect home. We help them furnish it. So we really make investing in vacation real estate turnkey. That's something we're really excited about and seeing a ton of demand for.
All right, Eric Brion, we're going to look forward to that IPO announcement sometime next year. As CEO of Vacasa, thanks for joining us.
Sounds good. Have a great day.
You too. All right, travel booking site Trivago released its earnings this morning. The company missed on revenue and also announced that longtime CEO and co-founder Rolf Schrömgens is stepping down. Actually, Rolf joins us now via Skype from Dusseldorf, Germany, and it's good to see you again, Rolf. First off, this is a company you co-founded. You've been at the helm for 15 years. Why are you stepping down?
I think it's a very good timing right now. Yeah? So I think that that I was able to build over the last 4 years a great team, yeah? And we transitioned in the last 4 years from our founders team, our 3 founders now, into a 5 hats leadership team. I have a great successor that I trust fully. I think that our culture developed nicely. I think that the motivation of people is great. So I think that it's always like the goal of the founder to make himself independent. And I think that I did that over the last 4 years. I think now is the time to hand over to my successor.
Rolf, 19% sales growth in the most recent quarter out of the Americas division definitely stood out to me. What drove that?
So I think this was the first time now again that after we refocused our business on profitability, which I think that we managed nicely. It was now the 5th consecutive quarter that we have been profitable. So after bringing our business back to profitability, we have now shown that we can grow, and that was one market where we tried it out. So Americas was one segment where we tried it out. We tried out what happens when we reinvest into growth, and we were able to grow profitably at a very nice pace of 19% year over year. So I think that is something that we're looking at right now, how we can duplicate that in the other parts of the world, in developed Europe, in the rest of the world markets for us. So I think that is a great opportunity for next year, but it shows us that we can grow at a rapid pace.
Talk to us a little bit about the health of the consumer when it comes to travel, their appetite for travel right now, and where did you see some weakness last quarter?
So I think we have seen some weakness in developed Europe. We don't know if that was how much of that was homegrown and how much of that was actually the market. But what you can see actually in Europe is that a couple of players, have shown weaknesses. We have seen some companies going out of business, some OTA companies going out of business within Europe. And I think in general, of course, there is a little bit of insecurity in the market where it's going. I think Brexit might play a role. To what degree, it's really, really hard to say.
Rolf, on the earnings release, I think very important, you gave an update on 2 legal proceedings. One with regard to alleged breaches of Australian consumer law relating to advertisements in Australia, and another related to a former issue regarding legal settlements. What's the latest on that, and how much have you set aside for potential damages?
Yeah. So I think that legislation is there very clear, what you have to set aside, and I think we set aside a very reasonable amount for that. But there is really not a big progress on these issues now for quite a while. So we don't see that there is a development there which is worth commenting right now.
All right.
Okay, and I just want to mention that your current CFO, Axel Heffer, who has also been on the show, is actually going to take over as CEO. When will that be happening?
We said that we want to have the transition happening end of this year. So this was a process now going on for 4 years, and so we don't want to rush. But I think it's always good to start, with a fresh team in the new year. So that's why we said, okay, I will run operations till end of the year. Axel will take over 31st of December, and then run the company. And I will transition over into the board, and happy to help, happy to support, happy to challenge the team, but just in a new role.
All right, Rolf Schrumgren of Trivago, thanks for being with us today.
Thanks a lot.
And we have the opening bell coming up here next on the first trade, taking another look at those futures off their highs of the morning, but still holding on to some gains. Here's a look at the action in overseas markets, and we'll be right back. Welcome back to the first trade on this Tuesday morning. We're about 2 minutes away from the opening bell, and we have stock futures higher across the board. Let's go around the bell with Chris Constantinos. He is the Chief Investment Strategist at Riverfront Investment Group, also joined by Yahoo Finance's Jared Blickery, standing by at the Wi-Fi Interactive Board. Good morning to you both. Chris, I'm going to start with you. We see this market at all-time highs. Do we still have further to go as we head into 2020?
Well, I think for day traders and for very short-term folks, the market looks a little frothy here. But I think on the intermediate term, say 6 months plus, history is pretty clear on this, that new highs in the U.S. market typically beget better than average returns 6 months out. That's the historical track record, and it's been pretty reliable. So I think you have to respect the message of markets here that something good is happening.
Chris, where do you see froth?
Just in very short term, some of the investor sentiment data that we track, it just over the last couple of days moved into extreme optimism. So that may temper, that may keep us in a little bit of a cage here. But again, I think that the fact that you made a definitive new high in the S&P, the fact that some of the value-oriented and higher beta-oriented parts of the S&P are also participating. And importantly, I think the fact that developed international is now starting to participate, moving up through meaningful multi-year resistance. All of those things, I think, that's an overall positive backdrop for the market.
All right, Jared, you have a look at the world. How's it shaping up?
Yes, we do. A lot of green here. We're seeing the Hong Kong, the Hang Seng is up 0.5%, as is Shanghai, as is the Kospi. Tokyo coming back from vacation. The Nikkei is up 1.75%. Paris up just slightly, as is the DAX, and then the FTSE is up about 1/3%. In the U.S., we have stocks up again. The Dow is up about 1/3%. S&P 500 futures up about 0.2% here. And yes, we did have record highs yesterday in the S&P 500 and the Dow finally coming along. I think notably, as we wait for the bell here, I just mentioned that we have a lot of participation. We had 217 new 52-week highs in New York Stock Exchange listed stocks at the highest amount in 3 months. So short-term sentiment might be a little bit overdone here to the upside, but yes, I agree that we have more gas in the tank for the intermediate term.
Look at those cast of characters at the New York Stock Exchange. Those are mascots, or for the NCAA.
Where's Mr. Med? That's a Metzer college team.
I don't know. I think they're pretty cool. I want to see this every day down at the Stock Exchange. We have the opening bell at both exchanges, and we have stocks starting the day on the upside. The Dow Industrial is up 54 points.
Chris, what type of opportunities are you looking for in this market? I've seen a rotation out of large caps, out of the consumer staples. What do you like? Is it time to now ratchet up the risk on a short-term basis?
Well, we are starting to see a little bit of rotation, as I mentioned, into some of the more cyclical areas. But I would urge investors to take a look at 3 characteristics in the U.S. So stocks that have this combination of 3 characteristics. The first one is the ability to grow top line in a low GDP growth environment. As good as the stock market looks, we still have to recognize that right now this country is trending at a sub 2% GDP growth. And CEO confidence is still somewhat subdued because of trade uncertainties and other things. So the ability to grow top line is really important. The ability to grow cash flow back to the investor in the form of dividends, I think, is really important. And companies that have an efficient and prudent capital structure. And so when you put all that together, we're looking at sectors like software and services. We're looking at certain logistics companies and industries. We're looking at medical devices. These are not areas that are traditionally thought of as defensive. There is certainly some cyclicality to some of those areas, particularly logistics, and also some consumer-oriented plays. So it's kind of a mix of cyclical and defensive, but really the companies with those 3 specific characteristics.
You know, Chris, the S&P is now trading at about 17 times 2020 earnings. Are you comfortable with where that sits? Are you comfortable with these valuations?
Well, when you look at valuations in the U.S. market relative to interest rates, the market historically can certainly support a 17 or even an 18 or 19 multiple on this level of earnings, as long as earnings can continue to grow. Now, earnings growth this year has been pretty hard to come by. We're looking for about $175 in 2020. If you hang an 18 multiple, let's say, on $175, that gets you to around 3,200. That's not huge upside from where we sit today, but on any sort of meaningful pullback, maybe off of that frothy sentiment that we're talking about, I think it would be a pretty good opportunity to go back in. Actually, you know, for more risk-tolerant investors, this may also be a time to start dipping your toe back into developed international. This is a space that's been massively disappointing relative to the U.S. over the last 5 to 10 years. Arguably, there's probably more long-term upside outside the U.S. than within the U.S., but there's still some political headwinds, particularly in Europe.
Can you offer up any specifics for investors? Which markets are you talking about specifically, Chris?
Sure. So one of the highly contrarian markets that Riverfront favors, and in fact we are overweight across our asset allocation portfolios in, is Japan. Japan is, believe me, most investors don't even think of Japan anymore. It's become so irrelevant over the past 30 years of not being able to make a new high. I think the last new high in the Nikkei was about 30 years ago. So people have forgotten about it, and it's now trading at arguably the cheapest valuations it's ever traded in relative to the rest of the world. It's also one of the most politically stable areas we study. The bear case is very well known on Japan, but I think the bull case is less well appreciated, which is they are starting to reform from a corporate governance perspective. They are starting to get more females in the workforce to increase the labor participation rate there. And at the margin, these companies are becoming more efficient, higher return on equity. Again, the market has not recognized that yet with higher valuations, but we think that's coming in the future for Japan.
Jared, back to you.
We have the Dow heat map here, kind of a mixed picture in tech. We have Apple down about 1/3%, Microsoft up slightly, as is Visa. Financials doing well. I would mention that the 10-year T-note yield is up above 1.8%, up about 5 or 6 basis points today. And when we've seen that in the past, including yesterday and the day before, value, cyclicals, transports, those kind of stocks tend to outperform. And we still see those momentum stocks getting hit as the 10-year T-note yield goes higher. If it breaks out meaningfully, it's going to break into a new trend. It's going to break a negative trend channel that has existed since 2018. That would be a big breakthrough, and I think we'd see this continued rotation here. I want to take a look at the earnings stocks. So these are stocks that released earnings yesterday after the bell or this morning, and we can see Uber down 8%. I want to talk about Shake Shack because, Brian, you and I were talking about that. Here is the year-to-date chart. I'm going to go to a 2-year, and we are trading right at about the 70 level. That is critical support because this goes back. This was a prior high in 2018. If we close below there, look out below. We also have the 200-day moving average right about where the price is here for Shake Shack.
Jared, best chicken sandwich in the game. I know all this Popeye stuff, that's all cute, but that's the best chicken sandwich in the game. Chris, back to you, and just staying on fast food. I'm sure you saw the McDonald's news over the weekend. The CEO is out. What do you do with a stock like that? It pays a good dividend. It's McDonald's. It's a brand we all know. But they appear to be in some sort of leadership crisis.
Well, that's a tough one. So that's not a company that I follow specifically, but I can just speak broadly about corporate governance. Corporate governance is incredibly important. It's one of the things that we look for. Because this was of a personal nature, that's my understanding of it at least, and not necessarily a strategy mistake or something like that. I have to think that McDonald's is the type of company that has a really deep management bench and probably on some level sort of runs itself, at least in the short-term perspective. So, I don't know that this is a major concern longer term for shareholders, particularly as you mentioned, some of the cash flow characteristics of the company. So, it's tough. These types of company-specific or what we call idiosyncratic risks are one of the reasons that we recommend a lot of investors invest in a diversified way versus being too concentrated, because you can have a great company with a great business model executing well, and then all of a sudden something very, very specific to someone in the management or some very specific issue crops up that causes this company to act differently than its peers. And that's a real problem if you're too concentrated.
Would love to get your thoughts on Uber. They lost more than $1 billion last quarter, but for the first time, really, the CEO is now talking about a road to profitability, actually targeting early 2021. Are you bullish on ride-hailing in general and specifically Uber?
Well, I'll tell you, the part of technology that Riverfront's really focused on and where we have our preference is outside of these high flyers that don't make money. Everyone talks about the FANG stocks and that sort of thing. But there's a whole nother segment of tech. I like to call it atomic, which is, and you can probably do the math on which companies I'm talking about. These are mega cap tech companies that instead of trading at huge multiples, in excess of the market, they actually, in many cases, trade at multiples lower than the market. They have much higher stable cash flow than the market as a whole. And they're kind of boring, right? In areas like software and services, it's not a sexy type of high growth industry, but they just mint cash. They return that cash to shareholders in the form of growing dividends. And I would recommend for investors to really focus their tech attention more on these types of companies than on some of the sexier, more highly valued companies that don't make money, whether that's now or in the future.
Atomic, I like that one, Chris. One more for you. Kroger out with big news this morning, a complete rebrand of the soup market. That is a space that has struggled. Kroger has struggled. What do you do with a stock like Kroger here?
Well, I think that this is where risk management comes in handy. And again, from my compliance department doesn't allow me to talk about individual equity. So let's talk conceptually about a company that has low margins. It's struggling in a low growth, low top line growth type of business model. For investors, this is the kind of thing where I've seen a lot of folks make mistakes because they get stuck into these stocks and they think, well, look, I'd be selling it at the bottom and that's terrible, so I'm just going to hang on. And then they keep hanging on until disaster strikes. And what I suggest when I talk to clients with these types of positions is, look, set a risk management level that's based on something that's not emotional, like a technical support level. And if it breaks that support level, honor your sell discipline and sell it, because more often than not, these leaky pipes continue to leak in the future.
AKA avoid value traps. Chris Constantinos, good to see you again. Jared, thanks so much. It's time to check back in with Yahoo Finance's Inez Ferre down at the New York Stock Exchange. Inez?
Yeah, Brian, and this morning we're watching Shake Shack under pressure after their latest quarterly results, with earnings per share coming in above estimates, revenue in line, but it's the same-store sales that were a miss, and the company also lowered its same-store sales guidance for the year, and analysts are saying that the fourth quarter could be worse as the Shake Shack moves to a single provider relationship with Grubhub. Also, we're watching Marriott. This is after their latest quarterly results, with adjusted earnings coming in below what the street was expecting. Revenue came in above street expectations. And then we're watching Adobe seeing a pop this morning after the company gave some strong guidance for their fiscal 2020, raising its fiscal 2020 guidance in an analyst meeting, saying that the revenue will total $13.15 billion, and their adjusted earnings are expected to come in at $9.75 compared to an estimate of $9.70.
All right, thanks so much, Inez.
Thanks.
Peloton released its first earnings report since going public. The exercise equipment company doubled its revenue to $228 million and narrowed its loss to just under $50 million for the quarter. And of course, the company is bullish on its future. For the full year, Peloton expects to grow connected fitness subscribers to more than 885,000. Earlier, we spoke with the president of Peloton, William Lynch, about those results and the company's path to profitability.
What investors can take a lot of comfort in is the closing losses with the growth. And anybody who's examining our business model can see that that ends in a very good place. We've got one of the most exciting business models I've seen in my almost 3 decades of working in consumer, beyond between the gross margins on the hardware and then the subscription and the membership. And so what we would say is, our board is supportive of our investments in our new growth planks. We've got a lot of things coming online this year. We've said fiscal year 20 is a big investment year for us. New studios in New York and in London, as you mentioned, R&D. And so what we'd say is examine the business model, look at the closing losses, look at the top line growth, and they should be excited. We are.
William, probably within the next 1 or 2 months, there'll be some more competing products coming on the market, notably a new SoulCycle bike and another product, I believe another bike from Nordic Track. How do you expect, or how do you plan to respond to some of those new competitive offerings?
Well, we don't plan to respond. We feel like we created the category. We've got a 7-year head start. What really focuses this team, Brian, is our members. That's what fuels us. And we feel like if we continue to innovate every day, every week, every month, we're going to be very successful. We spend more time thinking about the global opportunity in fitness. There's 183 million people globally that have gym memberships. And so we think connected fitness is here to stay. We think it's going to move to the home. And we think Peloton is a category of one there. And we just need to do our jobs and keep focusing on members.
William, I know you've been busy making some acquisitions. A few months back, you bought a Silicon Valley engineering company called Gossamer. Talk to me about what that acquisition means to your company's strategy. You talked about new products coming down the pike. I have to imagine Gossamer has something to do with that.
It does. That's a great question. And again, we're not going to announce new products today, but that team we'd actually worked with before in a past life. It is an elite team of engineers, and we have said we're a tech company, and we have a lot of plans for innovation. Our product roadmap is super exciting, and so that it was a known quantity to us. They've been doing work with some leading global tech companies, and we brought them over, and it was really an acqui-hire to accelerate product development, and that team's doing a great job. They've been with us. It's funny, it just got reported that they've been with us for almost 5 months now.
William, what does your international expansion rollout look like over the next couple of months?
Well, in 2 weeks, November 20th, we launched Germany, which interestingly, Brian, is our first foreign language market. So we launched UK last year around this time, 2 weeks after, launched Canada. those two markets are ahead of where the U.S. was at the same time. And so we had to really prove our business model in those two. Could we export the U.S. business model into those two markets? And so far, so good. We're really happy with it. So we're going to learn a lot from Germany, which is, again, our first foreign language market, which presents a few more complexities. But we're super excited about those three markets. It's interesting now with the U.S., U.K., and Germany, we're in the world's three largest fitness markets. That's going to tell us a lot, and it allows us to establish our presence where the biggest fitness markets are.
William, I know you started a free trial not long ago. I'm curious if that is swaying reluctant buyers, those who might have been on the fence. Are they coming on and joining the Peloton family?
Yes, we said in our analyst letter, we launched that September 12th, so it was really only the last 2 weeks of the quarter, but that is doing everything, home trial is doing everything we'd hope it would do. We had done some research on the biggest barriers to purchase for Peloton, and it's sort of the category baggage with fitness equipment. We'll actually use this product, and we had enough confidence in the experience that we felt like, hey, let's let members take this home, meet Robin Arzon, meet our amazing roster of instructors, use this software, get on the leaderboard with millions of people, and they're going to fall in love with it. And that's what we've seen. We've seen home trial lift sales substantially. And the thing we were looking at is, would we get returns? And return rate, any change in the return rate has been negligible.
And you were just watching William Lynch, president of Peloton, on its first earnings day. And you're seeing a big reversal in the stock. The stock is now down almost 8%. It was up close to 5% in the early going after the earnings report. You know, Alexis, real quickly, he dodged the question on profitability.
Yeah.
I think it's still sometimes off. And in this market, if you're not turning profits, you don't have a path, you're going to get penalized.
Yeah, for the first time in a long time, investors are real skeptical about companies, startups that don't show a real path to profitability. Even Uber saying today they expect to be profitable in 2021. That stock is down about 8%.
Yeah, but good quarter, and I lost about 7 pounds on this bike in the past 4 months, so win for me. Switching gears, oil is rising again today. Overextended U.S.-China trade deal optimism. Yahoo Finance's Jared Blickery is over at the Wi-Fi Interactive Board with today's commodities report. Jared?
Yeah, we have oil up 1%, testing yesterday's high. So we're going to take a look at the price action. This is a 2-day chart. So this high yesterday, just above below 57.50, was a 6-week high, and testing it again right now. So we're going to take a look at our 3-month candlestick chart, see where we are with the uptrend that is still in place here. Could go a little bit higher, and maybe to 58, 58.5 if we're going to test the upper end of this trend channel that we've been looking at. And then again, that would be a new 6-week high. And so this trend that's in place, we're watching that carefully. Dynamics in play. Are we going to ink that deal for phase 1 in the near future? It looks like everything is falling into place for that. And also it looks like we might be lifting some tariffs on existing tariffs, or removing them on existing tariffs. Guys?
I know you're also watching copper and nickel. What's going on there?
Yeah, well, we've been watching copper, and there's been an important kind of sea change going on. We have this kind of rounded bottom that's been going on. Last time we took a strong look at copper, we were looking at this reversal candle here, and then we have this trend channel that's in place for copper as well. And we've been having some constructive action. It all has to do with the trade situation, which looks like it's resolving.
All right, thanks so much. Appreciate it, Jared. Fighting deep fake videos and pictures. What is being done to end misleading information? We've got companies to watch coming up next. Now for a look at some of the companies the Yahoo Finance team are watching for you today. In its first earnings report since going public, Peloton doubled its revenue to $228 million. It narrowed its loss to just under $50 million for the quarter. The exercise equipment company issued a strong growth forecast for 2020 and said sales could go as high as $1.5 billion in the next fiscal year. Meantime, a rough quarter over at Marriott International. It missed on third quarter earnings, reporting $488 million in income. That's an 18% decrease year over year. The hotel chain also lowered its full year guidance as travel demand slows down. Marriott also repurchased about 3.8 million shares of the company's stock, worth $500 million. Google will now reward you for downloading apps. The company is bringing its Play Points program to the U.S. this week. Android users will be able to earn points on all purchases from the Google Play Store, including in-app purchases and subscriptions. There are 4 reward tiers in total, with additional rewards for each level. Adobe, Twitter, and the New York Times are teaming up to tackle fake pictures and videos. The trio launched a content authenticity initiative. The goal is to set a standard for digital media attribution. This will allow you to examine the file and track the media back to its source to tell if it's real or not. The chicken sandwich craze has led to a fatal stabbing at a Maryland Popeyes. Police say the 2 men got into an argument, allegedly about cutting the line. The company released a statement saying, quote, "We do not yet know whether this was the result of a dispute over one of our products or something unrelated. We are fully cooperating with local authorities." An inside look of what's happening behind the scenes at Tapestry inside the C-suite is coming up next. Welcome back to the first trade. Here's a look at the markets. We're coming off our highs of the session now. There was some euphoria earlier about a possible trade deal between the U.S. and China. The S&P just near the flat line. Dow up 30 points.
Some of the greatest minds in global finance are gathering in Connecticut for the Greenwich Economic Forum. Not long ago, participants heard from hedge fund billionaire Ray Dalio with Bridgewater Associates and Paul Tudor Jones with Tudor Investment Corporation. The pair was talking about the president and his impact on economic policy.
Donald Trump is the greatest salesman in the history of this country. He has somehow been able to move the Republican Party into believing that a 5% budget deficit, adjusted for the economic strength that we have right now, is a reasonable proposition and one that is good government policy. And then similarly, he has, through, and I'm being charitable here, great moral suasion, convinced the Federal Reserve Board that running negative real rates with a 50-year low in unemployment is also reasonable monetary policy with no consequences.
And stay with us. Wi-Fi AM is coming up at the top of the hour on yahoofinance.com and on our app. They're going to have more with Julie LaRoche at the Greenwich Economic Forum, where she's hosting a conversation about the revolution happening in venture capital and private equity investing. All right, time now to go inside the C-suite where we talk to some of the biggest names in business. And Brian, you had a chance to talk with the Tapestry CEO recently about their earnings report.
Yeah, Tapestry earnings out this morning. Not a good quarter again at Kate Spade. Same-store sales fell 16.8%. But to your point, Alexa, I hopped on the phone with Jide Zeitlin. He took over as CEO in September. He was the chairman for a long time, chairman. They're launching a review of the business. Now, I asked him, does that mean a potential sale of Kate Spade or Stuart Weitzman, some of the more struggling businesses? He says no. I think at least initially it will involve cutting a lot of expenses at Kate Spade and to a lesser extent over at Stuart Weitzman. And overall, holiday season is upon us. Pretty optimistic on the holiday season.
What about the Coach, though, continues to be a bright spot for Tapestry? What did he have to say about Coach?
Coach is the main driver here, and it's one of the topics we didn't touch upon that much because it has been a steady performer for the company. But I would suspect over the next 6 months, there's something going to happen with this portfolio. More expense cuts or Stuart Weitzman ultimately gets sold.
Expense cuts meaning job cuts, possibly?
Possibly. Something has to happen. This stock it has been hammered. It's been hammered.
What about Kate Spade? Did he talk at all about what they're doing to right the ship over there?
Well, a lot of the assortments you're seeing in the store right now are from the old CEO, and Victor Ruiz, one of the best CEOs in the game. He's left in September. I think they just have to get their processes right. They paid a lot of money for Kate Spade in 2017, and it was a business that has not been, I think, fully integrated into the culture of Coach, and they need to do it. And they need to do it quickly.
And look at this chart. Not a pretty sight. And year to date, Tapestry off about 19%.
But I will add this: so you look at the Louis Vuitton Tiffany deal rumors news. This company has some strong brands as well. You never know what happens.
What they do with them going forward. All right, thanks a lot, Brian. That's going to do it for the first trade for this morning. I'm Alexis Christoforous.
I'm Brian Sozzi. Now let's get one more check of the markets down at the New York Stock Exchange with Inez Ferre. Inez?
Brian, Alexis, we're looking at the Dow that's up about 50 points right now. And we're watching this morning Groupon just slightly under pressure. This is after their latest quarterly results with a miss on earnings and revenue. Their CEO said that this quarter they faced some challenges from traffic and also international macroeconomic conditions. And we're also watching Adobe this morning seeing a pop. This is after the company gave some strong guidance for the fiscal 2020 year. They raised their fiscal 2020 guidance with their revenue is supposed to come in at $13.15 billion. That's above what the street had been expecting. Also, their adjusted earnings for fiscal 2020 coming in above street expectations. And then we're watching Peloton. This stock has moved around a lot. In pre-market, it was up. Now it's under pressure. This is after their latest quarterly results with revenue coming in above estimates. Their net loss coming in at $49.8 million. Make sure to stay with us because Wi-Fi AM starts right after the break.
Good morning and welcome to Wi-Fi AM here at Yahoo Finance. I'm Dan Roberts. We've got Scott Gann and Anjali Kanlani here on the couches. All right, guys, Tuesday morning. Let's take a look at what markets are doing. We are seeing green across the screen, as we say. The Dow right now up 66 points, just 0.2%. The Nasdaq and S&P in the green as well, but not by much. And we have to start the day talking about rumored developments on trade. China and the U.S. are reportedly very close to finally signing a Phase 1 trade deal. But before Xi Jinping will sign, he is looking for the U.S. to roll back tariffs on up to $360 billion worth of Chinese goods, according to new reports out this morning. Our friend Jessica Smith is live in D.C. with the latest. Jess?
Well, there's a lot of different reporting out there this morning, but the main takeaway is that China is pressing the U.S. to remove tariffs in order to nail down the Phase 1 trade deal. The Financial Times reports that China wants the U.S. to remove the 15% tariffs that went into effect on September 1st. And the Financial Times reports the U.S. is considering doing that. Now, it's not clear yet if President Trump plans on canceling the tariffs that are set to go into effect in December, but that kind of has been the expectation, because if the two sides are going to come together for this deal, another round of tariffs wouldn't really help move forward. But now it looks like the Chinese want more. The FT reports if the U.S. does give in on the tariffs, then the U.S. would want more from China, including more certainty on ag purchases, greater IP protection, and then a signing ceremony on American soil. Dan?
Jess, as I understand it, there's also a big tech hearing today on Capitol Hill. I feel like I say that every week. And I'm sure China will be a big focus, including the acquisition of that app TikTok, which I know is under the microscope.
Right. This hearing is going to be led by Senator Josh Hawley, who is one of the most vocal critics on big tech and one of the most vocal critics of China. So this hearing is going to be focused on a couple things. First, American businesses doing business in China, and then Chinese businesses operating in the U.S. and potentially collecting consumer data. That's the issue here. Senator Hawley has been on our air saying that he's very concerned about U.S. companies kind of putting Chinese profits in China over U.S. values. So we expect that to come up quite a bit. TikTok and Apple both declined to testify in this hearing today. Hawley tweeted about that, saying, "I've invited Apple and TikTok to testify on Tuesday about their business in and with China and the risks to American consumers. So far, they are both refusing, something to hide." Now, he called the decision a mistake in other tweets and said in a press release that he's going to have chairs for TikTok and Apple at the hearing today. So expect a little bit of public shaming. In a statement to Yahoo Finance, TikTok said that it appreciated the invitation but couldn't provide a witness on such short notice. A spokesperson went on to say, in part, "We remain committed to working productively with Congress as it looks at how to secure the data of American users, protect privacy, promote free expression, ensure competition and choice among internet platforms, and preserve U.S. national security interests." We did reach out to Apple as well, but we did not hear back. This hearing starts at 2:30 this afternoon.
And Jess, obviously we've had a lot of tech hearings over the past couple of weeks and months and years. I mean, is there any evidence that any progress has been made after these hearings to accomplish any of the things that are talked about, or is it just sort of political noise at this point?
At this point, there hasn't been any real movement. There have been some bipartisan bills introduced, but nothing that is really gaining traction or really moving anywhere in Congress on the House or the Senate side. So these investigations will continue. We'll have more hearings. We'll see if they get anything done eventually.
All right, Jess, thanks so much.
Of course.
Well, UPS and CVS are going big on drones. UPS drones have just successfully delivered medication from a CVS pharmacy in Cary, North Carolina, to 2 customers' homes. Those drones are manufactured by Matternet. Now, this news comes just a few weeks after the companies announced their delivery partnership, so they are moving quickly, and these drone tests were done under the watchful eye of the FAA. Now, of course, there's competition in doing this from Uber Eats and from Amazon, to name just 2 players, but everyone wants to deliver via drone. I feel like whenever we discuss this, someone says, well, I don't want to see a drone coming in through my window in my New York apartment. It's like, well, it's going to be a long time before it can happen in big cities. I mean, Cary, North Carolina makes sense to me. For now, it's got to be big, open, rural or suburban areas where they can fly freely.
Absolutely. Yeah, I think that that's one of the key issues, too, is that you're seeing all of this happen in some of the smaller areas. But I think that that's where it makes the most sense, because in bigger cities, we have the same-day delivery option. I don't think that we necessarily need it here.
Yeah. Although you look at Amazon, I mean, the amount of money they are spending on first-day shipping, and investors don't really like that, right? So
right.
More costs.
Right. So if drones can bring down the cost of shipping, I mean, maybe over the long term, that is an important area to invest in.
Although it's confusing to me, how could they bring down the costs? I mean, I'm no drone expert.
But drones are...
But I would think that it's, if anything, more expensive, because think of the scale. I mean, every time you're doing it, you're using like one drone for, it might be some tiny amount. Can they carry a large amount? I mean, I just ordered on Amazon a fold-up table to have out in the backyard, and it was very heavy. The box was enormous. I don't think a drone is going to carry that to my house.
Well, I mean, the most expensive part of the shipping process is that last mile.
Yeah.
So maybe drones can help with that part, and that would be a significant development.
How, if the bulk of it is supposed to be, like the bulk ordering process and bulk delivery process, especially for the last mile, is supposed to be the cost-effective option, especially when you're looking at, the delivery process, having, all these boxes and they go around on the routes and whatever. How is it more cost-effective to just do it one by one with a drone? And then how many drones do you need? And then where does all this air traffic go? There's just so many questions.
Eventually, you're going to have to go to the store. Can we just leave it at that?
What? Go to the store? No one goes to the store. I would be very interested to read about sort of the math here and the finances.
Yeah.
But it's very, very early days, suffice to say. And then separately, but it's all related, I mean, I'm just not a fan of drones, at least the personal drone, for fun or for taking photos. I think they're annoying. I think the sound is annoying. But I guess if you're using one, it's fun. I'm just...
invasive too,
a
little bit.
I find it
Well,
invasive.
it's scary when you see the stories that they get near planes, and that's like
God, if there's even if there's even a chance that there's a safety risk to passenger airplanes because of drones, then get them out of the sky.
Absolutely.
It's all additive right now. I don't need them. All right, let's talk about Peloton. Peloton released its first earnings report since its IPO. You will recall that IPO didn't go very well. The earnings report did. The company more than doubled its revenue in the last year, and at first that sent the stock higher, although right now it is down 7%. Now, this morning, Yahoo Finance spoke with Peloton president William Lynch about the company's planned path to profitability and why he says Peloton is in its own category.
We feel like we created the category. We've got a 7-year head start. What really focuses this team, Brian, is our members. That's what fuels us. And we feel like if we continue to innovate every day, every week, every month, we're going to be very successful. We spend more time thinking about the global opportunity in fitness. There's 183 million people globally that have gym memberships. And so we think connected fitness is here to stay. We think it's going to move to the home. And we think Peloton is a category of one there, and we just need to do our jobs and keep focusing on members.
Boy, it's the same story because, as I mentioned, revenue doubled in last year, and at first the reaction was pretty positive to that. But in the end, it's still a company that has big losses. It's unclear how long it will take for it to become profitable, and you got to believe that's why the stock's down.
Well, and the WeWork situation has totally changed the way investors look at these companies, right? If you're not profitable, you get punished. Investors don't care. They don't ask questions. They don't want to look at your guidance. They don't want to look at this. They don't want to look at your books. Are you profitable? And it wasn't like that a year ago. And I think investors are finally waking up to the fact that maybe Silicon Valley isn't living up to the hype that it had for many years. Not to say that there's not tremendous innovation coming out of Silicon Valley, but is there a business model? And do some of these business models justify these multi-billion-dollar valuations?
I'm also very intrigued just by the amount that they spend on commercials. I mean, you see these commercials.
Peloton, absolutely.
Everywhere.
Yeah, what's the marketing budget?
Right? Yeah, absolutely.
Totally.
And how much is that cutting into everything?
Yeah, I'm really glad that investors and shareholders are finally starting to say, actually, I care about profitability, because I've been saying for a long time, forget sort of all the retorts about, they're smarter than that. It's about the long term. They're waiting. They're patient. Silicon Valley companies will eventually look at Amazon. Forget all that. In a very simple sense, a business is supposed to make money. I mean, I've been saying for a long time here, why for so long was everyone so willing to say, oh, profit, that'll come later. It doesn't matter. It's a great idea and people like it and the users are happy and profit will come later. How much later? I mean, you start a business, you're supposed to make money if you're a for-profit, entity. So,
well, what is comforting in my mind is the fact that these lackluster IPOs haven't really bled into the broader stock market. We're still at record highs, and a lot of strategists throughout the year were saying, if these IPOs don't go so well, that could signal that we're at peak market, right? Peak stocks. And we certainly haven't seen that yet. And I think there's so many other factors now driving the trajectory of the market. And I think investors are looking past these sort of high profile but not profitable IPOs.
Right. And you're right to point out, look, it's not that we're saying there isn't innovation in Silicon Valley. There is. I mean, just yesterday we were talking about Airbnb.
Right.
That's a company I love to mention. Forget its business, also not profitable yet. I think they've had 1 or 2 profitable quarters. But a great idea, I'm happy to say. I mean, I think one of the best fresh ideas that we've seen come out of Silicon Valley in like a decade. That doesn't necessarily mean that its IPO or direct listing will be a hit, and that doesn't necessarily mean that it will be fully profitable every year right away. We'll
or
see.
that it will be perfect in its
exactly right. And they've got a lot of legal and regulatory issues.
Yeah.
A lot of regulatory.
Talk about later in the show. Okay, coming up here on Wi-Fi AM, we will talk to the man who just bought out the IndyCar series, including the Indy 500. Welcome back to Wi-Fi AM at Yahoo Finance. Let's take a look at what markets are doing. You can see on your screen that we are seeing a mixed picture now. The NASDAQ and S&P have flipped into the red, the Dow hanging on to gains. Let's check in with our friend Ines Ferre live on the floor of the New York Stock Exchange for more. Hi, Ines.
Hi, Dan. Yeah, we have been losing some steam in the last few minutes. As you just mentioned, the S&P and the NASDAQ slightly in the red. The ISM non-manufacturing number came out for the month of October, and that was a solid beat, coming in at 54.7 versus what economists had expected of a reading of 53.5. And that reading, by the way, is higher than the ISM non-manufacturing number from September. And now we're talking about services when we're talking about that reading. Also, Marriott International, we're watching that stock this morning, not moving too much on the heels of its third quarter earnings. Its quarterly profit was down 23% from the same quarter last year. Its adjusted earnings coming in at $1.47 a share. That's below what Wall Street was expecting. Its revenue did come in above estimates. The company did lower a key metric, their comparable revenue per available room, and the CEO said that their growth was moderated really across markets, especially with the Hong Kong protests, which those limited growth for the company. Now, year to date, the stock is up about 20%, Dan.
All right, thanks, Ines. We'll check back in with you in 15 minutes.
Thank you.
Well, let's talk about the racing business. Penske Racing is the new owner of IndyCar. Penske, one of the biggest names in racing, is acquiring IMS from Holman Company, which owned it for 74 years. The assets include the Indianapolis Motor Speedway, IndyCar Series, and IMS Productions. And Roger Penske joins us now to discuss. Roger, thanks for coming on, and let me start by asking, why now?
Well, Dan, thanks for having me. I think I got to go back probably to 1951 when my dad took me to Indianapolis when I was 14, and I had a chance to, I guess, inject this sport into my blood and to think about, so many years later and the success we've had at the track. And quite honestly, 6 weeks ago, the Holman George family approached me concerning my interest potentially about buying the Speedway. It was something that wasn't on my radar at that point, obviously. But because of the long history we've had, I think we've owned tracks before. We had a public motorsports company that we sold to ISC in the past. So I think the domain knowledge we have, and obviously my understanding as a team owner, this was a great opportunity for us. It's an iconic asset for me, for our family, and I think worldwide it's the biggest sporting event with over 300,000 people. So, when you got domain knowledge and you have interest, and let me say this might be a dream came true after many years.
Roger, you talk about the fan interest, but of course live TV ratings are an issue for all the major sports now, even the NFL, which some people think maybe peaked in 2015. What do you make of where fan interest is for IndyCar, and what can you do now to grow it? Because there are some concerns that maybe ratings haven't been as good in the last few years for these races.
Well, Dan, I'd have to say quite differently. With IndyCar, our ratings were up. We had a broadcast partner in 2019, NBC, both on network and on cable, and that's been a big plus. Obviously, from the standpoint of our fan base, it's gone up almost at every single track. And again, on the Indy 500 weekend, we have between 250 and 300,000 people for that week, and also the race. So attendance, I think the social media piece has gone up, lots of interaction. We've raced at COTA, the Formula One track. We went back out to Monterey, California. So the schedule is about 17 races. We got a lot of date equity. I think the teams are stronger than they've been. We got a lot of new young stars. So I think we're getting in at the right time. And I know with the people that we have, and they've got a great team here at IndyCar, which has brought this thing to the next level. So quite different than maybe some of the other sports. I think this is a business that has short races. I think the duration is key, the excitement. I look at the demographics in the pit area and the people that we bring, lots of young people interested in this sport, and I think that's going to be key to our success, whether it's on TV or radio or in the social media or being at the event yourself. I think it's a real opportunity for the future.
Now, Roger, you also own an IndyCar racing team, and then you also have business interests over in NASCAR. And I know a lot of people say, well, look, NASCAR and IndyCar aren't necessarily competitors, the way that some people frame it. But I'm just curious what you'd say about whether there's any conflict with you owning the IndyCar series and also owning an IndyCar racing team. What's next for you in that sense?
Listen, that's amazing. I've gotten that question, I think, once an hour here over the last 24. So you're right on pace. Look, from my perspective, I've probably been a team owner in IndyCar longer than anyone else there. I think I've got credibility with the teams. I've always been a strategist on the box, calling a race. I'm going to step back from that, just as I do in NASCAR. I'm not involved down in the pit from the standpoint of strategy, obviously from the financial aspect of it, and maybe as you hire a driver, things like that. But I'm going to step back because this commitment that I've made is much bigger than just running one team or one car on race day. What I want to do is help bring another engine manufacturer in and do things that'll make the team stronger. And even potentially, as we've set this up from a financial perspective, we have the IMS Productions, we have the Speedway itself, Indianapolis Motor Speedway in one entity, then IndyCar will be in another one. And hopefully, as we get together the teams with full transparency, we can get some ownership as they have in NFL and other sports, that have associations and multiple locations to race in. So I think there's a chance to break some glass here in a positive way. I think we do have some momentum. And to me, what I've got to do is take our people. Remember, we owned the Michigan Speedway, owned California Speedway. So we've had that domain knowledge, and we still promote the race for the Detroit Grand Prix in Detroit. So we have people that can add our knowledge and our expertise to the IndyCar folks here. So quite honestly, you'll give me a report card on that, everyone will, maybe at the end of 2020.
All right, I will. I'll give you a report card. Very interesting what you say about maybe trying to recruit some NFL team owners. Roger, thanks so much for coming on.
Great, thank you.
All right, that was Roger Penske, who just acquired the IndyCar series. And coming up on Wi-Fi AM, we will tell you what tickers are trending today on yahoofinance.com.
All right, it is time for today's trending tickers. The first one is Shake Shack. The stock is down sharply. Look at that, down 19%. Earnings beat, revenue matched, and was up 32% year over year, but same-store sales rose 2% year over year. That was short of the 2.5% Wall Street was expecting. Now, the stock is still up about 60% so far this year, even with this big decline today. But, I mean, goodness, to see a stock, I guess, in bear market territory in one day, down 20%, happens.
It does. Well, and, you know, looking at food in general, we know is constantly on the up right now. So
well, people love burger. It seems to me like it's a hot time for burger stocks. I don't want to give away what ticker we're going to talk about next. But yeah, I mean, there are people who are just huge Shake Shack bulls, and that has been true for years already. People love that business, and it's funny to me how that has stayed even amidst all of the chicken sandwich craze.
Right,
I mean, people are talking about Popeyes, and they're talking about, is the Popeyes chicken sandwich better than Chick-fil-A? And then it's like, meanwhile, over here, Shake Shack just chugging along. I mean, the fact that it could be down 20% and it's still up 60% for the year.
I wonder
Sorry. Well, no, the stock was at 105 in early September. So you have a 20% decline from there prior to this earnings report, and then another 19% fall right now.
I wonder how they're doing in light of all, like what we've been talking about, right? All the Impossible Burger type companies. In light of all that and the trend skewing that way and them not sort of on board with that, I don't know, maybe that affects them.
And that is a good segue to our next trending ticker. Beyond Meat, which of course was upgraded today to outperform from market perform by the analysts at Bernstein. Their price target at 106 held steady. Bernstein thinks the risk-reward ratio of the stock is actually tilted to the upside, though they did say, guys, get this, the company's trial at McDonald's in Canada has not been a, quote, blowout. So
I'm not shocked.
Yeah, I was going to say, I'm not shocked.
Are we seeing cracks in the Beyond Meat hype after 4 months of endless ridiculousness?
I think this goes back to a traditional thought about food, and that it is very market specific. You're going to have certain things that will just blow it out of the water in some areas, and in some markets you just will not see that pickup.
Well, and I don't want to go too far and just, basing something off this one example in Canada, but I wonder if Beyond Meat, which a lot of its success is people starting to think more critically about their environmental impact and the impact of eating meat, I wonder if that awareness and issue is a bigger concern in America than in Canada. I wonder if for some reason Americans are more focused on that and more thinking about that than Canadians are.
And I also wonder if the idea that processed foods, because at the end of the day, this is still a very hyper-processed food, so even though it's healthy, there are some areas where they just will not accept it, regardless of how healthy or plant-based it is.
And I don't think it is healthy, by the way. I think it's just better for you than a cow. But they pump this stuff full of salt and sodium to make
it's like
it
diet
good.
soda. I mean, they say diet soda is better for you because it's lower calorie, but then when you look at the artificial flavoring and whatever that's in there, the artificial sugar.
There's so many examples. It's like Subway. Oh, eat Subway sandwiches to lose weight. Well, Subway's not good for you. It's still fast food.
And
it's
the bread.
just not as bad for you as other fast food chains.
Right. Yeah. No, I think it goes back to are we becoming smarter as consumers of food and just sort of understanding that more? I don't know. Maybe.
But why did this IPO take off Beyond Meat, and so many other ones that had better name recognition
did not?
Well, and it's not the first veggie burger. I mean, I know it's not a plant-based, whatever, but there are other brands out there that have been around for ages. On one of our other live shows a couple months ago, we had Dr. Praeger's, and that's a veggie burger brand that's been around a long time. And we said, oh, what do you think of the Beyond IPO? And they said, look, we're just focused on, we've been successful for a long time. We're just heads down, focused on our business. And I thought, come on, you would love to be Beyond Meat Burger. You would love to have the IPO they've had.
The attention,
but it is interesting. It is interesting how something sticks.
Someone needs to do that. Someone needs to talk to the CEOs of all these companies side by side.
Not that they're going to tell you anything interesting.
Well, and what's tomorrow? The Uber lockup expiration. So that is another layer of these IPOs, which is that, okay, 6 months later, you're going to have all this uncertainty and volatility from people in the company trying to cash out. And look, I mean, Uber shares are down 30-something% since the IPO. So you're talking about people that might be losing money or not making as much if they start selling this week.
They're going to sell. A lot of them are going to sell tomorrow. Really glad you mentioned that because we'll talk about Uber later on in the show. Now, coming up here on Wi-Fi AM, the latest rallying cry issue for employees inside Google, oil companies. Welcome back to Wi-Fi AM here at Yahoo Finance, where markets are a mixed bag, not too much going on. The Dow right now in the green, but the S&P and NASDAQ in the red. And activist employees at Google are calling on management to take steps to reduce Google's carbon footprint, and they're focusing on deals with oil companies. In a letter, more than 1,000 workers ask Alphabet's CFO to release a company-wide climate plan that shows the company is committed to cutting carbon emissions entirely. The letter also asks the company to cut any contracts that, quote, enable or accelerate the extraction of fossil fuels. Now, what contracts do you think they're talking about? Google has cloud computing contracts with oil giant Schlumberger, with Chevron, with Total SA, and with Aramco. So we'll see what happens there. Scott, you often cover the oil markets, and I know you've covered the Saudi Aramco IPO, which we've heard so much about for so long. Do you think Google will make any changes here?
Well, it's tough because this is such a fast-growing space, and there's this sort of tug-of-war going on right now in the industry, right? AWS, Amazon Web Services, is the leader. Microsoft is probably, number 2? And then maybe Google Cloud is somewhere in that leadership, right? But everyone's trying to compete for this pie. Now, you could argue that we're in the early innings of the cloud process or the cloud industry, so maybe there's room for everyone. But it's a tough call because clearly employees now are taking note of what's going on in the cloud business, because you could argue that there's not enough education as to what the cloud is just among the general public.
Exactly right.
And that goes to, the hearings that we've seen on the Hill, and talking about just generally more companies having these employees that are active, that are protesting. We saw it with Wayfair and the equipment that they were selling to the detention camps. Yep. And then you're talking about Google, who earlier also had to deal with sexual harassment and and the search engine in China, right? So you have a lot more activity going on where the employees are now bringing attention to the issues that the general public may not really be aware of.
Well, and the Business Roundtable a couple months ago updated their statement as to what a corporation is, right? Who does it serve? And so this is a great example, like, will companies actually make decisions that change sort of the shareholder priority? And in this case, if you're not going to have these contracts, you're not necessarily serving shareholders, because these are, one would think, lucrative contracts. Or do you really take note as to who you're doing business with and say, you know what, I'm not going to do business with that oil company because of the environment.
Right.
So it's a really fine line that these companies may be forced to walk in the coming years.
The examples abound. You're totally right. I mean, guns as well. BlackRock for a while was facing protesters for its investment in gun companies, as well as Dick's Sporting Goods saying, you know what, we're not going to sell rifles anymore, assault-style rifles, and we're also going to raise the gun buying age to 18. And a lot of its customers said, well, that's it. I'm done going to Dick's. Stock took a hit in the short term. But the CEO has doubled down on that, Ed Stack, and he said, after a number of school shootings, we just said we have to act.
I think it is going to be interesting to see how much longer this trend continues, where employees, or even when you talk about activist boards, right? we've had situations with that as well. How much longer it can go on? Is it a sustainable sort of strategy to hold these companies accountable?
But where do you draw the line? I mean, can't you argue that there's an issue with every business, right? Someone's going to be unhappy. So it's like, at some point, your employer has to make money. So if you're going to be upset about every contract that they close, well, then you're not going to have a job.
And I brought this up with the Stephen Ross protest. People saying, oh my God, now I find out that Equinox and SoulCycle are owned by a person who is a Trump supporter. I'm not going to go anymore. That was all everyone said. I really don't believe many people actually stop going and cancel their accounts. And also, if you decide, I don't want to give my business to any company that has even a remote tenuous connection to Donald Trump, well, good luck, because that's a ton of companies.
Right.
So, tough. All right, if you own a smart speaker, you should already know by now that those devices can be susceptible to bad actors. But the latest way that hackers can get into your homes has nothing to do with the voice controls on those devices. Hackers have another way they can get in. Researchers in Japan and at the University of Michigan have found that hackers can gain access to voice assistants like Amazon Echo or Google Home by pointing a laser or even just a flashlight at the devices, because the microphones respond to light as if it were sound. And that can allow hackers to talk to your device and command it to do something like, say, unlock a door. And the tests found that researchers could control devices from as far as 350 feet away. Goodness gracious.
I am not touching these devices.
Go up to the window and
this just doubles my commitment to never buying one of them, ever, ever, ever.
I mean, if you are someone who thinks these things are great and convenient, and I know many people who love them, you go, Alexa, play the Rolling Stones, or chop chop, and you put the lights on, fine. But if you are someone who owns one, I would hope that by now you are aware of the various problems. None of these reports should come as a shock to you.
Absolutely.
If you're shocked and you're seeing one of these news stories by now and you're saying, oh my goodness, well then you haven't been paying attention, you've been sleeping. So I'm not gonna get one either. I'm with you, Anjali. I don't want one, I don't see the need for it, I don't want one in my home. But a lot of people don't really care, I don't think.
Or separate, like make sure that especially for the people who have very, IoT houses, do not have your door connected to Alexa. Do not have things that are access connected.
Well, and when you talk to people like in the industry, they're going to tell you, well, we're going to be using voice for everything now. So you're sitting on your couch, you want to order something from Grubhub, you're not going to go on the app anymore. You're just going to tell Alexa or whatever device you're using. So I think there's going to be some sort of need to be comfortable with these devices, or that whole technology is going to have to change, right? I mean, are we going to have deja vu with the social media privacy issues? Is that going to translate into some of these voice devices?
It's funny when you,
same issue.
Yeah, and you mentioned IoT houses, and you mentioned everything being connected by voice. I'll never forget years ago when I was at Fortune, I did a story on this company, Ubeam, that had a lot of hype, a lot of investment, and it was going to create wireless charging pads. So you could put it on the wall, and you don't even have to touch your phone to it. It would charge your phone through the air. Never really came about. It fizzled. I think the company's basically dead. But one of the investors was Mark Andreessen. I did a short phone interview with him, and he was saying, the future is every single thing in your house is IoT connected. Even your toothbrush is connected to the internet. And hearing that, I was just like, okay, dude. You know, like, I don't know. I don't need my toothbrush to be.
But he's probably got a good amount of money betting on this stuff.
Totally. A lot of money. All right, we'll leave it there. Coming up on Wi-Fi AM, Uber reported its earnings, and there was one number that was not great. We will give you the numbers after the break.
Welcome back. I'm Ines Ferre here with Tim Anderson from TJM Investments. Tim, we're right now looking at a little bit of a mixed picture. Not a lot going on today. We did have that ISM non-manufacturing number which came out, which was a solid beat, correct?
It was, and the market spiked very sharply and now has sold off. We could be having a little bit of a sell on the news reaction to that number. We have a couple of the other indices, the transports index and the Russell, that are at levels they haven't been at in 6 months and just over a year, respectively. So I wouldn't be surprised if there are some people that are selling into the strength that the market has right now, given that the Dow and the S&P and the NASDAQ have made new all-time highs, the Dow for the first time yesterday, and then the transports above 11,000, the Russell 2,000 above 1,600 could just be bringing out some sellers because neither index has been there for a while, and the market is clearly going to look to see how resilient the buying really is going into the last 2 months of the year.
Talking about China and the U.S., there are some reports that some U.S. officials may be considering perhaps rolling back some tariffs on Chinese goods. Do you think this is what the markets need to kind of break out from here?
Well, that would certainly be a sign of goodwill for the trade talks that things are moving in the right direction. Now, that being said, I'd be very surprised to see them take all of the tariffs off that are scheduled December 15th. They may delay them for 30 or 60 days or 90 days as a goodwill measure. But all of the other tariffs that are currently in place, I really don't see them taking them completely off, because that's the only real leverage that the administration has right now against China in the trade negotiations. I think it would be likely if they took them all off, the negotiations would slow down.
And what's the chatter here about signing this phase one soon? I mean,
Well, it would certainly be. It was going to be signed, obviously, in mid-November at the APEC, which has been canceled because of some civil unrest in Chile. It's going to be signed at another location. I don't believe we know where yet, but it might be a week later than that. It might be 2 weeks later than that. Clearly, they both have an open spot on their schedule for that time frame, because both of them were going to be at that conference. But we just have to see what comes out next.
and for the month of November, what are you going to be looking at?
Well, I'm going to be looking at the productivity report for Q3 tomorrow very closely. Q1 and Q2, we had the highest back-to-back productivity numbers for probably 12 years. And productivity is a little bit of a multiplier effect for the whole economy. It has an impact on GDP. And if that number can be still above 1.5% toward 2%, that would be above consensus, and that would show that economic growth is probably going to be a little bit better than expected.
Thanks so much, Tim Anderson. And make sure to stay with us. Wi-Fi AM continues right after the break.
Welcome back to Wi-Fi AM here at Yahoo Finance. Let's see what markets are doing. The Dow is hanging on to gains just a little bit. The Dow's up 30 points. The Nasdaq and S&P are basically flat. Red just barely on your screen. Let's talk about something in the red. It's Uber. Uber reported its Q3 earnings, and it was, at best, a mixed bag. It's down 7% right now. The stock revenue growth improved, and it topped expectations. But Uber lost more than $1 billion last quarter, and those losses were even more than Wall Street had expected. Worth mentioning, this comes on the heels of a good earnings report from its rival, Lyft. So what do you guys make of Uber's earnings?
Not surprising. I mean,
Yeah.
we kind of knew the company was not profitable, and we saw the financials a few months ago, and there was no expectation that that would turn around at this time. We talked about the lockup period expiration earlier in the show. That is supposed to be tomorrow. I mean, the stock is now down, I think, almost 40% since the IPO, which was about 6 months, because as of yesterday, it was down 30% since the IPO.
Right.
So you add the 7%
Down
loss
11%
today.
in the last week, and it's going to go down again tomorrow.
I mean,
don't
down
think it's
below
going the other way.
$30 a share.
Yeah, and when we saw that with Beyond Meat,
Right.
which had room to lose a little, but when the lockup period ended for Beyond just recently, right? Am I thinking of the right?
Yes,
Was it
well,
Beyond?
and that's because, I mean, the stock went up so
Oh, sure.
incredibly.
No, if you have
couldn't
private
blame
shares,
anyone.
you sell when that lockup period expires. I mean, maybe you only sold half of your holdings, but, you know, stock took I think a double-digit hit that one day. It was about a week ago when the lockup period ended for Beyond Meat.
It may have been even longer than that.
Yeah, maybe in 2 weeks.
But certainly, I mean, you mentioned in the intro the fact that Lyft announced a few weeks ago that they're going to be profitable earlier
Q4
than expected.
2021, right.
That is significant because investors are saying, well, what about you, Uber? How come
Right.
you're not profitable?
Right.
And you have all these other diversification to your business.
Exactly.
Right? You have
And,
Uber
yeah.
Eats.
And I think, well, maybe the narrative is changing, that people are starting to say not, oh, look at all the different things Uber has, and more, oh, look at how Lyft is really focused. They do one thing.
They do one thing, and yes, Uber has more diversification, but also Lyft, I think, has a better local brand. They're doing a lot more sort of like in communities and focusing very locally. So I wonder if that is also playing a role, where Uber is seen as sort of this, like overarching, has more international, market, versus Lyft, which is very much still here.
Yeah, and depending on whom you ask, I find that people either say there's no brand loyalty in ride-sharing apps, or they say, oh no, there is. I only always use the one I like. What do you use if you're going to hail a ride?
I use Lyft.
And only Lyft?
I tend to.
Do you have Uber on your phone?
I do have Uber on my phone.
Okay, Scott?
Mostly Uber, but there are times when if Lyft is running a promotion, like over the summer they had like a 3-week thing where you got 25% off every ride. For those 3 weeks, I use Lyft.
Well, Lyft is still relatively cheaper. That's the reason why I use it.
So only in New York City, because it's nowhere else, I use Juno, which actually was acquired by Gett, G-E-T-T, but
That's
it still
still
has
around,
its own app,
Gett?
Juno. Yeah, and Juno, I find, is always cheaper than Uber and Lyft, just by a couple dollars.
Right.
But outside of New York, I just use Uber. I find Uber to just be faster. I don't know.
It makes a difference. And also, like in international travels, I try to find whatever the local ride-sharing app is. And so it's really interesting to see how they all operate.
Well, there's so many worldwide.
There's
so many. All right. Democratic presidential candidate Bernie Sanders is taking a jab at Apple. The company just announced its plan with California Governor Gavin Newsom to put $2.5 billion toward funding affordable housing in California. Bernie Sanders criticized Apple for not paying enough taxes, and he also says the company won't really be fixing the housing crisis in California. It will just be adding real estate to its already large real estate portfolio. Now, in a statement, Bernie Sanders said that Apple's announcement that it is entering the real estate lending business is an effort to distract from the fact that it has helped create California's housing crisis, all while raking in $800 million of taxpayer subsidies and keeping $250 billion of profit offshore in order to avoid paying billions of dollars in taxes. And of course, you'll remember that Sanders in the past has had some success going after both Amazon and Walmart. Guys? Bernie versus Apple.
He's not wrong. I mean, to a degree, you have to consider the fact that, number one, these tech giants have, in fact, boosted real estate prices for a while now. That was the major issue we saw in the Amazon HQ2 race. But then you also have to consider the fact that what he's doing is not necessarily unique. I'm talking about Apple, sorry. What Apple is doing is not necessarily unique in that they're trying to solve the problem or trying to, in some way, enter a different, diversified sort of, stream.
Well, and Google has said the same, by the way. Google has devoted some amount of money to trying to help the homeless crisis in SF.
And it's not just these companies. I see it a lot in the healthcare field as well, where they see the opportunity for revenue through this.
And we do both, which, by the way, if it works and it really helps the problem, I'm all for that. If you can help a social issue and also it helps your business, fine. I don't see why it has to negate the goodwill if it helps the business.
Housing crisis, definitely an issue. These companies are indirectly at fault, you could argue, but look, they're just growing their business, and as a result, the developers and landlords in the area have caught on, and it's a simple supply and demand equation. Clearly a terrible situation. The only issue, though, is that these companies, if we're going to talk about politicians attacking tech companies, are big employers in the U.S. I mean, you're talking about hundreds of thousands, maybe even millions of jobs in this tech industry. So we don't want to discount those.
No, and here we go. It's Amazon and Queens again. Same kind of debate.
And are there points of, well, how much more should companies be focusing on paying their taxes, right? Because that was, I think, one of the key points that he brought up, and a lot of people have clung to that, saying, yes, there isn't enough, push on some of these companies to start paying their fair share of taxes, not hoarding overseas, et cetera. So that's one issue. But also, when you're talking about the housing crisis, I think a lot of the conversation leaves out even the local government, because if you talk about the approvals, right, for some of these new buildings, all the real estate that goes up, that's also on the local government's back. So it's up to them also to even prevent gentrification, prevent these housing crises from happening. Yep. They do have the power to in some way alleviate that.
Right, let's see what local government does. I will say, in no city in the U.S. that I've been to other than SF is homelessness a more overt and clear and obvious issue. I mean, in San Francisco, in parts, it's just wild.
I I don't know. I want to say in some recent traveling that I've done, actually, so I was also in Chicago very recently, and I think I saw it more there than San Francisco, which I was there last week. So I don't know. I think it's just in all the major cities. Philly even you can talk about, right?
Yeah. In SF, the tech companies are becoming very aware of it, though.
Right.
Yep. And they want to do something, or they at least feel that they should look like they're doing something.
Right.
All right, coming up here on Wi-Fi AM, we will check in on the Greenwich Economic Forum, where big investors like Steve Case and Alan Patricof are speaking today. Welcome back to Wi-Fi AM at Yahoo Finance. Our colleague Julia LaRoche is at the Greenwich Economic Forum today in Connecticut, hearing from a number of big names in investing, including Paul Tudor Jones. Julia joins us live now. Julia, what are some of the highlights so far?
Yeah, well, Dan, the highlight was the kickoff panel with Paul Tudor Jones, the legendary macro hedge fund manager, alongside Ray Dalio, the co-CIO of Bridgewater Associates. These are probably two of the biggest names in the hedge fund space. And what did Paul Tudor Jones say? Well, he said that the 2020 election will be more meaningful than any election in his lifetime. He said the next president will have a huge impact on the economy, stock market, and asset prices. Take a listen.
So as an investor, you have to have a view on the election because the outcomes are so extreme. I've never seen this kind of polarity in the elections as we have now. And they always say, oh, well, it doesn't make any difference who president is. You know, the markets rallied 53% of the time under Democrats and 52% of the time. It does make a difference. Ronald Reagan, when he became president, was a huge difference to the stock market. And I would say who the next president is also going to have a huge impact on the economy, the stock market, particularly asset pricing, because clearly asset prices today, whether it's U.S. stocks, whether it's interest rates, whether it's the dollar, it's all priced off of, in my opinion, a 5% budget deficit with this incredibly overly stimulative fiscal policy combined with this overly stimulative monetary policy is creating this U.S. exceptionalism that one day, like if we normalized our deficit to where Europe is right now, would have a completely different valuations for the stock market, valuations for the dollar. The dollar would be substantially lower, I believe. So this next presidential election and what policies they pursue afterwards, I think this one is going to be more meaningful than any one, certainly in my lifetime. So it's going to be really interesting.
I agree with you.
Yeah, and Dan, some of the other highlights from the talk is that Paul Tudor Jones referred to President Trump as the greatest salesman of all time. Now, he said that sort of tongue-in-cheek, referring to how he's basically moved the Republican Party in the direction of, accepting the 5% budget deficit, given the economic strength that we're seeing. Elsewhere in his talk, he talked about modern monetary theory and the acceptance and the evolution of the acceptance of MMT, analogizing that to marijuana and the social acceptance there. Also touched upon capitalism and ways to fix it. Be sure to check out all of our coverage on Yahoo Finance. Back to you guys.
All right, Julia, looks like a nice place to be standing. Have a good day of reporting there at the Greenwich Economic Forum. Thanks. Well, ESPN is all in on the relaunching of XFL. ESPN will air every game from the new league on its digital platform in Europe, the Middle East, and Africa. Now, the games will show live and on demand through the XFL's postseason. And in the U.S., games will air live on linear cable on a combination of ESPN, ABC, Fox, and Fox Sports. But remember, the XFL the first time around in 2001 only lasted one season. And you might recall that another new fledgling pro football league earlier this year, the Alliance of American Football, lasted less than one season. So what do you think? How will the relaunching of the XFL go? I will reveal I am not super bullish on it. Maybe it'll get one season.
Why?
Because there's the NFL, and yes, it's so big, and people say it's so big that there's appetite for another pro football league, but I'm not sure. I think the NFL is already a year-round thing, and I'm just not sure that we need another thing in addition to the NFL.
And if there are ratings worries about the NFL, and now you're starting another league, it's like, well, is there demand for that?
I agree. I think we're talking about a saturated market completely.
I mean, there are, let's make sure we say, people behind this league with deeper pockets and better connections than the people who are behind the AAF. So, you know, in the AAF, which I mentioned failed earlier this year, people said, uh-oh, XFL, but other people said, no, the XFL has more money, and, you know, Andrew Luck's father is behind it, Oliver Luck, and he's experienced, he's the commissioner. I just don't think that guarantees anything.
I agree. I don't think it does. And you're also talking about, in general, like the appetite for sports, right? We've seen how some sports have struggled over time versus others. Yes, NFL is year-round, but is it more of a passive thing at this point? Do we really have a lot of sort of active viewers? And right. What does the international market look like for sports today versus, you know, what it did before?
If it fails, I don't think it'll be that it runs out of money. That's the difference. The AAF ran out of money. I think it'll play a full first season, but the ratings won't be good, and then it won't get a second season.
Well, we should talk about the media angle to all this, because it's interesting to see them launch it on multiple platforms. So you would think they would do digital only, but they're still doing some stuff on linear TV.
It's going to be on TV.
A nod to the continued strength of linear TV,
right.
Even though it is a declining business.
No, totally. The death of cable has been greatly exaggerated. And it's interesting to see both ESPN and Fox paying up to get the rights to the XFL. But we'll see past a year. Yeah. You know, it's not a long-term contract. All right, more football for everyone. Coming up here on the show, Airbnb is spending big to fight lawmakers in Jersey City. Welcome back to Wi-Fi AM at Yahoo Finance. Markets right now, still a mixed picture. The Dow is trying to hang on to gains. It's up single digits, and the NASDAQ and S&P are down by the same. So basically flat across the board. Now let's talk about Airbnb, because Airbnb is expected to go public next year, maybe via direct listing. Now, Jersey City will decide today whether to increase regulations on short-term rental properties, and that will have a big impact on Airbnb. If the rule is approved, it would require owners of these properties to get a permit from the city and set limits on the number of units that can be used for these short-term rentals. Now, Airbnb has spent millions trying to fight this, so we will see what happens. And of course, Airbnb is also still battling lawmakers in New York City Anjali, you actually spoke to the mayor of Jersey City about all this.
I did, yes. So, yes, like you mentioned, Airbnb has spent, I think it's like $4.5 million at this point to fight this. And Jersey City and the Democratic Party there has also fought back with about $1 million or $2 million of their own. And what we're looking at is, according to what the mayor was telling me, it's not necessarily that he's against Airbnb. He's a very sort of pro-business mayor, and understands the benefit that New York and the spillover from New York has had on Jersey City and that area. So what he's saying is, no, it's not a ban on Airbnb. It's just, if they're going to operate as a business, then they should have rules like a business.
And it's interesting that Airbnb is fighting this so hard because, again, Jersey City doesn't want to ban Airbnb. It's just, we're going to set these regulations and tougher rules.
And this brings to light, what is the definition of Airbnb? Is it just a thing where you're going to rent out your house every couple of days? Or is this, you're going to buy a house solely to rent out on Airbnb as a business? And I'm surprised that Jersey City is even looking into this, not because there's not a lot of issues with Airbnb, there probably are, but because the restrictions in New York City were so immense, and Jersey City was long viewed as like the Airbnb safe haven.
Yeah.
But not anymore, maybe, if this vote goes
It's a
through.
volume. Well, that's why, because the volume went up. I think like 4 years ago they had maybe 300 listings, and now they have 3,500.
Because it was so close to Manhattan, and it was a great place to stay if you were, traveling from wherever you were traveling from, and you didn't want to be right in Manhattan paying the high prices. You had a quick train ride over the river, and you could still get a good apartment.
Well, and that's why, because, we were talking about the housing crisis earlier in other cities. That's kind of happening. Like Jersey City is seeing where their prices are booming so much to the point that people that have been there for such a long time cannot afford to live there anymore. So they are concerned about that as well. And this is a little bit of where that is coming from, to make sure that the prices aren't artificially inflated because of the Airbnb buy-ups.
You have short-term rental demand pushing up prices for actual real property. That is quite a scary dynamic.
There you go. All right, that's Wi-Fi AM for today. Thanks for watching. We'll see you right back here tomorrow at 10 a.m. But don't miss On the Move. That show starts next in just 2 minutes.
It is 11 a.m. here in New York City. We're about 90 minutes into the trading day. Stocks are mixed right now. The Dow and the S&P, the S&P and the NASDAQ are heading a bit lower. The Dow just very slightly higher, but overall not much change. Here we go again. The U.S. and China reportedly consider rolling back some tariffs as the two sides look to finally make progress on the long-awaited trade deal. Losses hit the gas. Uber shares slide after the company's third quarter earnings showed bumps in the company's road to profitability and working things out. We'll hear from Peloton's president following the company's first earnings report since going public. Welcome to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. We want to head to the floor of the New York Stock Exchange to get the latest on what is happening. But before we do that, U.S. and Chinese officials are reportedly considering rolling back some tariffs to clinch a partial trade deal and end a trade war that has rattled global markets. We're going to go to Washington's Yahoo Finance's Jess Smith with the latest for us. Jess?
Hey, Adam, there's a lot of different reporting out there this morning, but the main takeaway is that China is reportedly pressing the U.S. to remove some tariffs in order to nail down that phase one trade deal. The Financial Times reports that China wants the U.S. to roll back those 15% tariffs that went into effect on September 1st. And the U.S. is reportedly considering it. Now, it's not clear if President Trump would cancel the tariffs that are set to go into effect in December. The president has said that that's a possibility, but it's been widely expected that he would do that if the phase one deal is going to happen, because if that deal comes through, it wouldn't really be very productive to have another round of tariffs go into effect. But it looks like China wants more than that. They want those September 1st tariffs rolled back. In the FT reports, if the Trump administration does give in on this tariff request, that they would want more from China, including more security on ag purchases, more protections for American IP, and a signing ceremony on American soil. The two sides are trying to nail down a place that could be doable for a signing ceremony. Some of the ideas that the Trump administration has floated include Iowa, Alaska, and Hawaii. Adam and Julie.
Jess, thank you. We're joined by this hour's panel to discuss all of this. Former CFTC Chief Market Intelligence Officer Andy Bush and Yahoo Finance's Jared Blickery are both here. Andy, let me start with you. Why would it be in the interests of the United States to roll back these tariffs? Because we're getting some good economic data reads. I mean, the ISM number today, even though it's services, this economy seems to be doing just fine with the existing tariffs.
Yeah, I mean, it's a question of what President Trump wants. I mean, obviously, he has great control over the trade situation, and I think he can decide whether he wants to have those tariffs on there to apply additional pressure to the Chinese or whether to roll some of them back to show good faith. I think there's three tracks that trade goes on. It's Super 301, unfair trade practices. It's human rights issues, which just came up with some of the Chinese companies that are out there. And I think the last one, of course, is security with Huawei and other ones. So when I look at this as an important thing for the stock markets, but not nearly as important as what the Fed's doing. So this is a great thing for the markets to get excited about and to start buying stocks. That's great. But overall, we're far from being done with trade.
Well, and the buying part isn't happening today, right? Jared, when you look at the recent movements on trade in the markets, we're seeing that pretty absent today. So it seems like market participants are maybe a little skeptical that this means much.
Well, I think there's so much embedded in the market right now in terms of expectations. And even the existing tariffs that have been implemented or additional tariffs since September, even those might be rolled back right now. So the market might be getting a little bit ahead of its expectations there. But some important developments here. We've seen a strengthening of the Chinese yuan. It just broke below 7 overnight for the first time since August. I think that's a big development as well. And it takes a lot of pressure off of the Chinese government. They also helped spur that by reducing some of the one-year lending requirements for the banks.
If that's the case, what kind of leverage do the Chinese have against us?
Well, it has to do with $50 billion worth of agricultural products, whether they're going to buy them or not. I'm out in the Midwest, out in Chicago, and farmers are hurting. It's really a tough time. Agricultural prices have been low since 2014. You're starting to see delinquencies on paying for their farms. You're starting to see defaults occur. So there's a lot of pressure there. And there's a reason why President Trump wants to sign this in Iowa, for exactly that reason. So that's the leverage that the Chinese have. Whether they buy $50 billion this year or over an extended period of time, that makes a huge difference. But they will continue to buy U.S. ag products, and that's really the key here.
All right, let's move on to a specific stock that we're watching today. That is Uber, which beat estimates on the top and bottom line in the third quarter. But the company did report over $1 billion in net losses. The shares are down 7.5%. There was weakness in Uber Eats in particular. Joining us now, Emily McCormick, to break down the numbers here. So, Uber was supposed to be this sort of more, holistic or sort of more well-rounded of the rideshare companies.
That's right. Well, we did see a beat on the top and bottom lines for the third quarter, but a little bit of disappointment on some of those internal business segments, particularly on the Uber Eats side. So just looking overall, that adjusted EBITDA loss was only $585 million, much better than the $805 million loss expected. And then adjusted net revenue of $3.5 billion also topped expectations. But if we turn to gross bookings, that's the total value of customer payments to Uber before netting out those driver payments and other items. That came short. That was just $16.47 billion versus the $16.7 billion expected. And this miss was mostly driven by Uber Eats. That segment we now know is not profitable, although the ride segment has posted an adjusted EBITDA profit and has actually grown by 52% over last year. It's one of the things Uber called out was that just looking at that ride side, that rationalization of the industry has driven it more towards profitability. Dara Khosrowshahi, the CEO, is now saying that they're aiming for 2021 to see profitability on an adjusted EBITDA basis. So about the same time, if not slightly before the timeline that Lyft, that number 2 ride-hailing giant in the U.S., had given earlier last week. And the last thing I'll point out is that this is mostly a mixed report for Uber, but we are seeing shares punished, particularly because we're seeing that IPO lockup period ending tomorrow. That's probably going to inject some more volatility into the stock. It's the first opportunity that early investors and employees are going to have to actually sell their shares. Part of the reason we're seeing that sell-off now. Adam and Julie.
Thank you, Emily. Appreciate it. I have to wonder, when I look at the decline in the shares, how much of it is because of the anticipation of the lockup expiration? Because Uber, yes, there were some weak points in the report, but it also made a similar forecast to what Lyft did last week in terms of we're going to get to that, cash flow positive, EBITDA positive in 2021.
So I think as a pure ride-sharing play, so look, Uber just, their driving segment just posted an EBITDA profit. I'm concerned about Uber Eats long-term because they have this kind of scorched earth policy where they're just going to blanket entire neighborhoods serving every single restaurant. The Grubhub CEO posted a very honest letter to shareholders last week. They have a very different strategy, although they are adopting Uber Eats as well, just to be able to compare Postmates, DoorDash as well. Grubhub likes to form partnerships, for instance, with Shake Shack, and that's hurting their own earnings today. But long-term, I think that's a much more viable strategy than having drivers commit 30 minutes of their time to serving one person, delivering food back and forth. I don't see this I don't see the path to profitability in Uber Eats.
And you bring up an issue that we had a guest on last week, Andy, who pointed out with Lyft, they had changed their perception that it used to be that Uber, being so wide and so large with different kinds of rideshare delivery, was the way to go. They now think it's concentrate on just rideshare. That said, what we showed the graphic earlier, but the monthly active users was 103 million. The street was expecting more than that, and a big loss. Part of that was because Uber Eats, people weren't using just quite as much as people were expecting. So if you're about to buy this stock, aren't you setting yourself up for some headwinds, not only with Uber Eats, but the rideshare space? They're not going to be able in the next year or two to raise prices because they're in a competition with Lyft.
Yeah, and I think it's a question of what are you buying? You're buying a company that's got two different paths that they're going on, the delivery versus the rideshare, and the delivery is killing them. I mean, they lost, I think, $1.3 billion, right? So, I mean, I don't know how you value that. To me, this is symptomatic of a lot of the tech shares that have IPO'd. Money has flowed to these companies in all technology, really, because of how low interest rates are, and we're going to continue to see that. But specifically with Uber and the competition with Lyft, they have to figure out what their game plan is, what their model is going forward, because clearly the competition in the Eats space is killing them. So I don't see a green light on this company until they really sort that out. I don't care what their guidance is. They can say whatever they want. A lot of times, tech companies you're just kind of doing that and hoping. So they'll get punished brutally if they don't hit these targets down the road.
I'm also really curious, again, as our sort of Midwest representative, right? We see a lot of the gig economy here in New York City because there's a lot of Uber and Lyfts around. There are a lot of deliveries going on, more so, I would imagine, than in other places in the United States. The whole promise of the gig economy, right, that was so hyped several years ago.
Right.
We're sort of seeing it play out, and maybe it's not all it was cracked up to be.
Well, I mean, there's that, right? And so there was a lot of hype about that, obviously a lot of hype with technology. But what I think people don't understand with technology is it actually does the opposite. Every tech company out there is trying to disrupt the business, right? That's their goal. And if you do that, that means you're disintermediating current companies, not only from their clients, but also their brands. And so you're making that area so much more efficient, and eventually you're going to lose jobs because they're more efficient.
In 20 seconds, is there an opportunity right now with Uber, with this stock trading down?
I'd like to see how this fares after the lockup ends. I mean, it just reminds me of 2000, all the tech stocks that went crazy, and it was great, but they had such a small amount of stocks initially issued for those tech companies, but when you got through the lockup, they crashed. So I'm not saying that's going to happen with Uber, but I'm just saying, you might want to wait.
All right. With that advice, Shake Shack is under pressure after a same-store sales miss last quarter. Inez Ferre, finally on the floor of the New York Stock Exchange. I'm throwing to you, Inez. What are we doing?
Yeah, Adam. Well, Shake Shack is down about 20% today, and that's because of that same-store sales miss last quarter. And also, the company lowered its guidance for same-store sales by about 0.5%. And some Wall Street analysts are weighing in, forecasting that the fourth quarter may be worse for Shake Shack as they move towards that single relationship with Grubhub. Also, we're watching Groupon this morning. Groupon under pressure. This is after missing on revenue and earnings. Their CEO said that they face some challenges with traffic and with international macroeconomic conditions. And then we're watching Peloton. Peloton is a bit under pressure. This is after they reported their quarterly results. This is the first time that they report their quarterly results since the company has gone public. Their revenue came in above estimates. In fact, their revenue doubled from last year. The net loss came in at $49.8 million. That's almost a $5 million improvement from last year. And also a key metric for them, their average monthly workouts, that was up. Now, the stock has moved around quite a lot today. It was under pressure in pre-market right after they announced their quarterly results. It was up in pre-market. Right now, it's under pressure.
Thanks, Inez. Let's talk more about Peloton now. The president of the company, William Lynch, spoke on Yahoo Finance's The First Trade this morning. Brian Sozzi asked him what he would say to investors about that wider than expected loss in the company's report.
What investors can take a lot of comfort in is the closing losses with the growth. And anybody who's examining our business model can see that ends in a very good place. We've got one of the most exciting business models I've seen in my almost 3 decades of working in consumer. What we'd say is examine the business model, look at the closing losses, look at the top line growth, and they should be excited. We are.
All right, let's talk to the panel about this. It seemed like the street maybe was initially excited and then not, because the shares have been bouncing around a little bit. Now they're down. Yeah. Jared, what do you make of the Peloton and how it fits into this whole universe of growthy, money-losing companies?
Well, it's growthy, money-losing.
That's going to trademark that.
It's a big category right now.
Well, they got to find that path to profitability. I think they're taking that hit because of the concern over their expenses. They're building a brand new New York showroom. They're trying to increase their instructors. They want to build showrooms around the U.S. So, they're building a New York headquarters here with a big studio. So they have a lot of capital outlays, and maybe the growth just isn't there. I think a couple of the growth metrics were just kind of flat quarter to quarter.
Is the growth for them, though, going to be, I'm going to ask, what truly are they? Are they a Wi-Fi workout, or are they a bike manufacturer? Because they spent almost $50 million. At least they're not real estate. Not real estate, yeah, go WeWork. They spent almost $50 million to acquire the company in Taiwan that makes their bikes. Yeah. And yet I can go get a cheap bike at Sears before they go out of business for like $20.
Yeah, it's not a hardware company, clearly.
But that's what they just spent $50 million to buy the bike maker.
Yeah, I think we're seeing a theme here. It's like, what do you want to be when you grow up? And I'll have to dive into what their CEO said about their model. But, to me, when you look at companies, as soon as they start getting away from their central business, and it seemed to me that was their video model, having people join in, that seems like really scalable to me. The physical component of what they're doing is much more challenging. And if, it's the combination of tech with manufacturing, which works out great, but if you have experience in both places. So I'm not quite sure how big their losses or where they were generated from, but if it's on the manufacturing side where they're buying bikes and bringing them in, then you know what the problem is.
On the flip side of that, though, they now control that cost and the issue of the bikes. They don't suffer some kind of shock in the coming quarters. But to the bigger point, what are they?
Yeah. Existential question. Am I supposed to answer that?
Yes.
I think they're a tech company, want to be, combined with the manufacturing element. Apple obviously knows how to do it, but how many companies are going to be Apple?
They're a connected fitness company. That's what I think of.
Maybe they should get into wearables too.
Can't you just go to Equinox or New York Sports Club and get on a cheap bike and take a class?
Well, clearly they're doing something right.
You do it in your home.
I mean, clearly they're doing something right. They've got the right concept as far as the videos go, and I think that's great, and that's where you can connect up a lot of people. I don't know what their strategy is for advertising on those things is, but that would be interesting to me to find out a little bit more about that. How can they monetize what they have? Can they build that out somehow? Because that would be an interesting model to me. I'd want to know more about that.
They're a connected fitness company. We are a connected financial platform. Let's talk about that. Coming up, why one high-ranking UK official is accusing Prime Minister Boris Johnson of making a secret deal with the White House. Plus, we are 1 week away from the launch of Disney Plus. How the Magic Kingdom can compete with the likes of Netflix and Amazon straight ahead.
Got some stocks moving from YahooFinance.com, our trending tickers for you. Let's start with Adobe, the big graphics software company, coming out with a forecast for next year. It's fiscal 2020 that's above estimates. It's recurring revenue in particular of $1.55 billion. That's the forecast for next year, is above what analysts had been anticipating. It's become more and more reliant on subscription revenue. Let's look at Chesapeake Energy as well, because it is having a dismal day. It's really been having a rough ride of it for the last few months. The company posted a wider than estimated loss and perhaps most importantly said it may not be able to continue as a quote unquote going concern. That means it might have to file for bankruptcy, might run out of money if low oil and gas prices persist. It has a lot of debt from building out things during the fracking boom. And then we're looking at Myriad Genetics. This stock has been all over the map this year. In today's session, it is down some 40%. It's a molecular diagnostics company, but a lot of its tests have not been selling well. The company posted adjusted earnings per share of 8 cents. 31 cents is what analysts had been anticipating, and revenue fell by some 8%. So those are just some of the movers we're watching right now. We'll be right back.
So the Dow and NASDAQ notch another record high as bond yields surge for the third straight day. Yahoo Finance's Jared Blickery is at the Wi-Fi Interactive touchscreen with what's moving these markets. Jared?
We got bonds moving today. Stocks kind of taking a breather, although, as you said, the Dow did hit a new high today, as did the NASDAQ. It's up 32 points. S&P 500 is down about 5 basis points. Here's today's intraday price action. Really not a lot of movement, just over 10 points from up to down. We did get a little bit of spike on that ISM services report, which was subsequently reversed on no particular news here, but in the big picture, really not moving that much. 10-year T-note yield, this is up 8 basis points again. Now it's above, it crossed above the $1.80 level here, heading to $1.90 or 1.90, and that's a pretty significant move. If we look at what's happened over the last year, we're going to see this trend line, which has been in place. You're going to have to forgive me, as this is not going to be precisely to scale, but it is just peaking above that today. And I'd say if we go above 1.9%, that is going to be a definitive reversal of this trend, and this has a lot of implications for other stocks. Now, this is our leaders, the canaries that I look at. Retail is up the most today. This is XRT retail, but also the transports have been doing well, the KBW regional bank index, and especially value. All this is correlated with these rising bond yields. So we're going to have to deal with that and take that into consideration as we figure out what to do with our investments. Now, this is going to be the Dow Jones Industrial Heat Map, and not a lot of movement in a lot of stocks. We can see Apple down just barely while Microsoft, or Apple up, and while Microsoft is just down. Financials doing well. JP Morgan at another record high, up 1.11%. If we look at the year to date, it is up 33.5%. Boeing making a nice move to the upside, up 2%. And we can see it's been in this kind of sideways trend channel for much of the year, and it's right in the middle of it. Have to see what comes of this as news comes out about the 737 MAX. And then McDonald's coming off of that big CEO shakeup yesterday, still up 7% for the year, but down off of its highs here. And I have to figure out what it's going to do next with its executive situation. Coca-Cola also down about 2%. Guys?
All right, thanks, Jared. Let's get to the global rally in fixed income markets that's resulted in near record low yields on treasuries in the U.S. and, of course, negative yields elsewhere. With global central bank easing, is it time for investors to rethink their bond investment strategy? With us now to discuss is Bill Amity, State Street head of Spider Fixed Income Group. We have seen some big flows into bond ETFs this year, Bill. Thank you for being here. 8% ahead of 2017's record-setting pace. When are we going to need to see a reset of what's going on in the bond market, or are we? Is there sort of a coming reckoning?
Well, thank you for having me, first of all. If we think about what's going on in the fixed income ETF market, we have seen great flows this year. Although the overall bond market, if you think about global debt, is around $100 trillion. So fixed income ETFs are still a relatively small part, less than 1%. In the US, it's about $800 billion in AUM and $1 trillion globally. So in terms of where the growth is, there's still ample room for growth within fixed income ETFs.
What risk does an investor face if they were to chase this into a bond ETF, for instance? Could there potentially be paying, for that ETF, depending on the underlying assets within it, that might be more than if they were to just do this alone and go a traditional route with a bond purchase?
Well, I think what's interesting about the fixed income ETFs is they're really kind of giving you broad-based exposure for different asset classes rather than, say, buying an individual bond where you're exposed to really single company risk or single country risk per se. So what the ETF has done, fixed income ETFs, have really allowed you to invest in high yield, investment grade, mortgage-backed securities, and really diversify some of that risk.
Well, let me ask you, because I was just talking about the 10-year T-note yield kind of crossing above this threshold, maybe breaking out of this negative trend that we've seen over the last year. Does that change the dynamics? So if yields are going up, bond prices may be going down, how does an investor play that if, in fact, this is playing out?
That's a great question. And so we really talk to investors about being very mindful of where you're investing on the yield curve. If you look at the yield curve now, it's almost like a hockey stick, if you will. Going out to 5 years, relatively flat, some kinks there, and then it gets steep. So we're really talking to investors about being mindful of that yield per duration ratio, right? Do you need to go out 4 or 5 years to get that same level of yield and be exposed to that interest rate risk? So
I was just going to ask, it's a great point. And I was just wondering, is there a breakdown between institutional investors and retail investors on the use of the ETFs in the bond space? Because it seems like that would be really interesting to me to see what the take-up is, especially on the institutional side.
Yes, there is. And what we've seen, some of the statistics are hard to see, but generally about 40% of our investor base is institutional, 60% more retail. But if you look at some of the institutions that are investing, for example, insurance companies, right? There's been some regulatory changes with insurance companies that are more friendly for fixed income ETF investing. And if you look at 2018, from a trading perspective, insurance companies traded about $16 billion worth of fixed income ETFs in 2018. And while that number in and of itself is not all that staggering, what we did see in the first 6 months of 2019, they traded the same amount, $16 billion.
One of the benefits people always talk about with an ETF is the liquidity issue. But in what we're witnessing, what Jared was just describing coming into all of this with bonds, if there's not someone on the other end who wishes to purchase at the price at which you entered, you're in trouble. And so are we seeing some kind of maybe squeeze potentially, especially as yields are going up on bonds?
Well, that's a fair question. And I think what's really important is to understand kind of the investment risk versus a product risk, right? So ETFs as a product, we want to make sure that they're able to handle kind of the ups and downs and volatility in the market. And that's what we're seeing. There is always a buyer at some price, right? Someone will step into the market. And when we look back over periods of time in different bouts of volatility, I think December of 2018 was a really interesting time in the fixed income markets. We saw a lot of redemptions from our funds, a lot of people moving out of fixed income, particularly high yield and loans. But really what we want to make sure is that ETF, that the structure is working, is managed well, and that's what we saw. So, we want to be sure to, again, separate the investment risk from the product risk, if you will.
Yeah. Sounds good to me.
Well, I guess the bigger question is, okay, so now we've just had extreme lows, right? And you kind of talked about it a little bit for interest rates, but I think that's the question that a lot of people can't get comfortable with just yet. And I think there's a lot of investors that have cash sitting on the sidelines that can prove this out, including Warren Buffett. But when it comes to these, people just don't like buying like the 10-year below 2%. They feel like it's too low. I mean, what do you tell investors when they bring that story to you?
Well, again, I mean, when you look at something like a 10-year bond, you have a lot of duration risk there. So we talk to investors about being on the shorter end of the curve. You mentioned cash. I mean, cash has now become a very investable asset class, if you will, and given the flatness of the yield curve. So what we're seeing now in terms of fixed income ETFs is a lot of products, and even asset managers who are getting into the ETF space are really entering into this shorter duration kind of cash alternative type of market. And that's where new fixed income ETFs are coming to market. It's a very popular place. It's a great area for investors. Rather than just putting money in a bank account, they're able to get extra yield from some of these products.
All right, Bill, thanks for being here. Bill Amity is State Street head of Spider Fixed Income Group. Thank you.
Thank you.
And we will be right back after this. All right, 11:32 here in New York City. We're about 2 hours into the trading day. Take a look at what's happening with stocks. Bit of a mixed picture. Dow is trading higher, S&P 500 still slightly negative. NASDAQ has gone positive once again. Oil, by the way, was trading higher this morning, and it continues to trade higher at $57.20 a barrel. Boeing fallout. CEO Dennis Muilenburg offers to forego millions in bonuses amid the 737 MAX 8 scandal. A+ for earnings, what you need to know ahead of Disney's final quarterly report before the launch of its streaming service. And a message from the final frontier. The Voyager 2 probe sends back its first data report since entering interstellar space. And what's the famous line? Nobody can hear you scream, but you can hear Voyager. Welcome to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. It's famous for Adam because most of us know it from you saying it. All right, let's get to our London bureau to find out what's making headlines there. Joining us, Yahoo Finance's Tom Belger. Tom, we're looking at Royal Dutch Shell today, which is pressing forward on renewable energy with a wind acquisition.
Hi, Julie. That's right. Shell snapping up the French renewable energy developer Eolfi, which is piloting floating wind turbines off the northwest coast of France. Shell shares are up. It's a bit of a statement of intent from them. We don't know how much they paid, but most of their money's in oil and gas, and this is a sign they're really trying to get into the electricity market to get a bigger share of that pie. Eolfi even is mainly focused on solar and wind. It's trying to break new ground with floating turbines because at the moment a lot of the sea is currently off limits to fixed turbines because it's simply too deep. Shell is expected to invest $2 to $3 billion a year up to 2025 in electricity. And it seems like a lot of other firms are making similar bets on the offshore wind industry, with estimates out this week that it could be, the investment could total $1 trillion by 2040. That's according to the International Energy Agency.
All right, let's talk about politics. Labor leader Jeremy Corbyn is accusing Boris Johnson of making a secret deal with Donald Trump. What is this all about?
Indeed, a vote for Johnson is a vote to betray our National Health Service and sell out to Trump. That's the message Corbyn was pushing on the election campaign trail today. Crude, yes, but there is a kernel of truth there, with a Channel 4 investigation revealing this week US and UK officials have already met to discuss potential drug pricing in a future trade deal between the UK and the US. And that has sparked something of a political backlash already. With it's well known the fact that the US government and US companies do want the UK to pay more for drugs. So if the UK were to give in and the already cash-strapped NHS were forced to fork out more, Research for Dispatches, the Channel 4 investigations programme, suggests that could cost £27 billion extra. And for the government, they're insisting on their side that it's not for sale, the NHS, and never will be. They say prices won't go up. That's what we heard in a statement from the Department for International Trade. But frankly, Johnson himself may need a pill for the political headache. He's been trying to fight this election on Labour's natural terrain of the NHS, and he needs to leapfrog the party and its traditional lead on the subject on this much-loved British institution if he wants to win the election.
All right. We will keep an eye on that with you as our frontline eyes. But right now, Disney is scheduled to release earnings after the bell on Thursday. The company is riding a wave of highs as the stock recently hit a record, just over $147 a share, while its streaming platform Disney Plus goes live next week. Joining us now with more is Bernie McTernan, Rosenblatt Securities Vice President. And how important is it that Disney hit this out of the ballpark from the start, or is there time for them to grow it?
Yeah, for Disney Plus, we actually have quite bullish expectations from the beginning. We think the service will ramp very quickly. Of our $170 price target, about $60 of that is based on the direct-to-consumer businesses, so Disney Plus, Hulu, and ESPN Plus.
We don't talk that much about parks anymore because there's so much exciting news with the studios turning out these blockbusters, but that's kind of been a staple for them, just turning out wins for them on a quarterly basis year after year. How important is that to their mix still?
So the parks is one of the big negatives on last quarter. The domestic attendance was actually down 3%, and that's because of some self-imposed restrictions they did with Star Wars Galaxy Edge launching in Disneyland. So they launched Star Wars Galaxy Edge in Disney World this quarter. We still have relatively low expectations for how attendance will ramp, but we're quite bullish on 2020. We actually visited the park, Star Wars Galaxy Edge in Disneyland in May, and it's quite the sight to be seen. So we think there will be the return there over the medium term.
So if they pick up with parks attendance, if they sort all of that out, then what remains the biggest risk for Disney? I mean, they still perhaps have some ESPN issues they need to sort out too.
Exactly, it's the media network. So subscribers were down 2.5% last quarter. We think they're going to be down 3% this quarter. But that's the reason why they're pivoting to Disney Plus and potentially accelerating cord cutting for the industry by putting out this great SVOD service.
So that's their hedge, in other words.
Exactly.
Where they're slowing media business, they're looking to pick it up with Disney Plus.
Exactly, and that's why Disney's our top pick in the media space, because they have the content and the brands to be able to pivot. We look at someone like Fox, who actually sold all their content assets to Disney, and that's why we have a sell rating on that company.
Just quickly, what does the monetization arc look like for Disney Plus? Because with what they're charging, and they're also giving it away for free to a lot of people, I mean, are they going to make a lot of money on it in the short term?
Yeah, in the short term, it's going to be certainly headwind to estimates, but those are included now. The price is going to be $6.99, and losses are going to peak in the 22 to 24, and then 20 to 22, and then it's going to be break even as the guide for 2024, and then we think it should ramp nicely from there.
What are their subscriber estimates? Because I think that's key. I mean, if they're saying 2022 they're going to be or they'll get through the worst part of it, what are they telling the market? Like, what do they expect? I mean, I know this is what we watch with Netflix all the time, like other users going up or down or whatever. So it'd be interesting. I think there's maybe two tracks. Is if they come out with a lower number, then maybe the stock gets a hit right away. But if they come out with a lower number, then they can beat it down the road every year that they go on. So what are your thoughts there?
Yeah, so the guide is for 60 to 90 million subscribers globally by 2024. We estimate it's going to be 10 million subscribers by the end of the first year, and then 24 million subscribers at the end of the second year. Mm-hmm. And the reason why we think the service can ramp so quickly is because it's brands and IP that people are used to dealing with. If you tell people that, hey, we're launching with a Star Wars show, they know what to expect. That's different with Apple TV Plus with a show like C and the Dickinson and the Morning Show. Customers aren't used to engaging with those brands and properties, which is why we think there's a much slower ramp there.
You also talked about the fact that they're still cleaning up the acquisition from the Fox Studios, and they'll deal with that. And they've got blockbuster movies that are still coming out. We're going to get the new Star Wars. We've got new animated films coming. Is there acquisition in their future, or are they now all pieces in play? Because eventually we're going to see, won't we, ABC and ESPN, more streaming options without perhaps jeopardizing the contracts they have with the cable carriers. So do they need to get anything else in here?
Yeah, certainly at this point they seem strategically complete. They have a war chest of content to go out and try to grab customers. So we wouldn't look to them to do anything, but never say never. People didn't see the Pixar acquisition coming. They didn't see Lucasfilm coming. Didn't see Fox coming necessarily either. No one knew that Rupert was a seller. But at least for the next few years, we think a M&A event is low likelihood.
All right. Bernie, thank you very much. And we're going to be watching Disney after the bell on Thursday.
Great. Thanks for having me.
Yes, we will. All right, coming up, why hysteria over Popeye's chicken sandwich turned deadly in Maryland. Plus, countdown to 2020, how U.S. presidential candidates are addressing economic issues in agriculture and rural America. That's next.
Not careful, we're planting the seeds of Well, 2020 Democratic candidates are sharing their plans to address social and economic issues in rural America in particular. And a recent note, our panelist here, Andy Bush, highlights the policies put forward by the 5 top polling candidates, Biden, Sanders, Warren, Harris, and Buttigieg. So, Andy, in your note, you look at the various policies that they put forth and their relevance to the agricultural economy. One of the things that you notice is the sort of climate change priorities of the various candidates and how it relates to agriculture.
Yeah, and I think that's, if you step back even from agriculture, this is so embedded in all of their plans. Environmental issues are first and foremost. Just as an example of the 5 Democrat candidates, none of them, with the exception of one, has a button on their website that says jobs in the economy. And that person is Bernie Sanders. So I think that says a lot about what their focus is, and I totally understand that's where they're coming from for the Democrat base. In particular, it's wild to go through all of their plans and how deep they are for agriculture because of why?
Because of Iowa, right? And so, I mean, I think Kamala Harris said that she's living there now. But that just gives you an example of where they're going. And you're right. There's so many of the plans that are reaching deep into the agriculture sector to change environmental practices. There's a lot of big farm versus little farm dynamics that they're trying to play out and elevate the smaller farms. But I think the risk is anytime you start throwing regulation and heavy duty regulation and intervention in a sector, you're going to get unintended consequences like hurting the farming sector.
Let's talk about some of the positions. Elizabeth Warren, she wants to get the government more involved in the grain markets because it's worked out so well with dairy, right?
Yeah, and so that's another thing. Like, she has a whole program for price supports that's very different from how we operate right now. And that's the challenge with all of these candidates is how deep a reach they put into the business sector, into a sector overall. But with agriculture especially, I think you get into price supports, you get into all sorts of behaviors that will come from that. You know, if the price for the government is at one level and
you encourage overproduction.
Yeah, you certainly do. And so you actually get into the wrong policies. You can go back to the 1930s, which Warren talks about, but you can see a lot of the price support programs that were detrimental to actually helping the farming sector back then.
You talked about big farm, little farm. How do these policies affect these different scales, the different sizes of farms? Because are we simply going to give subsidies to the smaller farmers that the big farms take advantage of and just clean up on it?
Yeah, I mean, that's what Warren's trying to avoid. And I'm just going to stick with her mainly because she seems to be heavy duty focused on that. But I think that's it. And Sanders has it too, and Buttigieg, Kamala Harris really doesn't have a farm program as much. But they also focus, I mean, and first of all, let me just say that's a great point. So big farms may be able to try to take advantage of it. They will be targeted, so I'm not sure they're going to get there. But they also have a lot of great programs for the rural America, especially on telecom. And this is something that I think is
Wi-Fi.
really interesting.
Buttigieg wants to, 19 billion, is it?
Right.
It's not, or it's 19 million Americans in rural parts of the country have no internet connection.
Right, and I think that's a great point. The thing that I would say is the USDA is already doing things along those lines. So just
President Trump, it's one of his initiatives.
It's one of their pushing out there. So, and I think just the last point is really quickly, you run a farm now using technology, on your phone, on your app. So you need to have it out in those areas to actually be more efficient.
Just to take a step back for a minute, I know that Iowa is important, and so the candidates tend to speak to these issues. How many people work in farming in the United States? What percentage of the voting population?
You're asking for the farm payrolls, where we usually talk about.
Yeah, basically, yeah. Like why? Like
On
we
farm
talk
payroll.
about agriculture a lot, and I understand that it's important. We are a huge agricultural producing nation, but in terms of the economic and the personal effect of the agricultural economy.
Well, first of all, as far as employment goes, obviously it's tiny compared to non-farming. But I will tell you, it's super important for A, feeding the rest of the world and the United States, and B, they're our number one export. I mean, we export we used to, before the tariffs, about $150 billion a year. I mean, that's our top export. That's why the Chinese hit tariffs on that, because that's the thing that we do. So you can think that, yes, from an employment standpoint, it's not great as far as trying to help that area. Yet, if you want to still eat, it's probably a good idea to help farmers.
Sure. Well, if you want them to vote for you, that's another.
True.
That's
well,
another.
and of course, that's if you look at the Midwest, right? So let's go Ohio, Michigan, Indiana, Wisconsin, Iowa. You were talking about the big farm states.
Yeah.
You're talking about things that are central to them, that are important to them. A lot of those are the swing states, and those are the states that put Trump over the top in 2016.
Yep.
I'm going to leave you with this question for next time we talk to you. Why would those farmers in those states vote for a Democrat? But that's for the next time we're talking about it. Some of the biggest names in global finance are gathering today at the Greenwich Economic Forum, and Yahoo Finance's Julia LaRoche is there now. You had the chance to sit down with Gerald Parksey, Alan Patrikoff, and Steve Case. Tell us what they had to share with you.
Yeah, well, Adam, it was the revolution that's taking place in venture capital and private equity. And one of the big themes, Adam, is finding sources of talent, getting those sources of talent in places outside of Silicon Valley, outside of New York, outside of Massachusetts, and these other areas. And that led to a broader discussion about some of the fraying social fabric, particularly about the millennial generation. So take a listen to what Gerald Parksey from Aurora Capital had to say about that.
Well, one thing I'd say about concerns I have about the millennials. I think if we're not careful, we're planting the seeds of not just an angry generation, where people are angry. They're angry at the fact that there's such a wide gap between those that have made it and those that haven't. They're angry because if they don't qualify for financial aid in college and they can't afford it, they have to take out a loan. They're not quite sure. So we have to create or help create an environment where people are prepared for the jobs that are going to be available. But I also saw one other poll. Having been involved slightly in some of the political activities, I think I understand some polls. There was a poll of millennials that I was fascinated by because it said about 25% who were polled didn't have a friend. Didn't have a friend. So it's not just an angry generation, but it is an angry, potentially lonely generation that if we're not careful. So we, the generation above, the mentors for the next generation, have to be thinking about how our educational system can prepare young people for the jobs that are be available and have to create environments outside of these 2 or 3 city centers where they can earn a living, enjoy, raise a family. And this is a challenge that if we're not careful about, we are going to have a very disruptive both economy and social system here.
Yeah, Adam, it's a broader discussion taking place around capitalism and how to make it better, particularly stakeholder capitalism. And I'll also point out Jerry Parsky there. He was the youngest Assistant Secretary Treasury in history, serving during the Nixon administration at age 31. So just a fun fact and a broader conversation here about capitalism and fixing it. Back to you guys.
Julia, thank you. Coming up, Voyager sends data back from interstellar space as its 42-year-old journey takes it to infinity and beyond. Plus, before we go to break, take a look at some of the biggest winners in the Dow today. Police in Mexico say 9 U.S. citizens, members of the same family, and all Mormons were killed when members of a drug cartel shot up 3 cars, causing one of the cars to explode. 3 mothers and their children, 2 of them 4-month-old twins, were on their way to a wedding when their caravan was attacked. President Trump weighed in on Twitter saying the U.S. stands ready to help Mexico fight the drug cartel and clean out, quote, these monsters. Popeyes issued a statement this morning after a customer was stabbed to death at one of the chain's restaurants while waiting in line for the popular chain's chicken sandwich. Popeyes says, we do not yet know whether this was the result of a dispute over one of our products or something unrelated, but there is no reason for someone to lose their life on a Monday night in a parking lot. Boeing's new chairman says CEO Dennis Muilenburg will decline his pay bonus this year. Muilenburg received a $13 million bonus last year, as well as $7 million in stock awards. Boeing told all employees last week there will be no bonuses this year. NASA got a bonus from the 42-year-old Voyager spacecraft, which just sent data back to Earth from interstellar space. Voyager 1 ventured there in 2012. Voyager 2 followed in 2018. Both sampled the electrically charged hazes or plasmas that fill both interstellar space and the farthest reaches of our solar system. We'll be right back. Palabra de Calle. Okay, word on the street, where we check in with our panelists, and I'll keep my day job, and find out what stories they're watching. Jared, you're following the 10-year Treasury yield. Tell us about this.
Yeah, so I've been talking about this 1-year negative trend channel. It's been going down like this. Well, it just kind of broke to the upside today. I think we've seen a high of 1.87%. Could virtually clear 1.9%. At that point, I think we have a new trend in place to the upside on yields. Has a lot of implications for investments. 2 months ago, we started talking about this rotation from momentum into value. Well, there's a lot more to that. Value is still doing well as yields go up, but also retail stocks doing well. The transports, which had been lagging. The Russell 2000, which is small caps, because that is heavily weighted towards financials, and then financials themselves, including the regional banking index. So you look at all of these things, what's doing bad? Well, tech software and momentum names have taken the biggest hit. Now, you take a stock like Microsoft, it's still hovering near record highs, but a lot of companies like Adobe, Activision, Blizzard have kind of fallen off. Maybe they can find their footing, but I think it's clear that we have a different investment paradigm, provided that we do have this breakout in yields.
Yeah, and we kept talking about, was that momentum to value shift going to be sustained? At least for now,
so far.
It looks like it has been. However, you are looking at your models, Andy,
right,
and saying that overall equities are appealing right now, which kind of fits with money coming out of bonds.
Right, right. I think so. So in my models, like, the biggest factor is the Fed. I mean, this is probably the biggest factor in everybody's model. But more importantly, I think it's just really something that throughout the year we've had so much turbulence from the trade war, and yet S&P 500 hasn't been able to go down a whole lot, and it keeps bouncing back. Well, there's a reason for that, because the Fed flipped at the beginning of the year and began to let everybody know they were going to cut interest rates, which they did. But they also now have engaged in quantitative easing. They can call it whatever they want. I don't care. They're quantitative.
We were having this discussion in the commercial break.
Yeah,
Call it $360 billion over 6 months.
Exactly. Is their balance sheet going up? Yes, it is. Okay, it's quantitative easing. So with that in mind, and the markets love that. right? And that's what's driving so much of what we're seeing, I think, overall. As long as that continues to happen, it's really hard for equities to go down. They can go down. On the domestic policy side, yes, we're seeing some movement forward on the trade. So now we've got these two really important components of my model. The financial universe, sun, that's the center, that's the Federal Reserve, and then domestic policies like the Earth, it's a lot smaller, but they're both aligned, and that's really when you get the biggest moves, and that's what we're seeing.
Andy, thanks for being here. Appreciate
Yeah,
it on
great.
that note. Andy Bush, former CFTC market analyst. Appreciate your time. Jared Blickery, thank you as always. Just want to mention something that we have been watching, and that is Uber. Those shares are now at a record intraday low as their declines continue to accelerate over the course of this session. Coming up, it's election day. As America heads to the polls, we'll take a look at some of the key races from around the country. Plus, make sure to catch our coverage of the Las Vegas Traders Expo on Thursday, November 7th. Our own Melody Hom will host a live fireside chat with Rachel Zoe to kick off that opening ceremony November 7th right here at Yahoo Finance.
All right, 2 minutes after 12 in New York City, 2.5 hours into the trading day. Stocks a bit mixed here. The Dow is up, NASDAQ is up, but S&P 500, it's, barely flat, barely down 3 points. Taking a look at the 10-year Treasury yield, we're watching yields rise. Jared Blickery was just talking about this. 1.87% could possibly break 1.9. So we're keeping an eye on that. And here we go again. The U.S. and China reportedly consider rolling back some of the tariffs as the two sides look to finally make progress on the long-awaited phase one of the trade deal. Losses hit the gas. Uber shares slide after the company's third quarter earnings showed some bumps in the company's road to profitability. And Americans head to the polls today, the top issues voters face across the U.S. Welcome back to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thanks for being with us. Let's get to our top story today. It's U.S. and Chinese officials reportedly considering rolling back some tariffs to clinch a partial trade deal and end a trade war that has rattled global markets. Let's go back to Washington now. Yahoo Finance's Jessica Smith has the details on what might be unfolding here. Jess?
Well, the Trump administration has repeatedly said that it is very close to nailing down this phase one deal with China, but there are some details that still need to be worked out. And this morning, the Financial Times is reporting that China wants the U.S. to remove some existing tariffs in order to finalize that deal. It has been kind of expected that if this deal goes as planned, the U.S. might cancel the tariffs that are set to go into effect in December, but now it looks like China wants more. China reportedly wants the U.S. to remove the tariffs of 15% that went into effect on September 1st. The Financial Times also reports in exchange for that, the U.S. would want more from China, including more security on ag purchases, more protections for American IP, and a signing ceremony on U.S. soil. And the president has said that he would like that to be on U.S. soil. They were supposed to make that deal official at the APEC summit in Chile, but since that was canceled, they're looking for a new location. And some of the places that the Trump administration has been floating include Iowa, Alaska, and Hawaii. So we'll keep you updated as soon as we get any more details about where that might take place. Adam and Julie.
Thank you so much, Jess. Appreciate it. Let's bring in this hour's panel to discuss. Maslensky and Partners President Lee Carter and Yahoo Finance's Brian Chung are joining us. Lee, all of this back and forth on trade, right? I mean, the markets don't seem too impressed with today's headlines.
No, I think that the markets have pretty much assumed that something's going to be happening in the near term. I don't think they are expecting much, but I think they're expecting something. I think the big news will be if nothing happens come mid-November. But I think we're expecting to have some small movement, and that's what everybody's expecting. Right?
This is not a data issue or a detail issue. It's more of an image issue, and you're really good with messaging. Part of what President Trump wants is for Xi Jinping to come to the United States and maybe sign this phase one deal in Iowa.
Yeah.
What does that look like to Xi Jinping's people, the 1.3 billion Chinese? Would he even consider doing that?
I don't know. I mean, the idea that they're in continuous conversation, I'm wondering if they're not saying that we're going to do something for each of us, right? In some ways, I think they know what's most important. I'd be surprised if he came all the way to Iowa. I think that would be an optic that he's not willing to make, but it would be very important to the president. So I wonder if there's some kind of symbolic gesture that would happen in return. I can't see it happen.
Something interesting, though, is that Xi Jinping actually has a close tie to Iowa, though. So in the 80s, he actually spent 2 weeks in Iowa. He did like a homestay. So actually, he's visited Iowa before, I think it was 2 years ago or so. So he actually does have a close tie to Iowa. So
maybe he can go back to that house where he stayed.
Yeah. The optics of the leader of 1.3 billion people, the world's second largest economy, traveling as far to sign this deal. What does that say to? He's got to maintain some kind of authority and power, not only over the 82 million members of the Communist Party, but 1.3 billion Chinese.
I mean, you could argue that the optics are already not so great for China because it seems like the framing of now this urgency to try to roll back even more tariffs as part of this phase one deal is coming from China. So it shows that, if anything, maybe it's China that's saying, actually, we really need to have more concessions here because we're worried about our economy slowing, for example, right? The last reading of GDP growth in that country was 6%. Which is dramatically lower than it's been in previous quarters. So, I mean, you're talking about the optics. I feel like Xi Jinping coming to the United States is not as bad as the optics of China asking for more tariff rollbacks.
I mean, the way I look at it, though, is China, the one thing that China is really, really good at is symbolic storytelling, right? Everything means something to them, and much more than it even does here. Our president is really into image as well, but that is something that they do. Pomp, circumstance, ceremony is very, very important. So I think if they are going to make a compromise, are they going to make it to that extent? I'm not so sure. It would be very, very good for President Trump. I'm not so sure that it's something they'd be willing to do.
All right, we're watching what's happening with Boeing because Boeing CEO Dennis Muilenburg offered to forego all bonuses this year as the company continues to deal with the 737 MAX crisis. Inez Ferre is on the floor of the New York Stock Exchange. She's got more details with us. But we should point out, too, Boeing told every employee there would be no bonuses last week.
That's right. In late October, Boeing had sent an email to employees saying that they have decided not to give bonuses. Nevertheless, the stock right now is up more than 2%, really helping the Dow stay in the green. This is after Boeing's chairman said that CEO Dennis Muilenburg had called him over the weekend to offer to forego all of his bonuses for this year. Of course, that makes up the majority of his compensation, and his compensation is something that he was grilled about by lawmakers during those congressional hearings last week. We're also today watching Beyond Meat seeing a pop. This is after Bernstein upgraded Beyond Meat to outperform partly because of the probability that Beyond Meat may partner with McDonald's fully. You'll recall that Beyond Meat and McDonald's have a deal going on to test out Beyond Meat burgers in some select McDonald's in Canada right now. And also we're watching Adobe. Adobe is up today after the company raised its fiscal 2020 guidance. This was during an analyst meeting in which they gave revenue and earnings forecasts which were above what the street was expecting. Adam, Julie.
Thanks, Inez. Let's also talk Uber. It beat estimates on the top and bottom line in the third quarter, but the company reported over $1 billion in net losses. The shares are trading at a record low. Uber Eats was part of the issue there as well. Joining us on the phone now, Morningstar analyst Ali Mogharabi. Ali, thank you for joining us. Why be in the food delivery business at this point? I mean, we are now seeing Uber Eats. We saw Grubhub. Is it just, I mean, how do you make that business work?
Yeah, good question. It's actually, we think the business is being commoditized. However, there is an advantage that Uber has compared with some of the other players in that it is working off of the same platform that its ride-sharing business is working off of. On top of that, you've got a lot of the riders already on that platform. So Uber may have an easier time trying to cross-sell those two services. Getting some riders to also order some foods and or getting some diners that order foods to also request additional rides. So there could be some synergy which could actually help both of these services and or businesses operate more efficiently.
Or is there the possibility they've peaked? I mean, when you look at the monthly active users, whether it was for Eats and or the rideshare, it fell below. It was 103 million, and it was below what the street was expecting. Yet you're still optimistic that this stock is going to go higher. Why?
Well, because actually it wasn't that far low in our opinion. The monthly active paid consumers had 103 million, was not that bad. On top of that, the frequency of the trips. So if you take the total trips divided by the monthly active users, the frequency of the trips actually increased. So I think all of that basically shows that the network effect, competitive advantage that these guys have remains intact, which means that they continue to attract more users, which means that also it continues to attract more drivers and or deliverers. So as this continues, we think that the cost of acquisition of the user and or the cost of acquisition of the driver is going to decline, which means that some operating leverage could be forthcoming, let's say, 2-3 years down the road. And then after that, of course, profitability. We're expecting the company to become profitable in 2024. So we don't necessarily think that we're being too bullish on this company. We actually think that we're being pretty realistic. And from a valuation standpoint, we take that into account. Our valuation is based on a 10-year discounted cash flow model valuation. So we're still valuing it at $58 a share. Yes.
Hey, Brian Chung here. So on that point, I mean, you're talking about kind of the proper valuation, but I'm wondering that, even though you expect them to become profitable, it's still going to be, over 4 years from now. So based on this quarter's results, though, are you satisfied with the amount of cash burn that they've had so far? We know that this is a company that's going to make investments. We know on the bottom line, you do expect to see those, those negative numbers. So what are you seeing when you unpack the fact that they had $3.8 billion in revenue, but, $585 million of loss this quarter?
Yeah, I mean, we are seeing some indications of operating leverage. So there's some levers that are out there. So sales and marketing as a percentage of adjusted net revenue continue to go down. They're doing a pretty good job of cost control on the R&D side, even with the additional investments that they keep making in new businesses and or technology. And as I mentioned, that virtuous cycle that I described before, I think that's going to help them to further control the costs and actually lower the cost of sales and marketing. So you add that to the top line growth. We're thinking again that's going to create operating leverage and possibly actually make them profitable a few years down the road.
We'll be watching for it. Ali Mogharabi from Morningstar. Thank you.
It's election day, and it may not be 2020 yet, but voters in several states heading to the polls, and the outcome could lead to a major shift in power. For instance, Mississippi and Kentucky face key gubernatorial races, while in Virginia, people there will choose members of their state legislature. These elections, Lee, and you know this best, will this be a bellwether of what's going to happen in a year, or are we still too far out?
I think that it's not a bellwether for what's going to happen next year. Presidential elections feel different, they look different, they draw different people to the polls than these do, no matter how important these are. I think there's certain things that we should be looking at that are very important. I think Mississippi and Kentucky are different because these are states where Trump won by a landslide, won by 30 points, won by 18 points. We're talking about states where a majority of people oppose impeachment, much more so and very, very different than the rest of the country. So these are places where the president should have absolutely no problem winning. If these flip, I think that's something that everybody needs to take seriously. But I think we also need to look at these races and say there's reasons why they are different than they might see otherwise. I think when you look at Virginia, now you're looking at flipping the state there. Now this is really important because this is a state where you have a Democrat and governor, and now you've got Republican-led Senate and House. What's so interesting about this is if this were to flip Democrat, I think that we're looking at some issues that are very important to the American people, and they're saying it's more important for us to have all of those issues happen than we are to have balance. And so when you look at what's happening in Virginia, you're looking at issues that are on the ballot right now. You're looking at gun control. Because gun control can't get done, this is very, very important to that state. There was a mass shooting there in May, and this is the big issue for people in that state. And this could be a big flip for them. This is saying Virginia now is solidly on the left. If you've got the governor, you've got the House, you've got the Senate, everything changes. So I think we're looking at some big shifts, but I don't think this is going to be an indicator to say this is what's going to happen in 2020.
Interesting. So back to the all politics is local, I guess, adage. I want to bring up the conversation that we had yesterday with former White House Communications Director Anthony Scaramucci. He said anyone but Trump and Elizabeth Warren for 2020. That was his caveat. Listen in what he said.
You know, I could not support Elizabeth Warren. I would have to not vote in the election, frankly, because I'm ABT right now, anybody but Trump, except for Elizabeth Warren. So it's EW, except Warren. You know what I mean? Nothing that she's saying makes sense. And
what does she do to the markets if she's elected?
Well, I think she would have the markets.
So from today's election to sort of broaden it out to 2020, because there has been this near hysteria on the part of market participants, like leaving aside his anyone but Trump for a moment, about Elizabeth Warren and her supposed terrible effect on the markets.
Okay, so we heard the same thing. Let's not forget when Trump was going to be elected and everybody said if Trump goes in office, the markets are going to be over. And I remember being on, and I was like, this really, and now look at them. So I think that we've got to take the hysteria out of it. I think Elizabeth Warren is likely to be the Democrat candidate right now. Now, this is something a lot of people think I'm crazy for saying because we can go apart her policy by policy. But the issue is she is the only candidate on the left right now who's running a very, very strong campaign. She's the only candidate on the left right now who has a master narrative that we all know what her story is. We all know what she's about. She's the one that everybody's reacting to. I always say you can tell who's winning by the one that everybody's reacting to. It's usually the president we're reacting to and Elizabeth Warren. It's not anybody else. And so I think that the markets better get used to that idea and figure out what that means.
And I think on Lee's point here, it's really all about what helped Donald Trump get elected in 2016. And I think what we saw is that the popular vote was very close. There was a lot of swing voters in those Rust Belt states, in Michigan, in Wisconsin, in Pennsylvania, that he ended up winning. And he did that by having a really fired up level of rhetoric. So I think that when a lot of people do that autopsy on what happened in 2016 for the Democrats, they're saying Hillary Clinton just wasn't someone that could energize the base, that it wasn't necessarily the policies themselves. When you look at the Democratic candidates for 2020, you kind of wonder if Joe Biden has the energy that could compete with Trump in a debate on a debate stage. So you wonder if Warren would be that person. Again, we're still far away, but it seems like for right now, she might be one of the more fired up.
Threatening to take people's private health insurance away, that seems like a political no-winner.
It does seem like that when you take it at its face, if you start pulling apart the policy, but when you talk to American people, depending on the poll that you look at, it's either 6 in 10 or 7 in 10 Americans are looking at that and saying Medicare for all is the answer. Forgetting the details, forgetting everybody saying, how are we going to pay for it? American people find it wildly popular. She's got a policy out there. Everybody else is reacting to it. You know what? She's the one that's winning this debate right now. And healthcare, by the way, whether you look at most polls have the economy and healthcare neck and neck is the number one issue most important to Americans. The Republicans are going to lose on healthcare because now, even though it is Obamacare that we're talking about, it is now 4 years of Republicans that have failed to get anything done. So if she's got the policy and she's the one that everybody's reacting to, I think that she's the one that's going to be leading the race.
You're trying to apply logic to politics. All right, coming up, the Popeyes chicken sandwich craze turns deadly. The company responds after a man is killed at a store in Maryland. Plus, take a look at some of today's losers on Wall Street. Speaking of fast food, Shake Shack shares have been tumbling after its quarterly numbers. We've got some more trending tickers for you from YahooFinance.com. A lot of them companies out with earnings, Kroger among them. The company out with a bullish profit forecast for next year, looking for earnings of $2.30 to $2.40. Analysts on average have been looking for $2.19. The company also said its comparable sales should improve slightly next year. This stock and the company have been seeing a lot of competition, so a little bit of a relief here after what has been a struggle this year for those shares. We are also taking a look at Regeneron Pharmaceuticals today, the maker of the Eylea treatment for macular degeneration, seeing demand for that drug that helped its third quarter numbers beat estimates. It also announced a $1 billion buyback authorization. This chart not looking so pretty. It looks a lot better when you just look at the one day and see the pop in the shares of 10%. And then we got to go all the way down to the end of the list for Tapestry, that retail and clothing and shoe manufacturer. Those shares up almost 3% today. Earnings there beating estimates. Coach comparable sales up 1%. Kate Spade, though, plunging 16.8%, but that's actually a little bit of a smaller drop than had been estimated here. So those shares getting a lift. And if you're following today's trending tickers, make sure you're watching the ticker. It's right here at 2 p.m. on Yahoo Finance.
Okay, stocks are a bit choppy after a few nominal record highs, but bond yields still surging higher. Jared Blickery is back at the Wi-Fi Interactive touchscreen. It's kind of like an episode of Succession. You don't know who to like or hate here, do you?
You gotta love these bond yields. I'm just telling you, what's a movement here? We're gonna start with stocks. So Dow is up a whopping 12 points now, 4 basis points. S&P 500 just off a little bit. And over the last hour, we've sunk a little bit. We're testing session lows right now, but overall, a pretty small range day. It looks like 11 or 12 points, not really threatening the long-term picture here. And here's that 10-year T-note yield. You know, we took a look at the one-year chart before. We can do it again, and it's just kind of breaking that downtrend just today. And I think that has longer-term implications, but we need some confirmation. Probably needs to close above 1.9% or so. Want to take a look at the sectors that are involved here, because these are highly correlated with the move that we've seen upwards in bond rates. So today we're seeing staples and financials and consumer discretionary. So cyclicals and value are leading. If we look at over the last 3 months, we can see tech is the winner here. Tech has been the story over the last few years, but financials coming back. You know, you look at XLF. XLF is testing its high from 2018. We could see this on a 2-year basis here, already at a 2019 high, ready to break out and test those highs from 2007. And then we see, following financials, industrials up 10%. Guess what? Industrials, this is trading at a record high as of yesterday and again today. Nice to see that, because this has been kind of a forlorn or foregone sector. And then we have consumer discretionary up 6%, communication services, healthcare. You get the picture. To the downside, real estate, which had been one of the leaders, kind of taking a dive over the last few months, or at least not up as much as the others. Energy has surged recently, but over the last 3 months, only up 4.5%. So the dynamic in terms of what you're investing as we get this change in interest rate situation, really need to pay attention to what's been working here. Guys?
Yes, we will keep paying attention to that. And that reversal notwithstanding, of course, we still have central bank easing around the globe, and that directionally has been down. So investors and people just, you know, refinancing their mortgages need to pay attention to all of this. Our next guest says as interest rates go lower, investors need to rethink investment strategies. Joining us now, Dan Griffith, Director of Wealth Strategy at Huntington Private Bank. So Dan, obviously, Jared, watching the sort of shorter term in interest rates, but the trend this year has been broadly lower. What do investors need to prioritize?
I think a lot of investors are really concerned about this because, as we've talked about, and I'm sure broadly in the markets have talked about, lower interest rates generally drives people towards stocks. And I think a lot of folks are looking at that now to say, I'm not sure if I'm going to substitute my fixed income for jumping into stocks when they may be at a very high position. So a lot of our clients are saying, I don't know if this makes a lot of sense. And so fixed income right now is a bit of a mixed bag and something that's worth a broader discussion with clients about.
So you're coming here to us from Ohio.
Yes.
There's a great deal of old money tied up in places like Hunting Valley, the east side of Cleveland.
Yep.
How do you advise those clients who aren't going to get much of a return if they're locked into fixed income on what they should be doing to not only preserve the wealth that they've inherited, but to grow what they've got?
Well, I think fixed income there's still a place for fixed income in the investments that we have, and there's a place for it. Part of it's working with them to kind of manage expectations, to talk to them about, all right, what is this going to accomplish? What are your long-term goals? And as a consequence, what are you really looking to do with fixed income? And I think if you do that, it works really well. I worry a lot about those folks, but I also worry a lot about the regular retail investors who are walking in, the 85-year-old lady who's walking in to say, I want to redo a CD, and she's living off of that income. Low interest rates affect her too a lot, and obviously that's something that we deal with on a daily basis as well.
And please.
I was just going to say, I mean, it seems like there's a lot of concern with the R word, recession. Some are worried that because of the inverting yield curve, maybe people should be expecting something in the next 18 months or so. But it seems like even in Germany, where you might argue they already are in recession, you've still seen equities go up. I mean, an interesting stat is that the DAX in Germany has been up 12% in the last year compared to the S&P 500, which is only up 14%, not too much of a premium there. So should people, you know, they have a tendency to be risk averse, wanting to dip out of equities right now. Is that not the right move right now?
No, I think part of it is just getting a tolerance for where are we. I think it's funny that we've had such a long run of really good markets that a lot of our clients are saying it feels like we're in a recession, and we have to remind them that in fact we aren't really even close, that growth rates are even above 1%. And so as we talk to clients about that, it maybe changes their mind a little bit about whether they're willing to accept a little bit more risk one way or the other.
As I mentioned, though, it's not just about market investments. It's about sort of personal assets, right? It's about your home, it's about your car, it's about the debt that you personally are carrying, not buying bonds necessarily. What should people be doing with regard to those various things?
That's a great point too, because part of the discussion is about how much do I want to get, but also part of it is what does this money need to do for you? And so one of the things that we've talked to clients about is be careful that you don't get into some bad habits as you're in a position where interest rates are low. If you've got fixed income rates that are fixed, you're in good shape. But if you've got you're in a position where you've got a line of credit that may move up or down, you don't want to get used to spending a lot more money while that debt service is really low. And so we've talked to a lot of clients about things along those lines.
Of the clients you've got, I'm curious about refinancing. A house in Parma might cost you $35,000. A house in Cleveland Heights might cost you $350,000. What's the criteria that you would say to these folks as to it makes sense to refinance or not?
Well, I think looking at their debt overall to say, what is your debt? Is it debt that's going to be deductible from a tax perspective? Is it debt that you're going to have the income to service because you're maybe retiring, along those lines? Those are all things that we look at to say, let's look at this and create a schedule to accomplish that.
So you say people are worried about where they put their money. Does it feel right now that they're more worried than they have been? I look at consumer confidence, and I'm always interested in how people are feeling about the economy going into the election. Does it feel different right now, like they're more worried than they have been?
You know, it's funny. We get to work in the Wealth Strategy Group at Huntington Private Bank. We get to work with a lot of business owners. And we ask business owners, how are you feeling about your business? Because it's something that helps inform us about the process. And we will have conversations with them where they say, we've had the best year we've ever had, which has followed the 3 years that are best we've ever had. And then 30 seconds later, they'll say, but we're really worried about the market. So I think there is kind of a kind of joie de vivre around the economy right now that says that's just a little bit different, you know?
You ever see that huge lobby at the original Huntington Bank
building?
Oh,
yes,
in Cleveland?
absolutely.
It's the second largest bank lobby in the world. It was at one point.
It's a great one, a lovely restaurant now. That's right.
Dan
Gotta go visit.
of Huntington Private Bank, thank you for being here.
Thank you for having me.
It.
All right, coming up, Fighting for Diversity in Hollywood, we're going to speak to the president of Howard University about the university's new partnership with Amazon Studios. Take a look at some of today's most actively traded stocks by volume.
Just after 12:30 p.m. here in New York City, about 3 hours into the trading day, stocks are mixed. They remain that way. All three major averages, though, are hovering near record highs. Shake Shack gets burned. Shares slide after the company's same-store sales growth disappoints. Striving for diversity. We'll speak to the president of Howard University as the school teams with Amazon Studios to bring change to the film industry. And while his reality is life in prison, El Chapo's wife has other plans. The details on her possible reality show participation ahead. Welcome back to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. Good to have you here. From being held in contempt of court to being called the worst Secretary of Education ever, Betsy DeVos has had one rough year in Washington. Yahoo Finance's Arti Swaminathan joins us now to break this all down. And it's almost as if, though, she had fallen off the news cycle headlines. So what's been going on?
Has she fallen off the news cycle headline? In my world, she comes up every single day. And this year, she has had such a terrible year. I mean, firstly, the politicization of higher education issues, right? Every candidate is coming out and saying, you know, she's not doing a good job, student loans are a mess. But then, I don't know if you've heard about this case where she was held in contempt of court in California, where, you know, the Department of Education is trying to garnish wages from students who were defrauded. So there is a whole list of complaints, and I kind of brought it down to 4 things, which is sort of like involving student loans and for profits. But the more consumer advocates that I speak to, they're all just like, how is Congress letting this go by? And it's really interesting.
Are we hearing any members of Congress speak out about what she's doing, or is it mostly on the education activism side?
It's interesting because not just Congress, Democratic Congress, men and women, but also Republicans. So I don't know if you've heard of this guy who was the former COO of the FSA. He quit, lifelong Republican who quit and said the student loan system is broken, right? So if you have someone within the administration who understands that this is a problem, I think it's just going to be a matter of time before we find someone who actually has a good fix for this.
I think it's fascinating, though, that locally education is so important. Mm-hmm. When you look at this position, it should be so important because people say they care about education. You look at Bernie Sanders talking about free education for everybody, and yet she's there, she's hated, and no one's really coming up with a huge plan on how to fix the education system or a topic of conversation. How do you think that, you know, what does she do in this position? Do we need somebody new, or?
I don't think that, so that's a question I asked one person on consumer advocacy group. How come Trump is not reacting to this? Why was she being criticized so much? And he says that the silence is more noticeable, right? He hasn't said anything against her, which means, you know, is he okay with what she's doing? I don't even think they think there's a problem in some ways.
Didn't the Department of Education go after delinquent loans and these kinds of issues prior to the Trump administration, or is this all new?
Prior to the Trump administration, during the Obama administration,
yeah.
they went after a whole lot of things. They went after for-profits. If you are defrauding your students, you know, and then the school closes down, you get your loans refunded.
But did they go after the students, though, who garnishing the wages, as you pointed out at the beginning? Now they're doing that. Is that something new?
I think that no, the Department of Education, to be clear, is not going after the students. They're just siding with the loan services, with the for-profits, which is just something that is new because the whole agency is being stacked with for-profit insiders, according to some people. And obviously the legislation that they have come up with is seen to be sort of in their favor, which is why all these people are up in arms and shocked.
All right, let's talk about another area of education. You're going to stick around, RC, because the push for diversity in the entertainment industry is getting a big bump from Amazon, the tech giant partnering with Howard University to launch Howard Entertainment. It's a 2-semester program in Los Angeles where students of color will learn the ins and outs of media while gaining hands-on experience from top industry professionals. Howard University's president, Dr. Wayne Frederick, is joining us now to talk about this partnership and this launch. Thank you so much for being here, Dr. Frederick. So where did this idea come from? Because as far as we know, this is the only program of its kind.
So we have been looking at our workforce development opportunities through a slightly different lens. Rather than the regular internship model, especially for underrepresented and low-income students, that model, especially with unpaid internships and so on, is difficult, as well as the progression to matriculation isn't there. So we started with a program in the tech industry called Howard West with Google, in which our students were co-taught by Google engineers and Howard faculty. And so this Howard Entertainment is a progression of that philosophy on workforce development that I think gives some type of assistance to students who are underrepresented in industries that need diversification, but at the same time propels the students by allowing them to continue to gain credit, get stipends for internships, and also get contemporary experience by industry professionals.
Has it been, in your experience, has it been a lot harder for recent graduates to find employment? I mean, I saw a recent data point that said that, recent graduates are actually, unemployment rate for recent graduates are actually increasing as compared to the rest of the labor force. I mean, is this something you're seeing, and what do your students say?
So our students are getting placed in jobs, but again, especially with low-income students and underrepresented minorities, they don't always have the flexibility to get into some of the areas that are not as diversified. So whether it's Silicon Valley or even in the entertainment industry, because they don't have the same exposure, opportunities, and their risk aversion is also significant. Howard University has had a significant legacy of placing individuals from our school in front of the camera. We've placed a few behind the camera, like Bradford Young, and certainly Debbie Allen in director roles, Felicia Rashad. But what we are looking at is that there are thousands of jobs in that industry, and a lot of times students are just unaware of those jobs. So getting students from a wide variety of fields to get out there and to try to participate in that wider job market is a big goal of this whole program.
I love this story because it's one of those things where you're looking at businesses who are trying to solve challenges that society is seeing right now. And we know that that's really popular. I think 8 in 10 Americans say that they're more likely to do business with a company that they feel is doing good things for the community. And so this is a great thing for Amazon. It's obviously a great thing for you. Are there other companies or other industries that you're having conversations with that you could see a similar kind of program where we're trying to get more education to more folks?
Yeah, absolutely. We've done it with the tech industry. We are obviously doing it with entertainment now. We have been working with a couple of financial companies. And again, I think what's key here is that especially with so much evolving in education so rapidly, having the students co-taught by industry leaders as well as the faculty, you have two advantages. One is that the students get a more contemporary preparation for participation in the job market. But the secondary impact, which I think is just as critical, is that the faculty also get an exposure to that contemporary experience as well, so that they can come back and disrupt the curriculum and really make sure that they're giving students an opportunity. So we had a mini project that we did with a financial service industry leader, in which we sent a faculty member out to look at what they do around their interns. The second summer, we send 2 faculty members, and next year we'll send the faculty members along with the interns. So they get a chance to look at what their curriculum looks like, what their courses look like, and then they look at the experience of the student and see if it's really a good match, so that by the time they graduate, that those companies can feel very comfortable that this student is as prepared as anyone that they would have working there for a year or 2, and therefore they spend less money on the front end getting our graduates ready for the work experience that they are looking for.
Dr. Frederick, thank you for being here. Hope you'll come back. Howard University President Dr. Wayne Frederick.
Thank you.
Coming up, from food trucks to Wi-Fi, the Trump administration reportedly considering bringing big changes to our national parks in an effort to attract more visitors. Plus, take a look at some of today's winners on Wall Street. We've got Chegg, the textbook company. It's on the rise.
The world is going green, from recycling and power generation to the cleaning supply industry, with many brands touting alternatives to traditional cleaners that are eco-friendly. One such name in the category is Lemishine, maker of Better For You cleaning products. Its CEO, Curtis Eggemeyer, joins us now and give us an understanding of how much growth there has been in the kinds of products that don't have perhaps the chemicals that frighten us.
Yeah, so thanks for having me today. And this category is off on a tear right now with a typically static category that's been growing at single digit year over year. It's now growing at 30% in this safe, green, natural segment.
And, you know, it seems to me that there are some market leaders already. I think of Seventh Generation off the top of my head. So how much room, with that kind of growth, how much room do you think there are for a lot of different players to participate in that?
Yeah, you're actually seeing a lot of new players come to the market right now in this safe, green, natural. We've been around for about 12 years, and Lemishine is a powerful, safe, and affordable household cleaner. So we've got this differentiation as compared to not just being a natural, kind of better for the environment type cleaner, but a safer product for the millennial consumer, as well as all households across the U.S.
So your company's been around for 12 years, as you mentioned. It seems like a lot of people might go to the store if they want to buy a cleaner. They just go with whatever the cheapest option is or whatever the best smelling option might be. When it comes to especially your mission, right, in terms of kind of environmental cognizance there, how do you market the product to try to take market share away from the big players in the space?
Yeah, so we believe that there's not a reason that you shouldn't be buying the Lemishine line of products. The biggest thing is that our core belief as a family-owned and operated business is this common good for the common man, that there shouldn't be any sacrifice whatsoever in household cleaning. So we make products that are powerful, that work as good as the conventional brands that you're used to, that are safe, EPA Safer Choice approved, and affordable. There shouldn't be a premium to these products. So
I'm holding one of the multi-surface antibacterial cleaner, kills 99.9% of bacteria. Ingredients: citric acid, 6.0%, but then it says other ingredients. What are those other ingredients? Is it chemical or is it something else?
Majority of that one in that prime example is going to be water. It's predominantly water-based, but there's also surfactants in there, which are non-toxic, biodegradable surfactants. We're not necessarily...
What are surfactants?
Soap, right?
Yeah, soap. Thank you. Yeah.
All right.
Soap, citric acid, and then drying agents.
What's the price point of something like this then?
So that one will typically retail varying degrees depending on the retailer, but at kind of your national retailers, $297 is where you can find it.
And no bleach. I mean, that's the key, because, you know, bleach can have some pretty nasty effects.
Exactly.
And in terms of your distribution model, so I mean, have you looked at maybe a direct-to-consumer model? Are you mostly in stores right now? Where can people pick this up? And how has that kind of strategy adapted over time?
Yeah, so we want to make it easy for the consumers to not only get what our product is, but convenient as well to where they can purchase it. So Amazon, Target.com, Walmart.com is predominantly our distribution channels through the e-com. We don't do it necessarily direct from our website, right? And then you can find us at brick and mortar retailers across the U.S. from Target, Walmart, Kroger, H-E-B, Publix, Albertson Safeway, all the regional players as well, Meijer.
What kind of growth have you seen?
We've seen compounded average growth of around 30% year over year, and just continuing to take up that trajectory, especially as consumers really become aware that, hey, I can have a better for me cleaner that works.
Anybody approach you to buy out?
You know, we love, my biggest value in life is I love to create. And so being able to create opportunities of great cleaners that work, the common good for the common man approach, that's something that's near and dear to my heart. So it's going to be pretty tough if somebody wants to take us out of this game.
All right, Lemishine CEO Curtis Eggemeyer, thank you so much for joining us.
Thanks for having me.
Appreciate it.
Coming up, from the big house to the small screen, as her husband rots in prison, El Chapo's wife reportedly considers a move to reality TV. I did not write that tease. Let's take a look at some of today's trending tickers on Yahoo Finance. Look at that. Shake Shack, we were talking about their earnings, and they are trading down right now. The chicken sandwich craze has turned deadly. A man was fatally stabbed outside of a Maryland Popeyes restaurant over its recently re-released chicken sandwich. Popeyes issued a statement this morning saying, and this is a quote, "There is no reason for somebody to lose their life on a Monday night in a parking lot." A California-based packing company announced a recall of vegetable products over potential listeria contamination. Several of the vegetable products were being sold at H-E-B and Walmart in the USA and Canada. No illnesses have been reported. It is beginning to look a lot like Christmas. Discount grocery chain Aldi announced its wine advent calendars go on sale this week. The company announced last month that they were bringing back the popular holiday countdown after their wine and cheese version sold out, you ready for this, in just minutes last season. We're going to be right back. Let's do some buzzer beater. 3 stories, 1 minute each, and we're going to start with this. Under President Trump, 2.3 million people have actually lost their Lifeline phone. It's a subsidized phone service from the FCC. So should people be given subsidized phones? This was a big issue back in the Obama administration. Remember, there was that video of the Obama lady where she talked about, I got a free phone. But these phones actually help people get jobs and hold on to jobs. So does this make sense?
Yeah, well, I mean, there's a challenge here. I mean, when you look at the drop-off, that's obviously quite dramatic, but you wonder about to what degree maybe the uptake of this program wasn't good because maybe there are cheaper, more subsidized phones available through private carriers and whatnot. And plus, I imagine that the government had to have a contract with, some companies to make that program happen. So, I think the core of the issue, though, which is, the elderly having access to these types of technologies is important. It's just, I think the means of getting it to them is maybe where the administrations differ.
I hate to be the person to say take the phones out of people's hands and take opportunity away. I think this is an opportunity to be primed for a company who's trying to do good, give back to society and do things better. So maybe they should be giving it back to the people rather than government taking care of them.
All right, let's talk about the Trump administration and national parks. It's also in the spotlight for trying to pump more revenue into the national parks. There's a committee that's now been disbanded that reportedly looked into adding amenities like Wi-Fi, food trucks, and even Amazon deliveries. It's not clear. So the committee's been disbanded, but it seems like maybe the proposal is still alive. I hate this idea, personally. I don't think people need more electronics and Amazon deliveries in national parks. But
Oh, no. Let's keep nature natural. No, I don't like this at all.
Yeah, and this is not even the most alarming thing that the Trump administration has tried to do with the national parks. They've shrunken the land for national monuments like Bears Ears. We remember that being a huge issue a few years ago. So, I mean, this idea to commercialize national parks, it's completely ridiculous.
Well, but there's also been the issue that the national parks, and it's not just the Trump administration, funding for the national parks, as more people go to them, they fall into disrepair, funding has fallen behind, and there's a lot of trash. So you got to come up with a way to create revenue so that you can clean up the parks so that people can enjoy them. More of us are going to them.
There's other ways to do it. I don't like this idea at all.
All right. The wife of the drug lord El Chapo is reportedly in talks to join VH1's TV series Cartel Crew. I guess this is just a reiteration of After the Music or something.
I haven't watched anything on VH1 in years, so I'm not even aware of.
Do you watch reality TV?
I do, yeah. I'm from New Jersey, big Jersey Shore fan, but I don't know about the Cartel Crew.
There's nothing real about reality. It is scripted. This is just a fact. Reality TV is scripted. They retake the shots.
Would you watch the show, though?
I don't think I'd watch this show, but free markets. I mean, let's see what happens with this kind of.
What is the premise of
know,
the program? So it's called the Cartel Crew.
It's ex-cartel members. So do we need to glamorize this, really?
Thank you.
Yeah, right. That's the bigger problem.
But let nobody watch it. I mean, let the market speak for itself, right?
Oh, the market will speak on this one.
Yeah, I think the ratings
market's
will be low.
We were like, is VHS, who dis?
Exactly right. Exactly right.
I love Adam saying who dis. That's great.
They're gasping for relevance here.
All right, just want to mention some news coming out. House Democrats are apparently asking White House Chief of Staff Mick Mulvaney, acting White House Chief of Staff Mick Mulvaney, to testify on impeachment. Of course, a number of White House officials have pushed back, have refused to testify. Others have. So this will be a very interesting case. They are asking for that testimony this Thursday. So we should know shortly whether it's going to happen or not. Lee Carter, thank you so much for being here today. It's great to see you. Brian Chung, thank you for stepping in. And if you take a last look at markets, we continue to see a little bit of a mixed picture.
Hey, don't forget to catch Brian's interview with Chicago Fed President Charles Evans. That's tomorrow, November 6th. You can catch that conversation live at 9 a.m. Eastern right here on yahoofinance.com. Stick around. Wi-Fi PM is next.
It is 1 p.m. in New York City, and the major indices are taking a breather after hitting record highs in back-to-back trading sessions. On tap for today, growing optimism for reaching a Phase 1 trade deal with China as U.S. negotiators weigh dropping existing tariffs on Chinese goods. Why that would be a big win for China. Plus, earnings season rolls on with painful quarters from profitless tech unicorns Uber and Peloton. Why both are getting slammed today, and why Peloton's CEO says the company is actually choosing to stay unprofitable. And speaking of game-changing tech, the founder of the startup behind Sally, the salad-making robot, will join us to explain why humans making salads is a problem that needs addressing. Let us begin. This is Wi-Fi PM. We got our puns out of the way for today's show. I'm Zach Guzman, and joining me on Wi-Fi PM today is Yahoo Finance's Heidi Chung, along with radio show host and podcaster Ben Kissel, back in the house with us. Ben, good to see you again, man.
Thanks for having me. Great puns.
Thank you. I figured might as well get them out of the way, and then we can do business from here on out.
Perfect.
We'll start by looking at the market action we're seeing right now, and you can see it's a mixed bag here on Tuesday. The S&P, the lone index in the red right now, the NASDAQ and the Dow up slightly. Again, kind of taking a breather here as we've been trading at all-time highs. We'll see where things go throughout the show. But first, Chinese President Xi Jinping is speaking out on trade tensions, saying at the China International Import Expo today that global frictions should be solved through discussion and cooperation. This comes as some Trump administration officials are debating whether to remove some tariffs on Chinese goods as a concession to solidifying a partial trade deal continues. According to Financial Times, the proposal could roll back tariffs on roughly $112 billion worth of imports, including clothing, appliances, and flat screen monitors. And guys, these imports were introduced at a 15% rate on September 1st. Of course, we're watching that 15% additional tariff round coming in December. But I mean, this is interesting for a couple reasons, right? We're talking about, we've talked so much about President Trump's timeline to get this phase one deal done. He wants some momentum heading into 2020. But you got to think this might be the last time. If they take tariffs off the table to appease the Chinese side, there's not really much room to slap those back on, because he would not want to see a market downturn right before we get into a new election cycle.
Well, I sure think that everything right now, as it stands, is so far so good. So phase one is expected to be signed sometime later this month, and that's the hope. Fingers crossed. I know I sound optimistic and you're rolling your eyes at me, Ben, but as of now, if everything goes according to plan, hopefully the U.S. would also not implement those 15% tariffs on December 15th, right? So, I mean, hope is there.
Yeah.
Right?
Well, I think this is a two-pronged issue for Donald Trump, both politically and economically. I think economically it benefits him to end the trade war or try to have a resolution to the trade war as quickly as possible, as a lot of the constituents that voted for him are in those sectors. And then politically, as he actually spoke about, wanting to make sure that the holiday season goes well for consumers.
Yeah.
So I think this is sort of, in Donald Trump's mind, a win-win, and I think that's why we see this moving forward.
I mean, that's the whole reason why we saw him take those tariffs off before, right? Was because of a worry about the holiday season. And we've seen pressure in the retail space as well. Retailers
Absolutely.
coming out against all of these tariffs as well. But again, we have to wait until phase one is actually signed and we move on and it's official, and then we'll see where things go from there. On the Democratic side, though, it's not as if people disagree. They still want to see some change made here, but you wonder what substantive change might come if you kind of agree to take tariffs off. Not much pressure to still be applied to get some of that substantive changes enacted later on. But nonetheless, that's the optimism on the trade front space right now. The other things moving the market, of course, is earnings season rolling on, and today some painful quarters being revealed at some big tech giants. Uber reporting quarterly results yesterday, the ride-hailing giant plunging despite a narrower than expected loss in estimates topping revenue for its fiscal third quarter. Uber posted an adjusted EBITDA loss of $585 million on adjusted net revenue of $3.5 billion. Gross bookings also coming up short of estimates as well here. Of course, we got the lockup expiring tomorrow.
I think that's why we are seeing the shares under significant pressure today, but that's not to downplay the fact that gross bookings disappointed specifically in the Uber Eats segment of the business, right? The company has long said we're going to focus a lot of our energy on Uber Eats. This is going to be our big driver going forward. And then this is kind of a smack in the face to investors who are betting on this company to become this mega platform where you can, order food, order groceries, take rides. It's going to be this huge player in the space, but I think investors are worried about the Uber Eats segment of this business right now.
Well, I just want Uber, if you're watching, I'm doing the best I can with Uber Eats.
Hey, Dara.
I am trying every single day to support your company. I think when it comes to Uber, the rideshare company, there wasn't a lot of competition. Obviously, Lyft came in. They had a big battle when it comes to the taxi unions and things like that. But in the food space, you got Grubhub, you got Seamless, you have all of these different places that people can go, or God forbid they call a restaurant and actually speak to someone over the phone and get it delivered to them that way.
Yeah.
So I think Uber Eats is realizing that the competition in that field is a lot more intense than the rideshare competition.
I mean, when we talk about it too, we'll be diving into another restaurant out there that's kind of pivoting to focus just on one, that being Grubhub. We'll talk about that later in the show. But nonetheless, I mean, when we're talking about kind of the positives here, right? They're targeting 2021 for positive EBITDA.
Right.
And we're talking about that. I mean, it's kind of a similar timeline to what we're seeing from Lyft, but that should generally be a positive sign. So you're kind of weighing that with kind of the growth and the misses that we were talking about there, and then also, of course, the lockup tomorrow.
That is 100% on point. I agree with you.
So that's kind of that's what we're seeing
exactly what
today.
I'm saying. Yeah.
Well, nonetheless, I mean, the pressure's not going to be going away tomorrow. And of course, every time we're talking about profitability in names like these, you get some of those negative mixes with the positives, and we'll see what happens because today Uber hitting all-time lows, trading near those as well. But while we're talking about one profitless unicorn, Uber's not alone in that camp. There's also another out there, something for the bulls and the bears in Peloton's first earnings report as a public company. As you can see there, that stock off by about 5.5%, 5.25% right now. The fitness company posted an adjusted EBITDA loss of $1.29 a share, missing analyst projections for a loss of 39 cents a share. But revenue more than doubled from the year prior, surging to $228 million. So again, kind of a pro-con approach to take here.
Right. And I want to apologize for Peloton. I am not supporting them very well.
Same.
I've done a horrible job.
On using their product.
Yes, on using
well,
their
at least you
product.
have one.
No, I don't even have
Okay,
one.
well, then, yeah,
I watched their
you're
ads.
definitely not supporting them.
I have a rowing machine that's collecting dust. It's a great hanger for my clothes.
Yeah. I think the issue with Peloton and why I feel like investors are a bit confused here is, yes, they sell this really expensive hardware, right? $2,000 bikes, treadmills, or whatnot. But they also rely heavily on subscriptions, right? So the margins when it comes to subscriptions have to be good at the end of the day. And if you're thinking about long term and if you want to think about profitability, a company being able to turn profitable at some point,
Sure.
I think we need to know more about how those margins look with the subscription company like this.
Well, this opens a very interesting debate. I want to get into this too because CEO John Foley prioritized growth over profitability on the earnings call this morning, saying that the company is choosing to stay unprofitable. Take a listen to what he said.
We are within striking distance of profitability. It's a managed outcome. I believe if we pulled back on growth, we could be profitable tomorrow. But that is not what the board and the leadership at Peloton believes we should do. We think this opportunity globally is so big that we think we're right on the right balance of investing for future growth.
All right, so a couple different takes we could have here, guys. I myself tend to believe that makes sense. Spending and maybe foregoing profitability for a little bit might make sense if you're in a space where you got to get in and capture share right away. I'm not sure if a workout company necessarily falls into that category. People have gyms to go to. It's not that disruptive.
Zach, at the end of the day, in an environment right now where we're seeing a lot of people freaked out about this growth at all costs business model, do you think this is the right thing of an unprofitable company CEO to say something like this and word it in that way? Oh, we're so close, we're within striking distance, but we're not going to go there. We're just going to spend a ton more money and focus on growing this company. But in reality, what kind of real competition do you think there is right now?
I mean, it's everything. It's Bowflex, it's gyms,
Both?
it's whatever
Okay,
else you wanna do.
they are not relevant anymore. Bowflex?
No.
How dare you?
Well, I don't know about
Oh, my
Bowflex.
gym.
I know Bowflex.
But I do know, gyms are still, if you truly are a workout aficionado, this product probably doesn't give you what you need. And if you're not, this product is probably too expensive for you. So I feel like there is something in the middle where it's like there just seems like a cap of people who, this probably is going to, I bet you their sales are going to do great in January.
Yeah.
And then as soon as people realize, again, it's like my rowing machine collecting dust, it's going to go back down.
I mean, this is just one of those things. I think if the size of the prize is big enough, right? And we're talking about, I mean, this it's kind of interesting because all of these arguments that you need to be at profitable, if you can be, you need to be there right away. It's the same argument that played out. We kind of saw this in the cannabis space before all these other industries, mostly tech. Some
How's
of these
cannabis
companies.
doing?
I know they're getting punished, but I'm just saying that it makes more sense there because if you do own that market and you do have a product, and this is kind of the thing in cannabis is that it's hard to differentiate, but if you do get there first, there is a lot to be said about first mover advantage. I'm just not sure that it's there for a product that has to do with working out in gyms because there's so many alternatives and maybe, yes, you can make the argument that you get these products out there and then you hook them on the subscription model where you make the money there.
If they can't
get it.
people to continue to subscribe, it's not going to work out.
Yeah. And I think the entire premise, as I sort of joked about before the show, there's a Black Mirror episode where everyone just has to bicycle and cycle, and then it's like, it's very dystopian. And so that's why I say
You're
no.
turned off.
I'm just scared.
Yeah.
I'm scared of allowing all these people into my home, and I just don't need to be yelled at in my living room.
Well, we'll see where they go. Again, it's a fairly newly publicly traded company. They still guide towards $150 million adjusted loss, $150 to $170 million before EBITDA or EBITDA adjusted loss for 2020.
This company has never hit hit its IPO price since its debut. The highest level that it's hit is $27 per share. It IPO'd at $29 a share. So what's next for this company? I mean,
So what you're saying is up from here can only go up from here when you look at it that way. We'll see.
Such an optimist.
I'm just saying. We'll see what happens. If you buy what he's saying on the call, then I'm sure you would be an optimist. I didn't open this debate by saying that I bought what he said on the call. All right, well, Boeing CEO Dennis Muilenburg is under more scrutiny as more questions are lingering after the 2 deadly crashes involving 737 MAX jets. But the executive does have the support of Chairman Dave Calhoun, as he says the embattled CEO has offered to forego all bonuses this year. Take a listen to his interview on CNBC earlier.
Dennis called me Saturday morning, 10 o'clock, with the purpose of suggesting that he not take any compensation for 2019 as in the form of bonuses, which is, of course, most of your compensation. It came in 2 fronts. 1, no long-term bonus, and 3, no consideration for equity grants until the MAX in its entirety is back in the air and flying safely.
Guys, I mean, that was a big battering point when we're talking about him getting grilled on the Hill. I mean, lawmakers criticized the fact that the CEO was still set to receive a bonus before when he appeared before them, but now kind of floating the idea that maybe he'd forego that. I wonder if that's because of that pressure or if it's just because that optically or looks better when you're seeing this play out.
Dude, I fly all the time. And your number one job is to make sure the plane doesn't crash. This is so upsetting. You got one job. Make sure that plane stays in the air and lands safely. And I think it is a slap in the face to the victims of these crashes for him. I believe he makes around $90 million, I think about $90 million. So for him to be like, I'm not going to take a salary this year, I believe he should be fired. You got one job to do, and he didn't do it. And when you mess up in the aircraft space, people die. So I think this is just pathetic. And for him to try to swing this as like, oh, I'm giving up all of my compensation for the year. It's like, you should be fired.
I mean, I certainly think that it's a good move that he is not obviously taking his bonus. It would not look good if he was continuing to get millions and millions of dollars in pay.
Why was he even up for a bonus? I don't get it.
But I have to agree with you to some extent, Ben, in that there are so many negative effects on so many other people, not just those that lost their lives and the families, but also, people that work for the suppliers, people that work for Boeing. It's a very difficult environment right now. And a lot of people have made the argument that he is on borrowed time. And a lot of people were actually expecting him to potentially lose his job following his testimony in Capitol Hill last week. But it seems as if he has the support of the board right now.
You just heard it. You just heard it in that interview. I mean, we've been talking about it. They said that they've been doing everything that they've asked of him since the problems and since this all happened. But I mean, you're right. A lot of people would argue the buck stops with you. You should have known that this was going on. And nonetheless, I mean, we're hearing he does have the support of the board still.
He was booed at the company meeting. He was protested on Capitol Hill by the families, from the survivors of the folks that died. I just feel like there needs to be more of a fallout than him not getting his bonus. He's going to be fine.
Yeah, well, I mean, he was stripped of the chairman title, so there's one thing. We've seen that increasingly when companies run into problems. They'll basically say, all right, well, we'll strip them of the chairman title if they have that and the CEO title. But you're right. I mean, in this instance, we're talking about a company that has far more implications when something goes wrong than some other companies where it's just not hitting profit targets. So, I mean, this is something to consider. But for right now, sounds like he's got the support of the board. But while we're talking about problems at companies, I mean, Walmart and Tesla, that was a heated point when we're talking about companies that had problems with each other. They've now reached a truce. Reuters reports that the retail giant has agreed to settle its lawsuit against Tesla after alleging several fires in its stores were caused by Tesla solar panels. The settlement terms have not been disclosed. But nonetheless, I mean, that could have been a lengthy battle between these companies when you're accusing Tesla solar panels of catching fire on multiple Walmart
Do you remember Walmart was saying that, Tesla was practicing gross negligence and this was a serious issue, and then all of a sudden now...
You gotta flex your
I know,
legal
so I
muscles
want to
to
know what the details are here. I'm so curious to find out because, it would have been a lengthy, very expensive battle between the two companies, and it certainly didn't look good for Tesla and Solar City. So I want to know the details.
I think I would rather have a lawsuit with the federal government than with Walmart. Like, that is how powerful Walmart is. So I think Tesla probably dodged a bullet here. It seems as if Tesla is like the road to hell is paved with good intentions. Like, I like so many of their propositions, so many of their products, and it's just been difficult to get them in the right direction.
Every time they take a step forward, you take two back. It's kind of the vibe here. And we're
Solar
talking
panels, wonderful. Don't have them start on fire.
Or profit one quarter and then you lose a profit the next quarter.
It's really simple, guys. It's really simple.
Yeah. Well,
also have a place for your cars to get repaired.
I suppose easier said than done, all of these things. It's easy for us,
course.
but you know, these things do take time. All right, well, coming up, Shake Shack shares are tumbling after a change-up in delivery strategy weighed on its latest quarter. We'll have that reaction next. Plus, ousted McDonald's CEO Steve Easterbrook taking another hit. We'll have which board he's now stepping down from too when Wi-Fi PM returns. Welcome back to Wi-Fi PM. We're watching Shake Shack shares coming off their lows of the day, but plummeting nonetheless after a mixed quarterly earnings report that saw revenue and same-store sales growth fall short. The burger chain posting adjusted earnings of 26 cents a share on revenue of $157.8 million. The company also boosted its full-year guidance as well, so those are a lot of positives, or at least the last one's a bit positive. But Shake Shack also said its exclusive Grubhub partnership will likely pressure sales. Take a listen to what the company's CEO said on last night's earnings call.
We believe the transition to Grubhub caused some noise in our Q3 numbers and will certainly have an impact through the fourth quarter and into next year. As we remove direct point-of-sale integrations with DoorDash, Postmates, and Caviar, we expect an impact to our delivery revenue, especially in those regions where Grub may not be the current market leader. Any difference in pricing, placement, or regional strength in non-Grub marketplaces will affect our sales for a period of time.
All right, so Heidi, I mean, same-store sales weaker than expected. Also, when we're talking about that last bit there, kind of Grubhub weighing, we're shifting to the Grubhub platform weighing on what they're seeing in the delivery space as well.
So just before we get into that, the stock plunged 12% immediately following the results. So that was even before Grubhub was mentioned, but that's because they slashed their same-store sales forecast for the full year. Now they only see 1.5% growth. They previously forecasted 2% growth. So that's why we saw the stock plunge. And then we had Randy Garutti get on the call and say, okay, so we had previously previously been on Postmates, DoorDash, Caviar, and Grubhub, but we are now only exclusively going to partner with Grubhub going forward. Now, in the third quarter, the company announced that, and these platforms such as Postmates, DoorDash, and Caviar started removing promotional items for Shake Shack, and that hurt their sales in the third quarter. Now they expect continued volatility as they do this transition to Grubhub exclusivity to weigh on their fourth quarter. But not only the fourth quarter, continuing into 2020, and there's no clear visibility at this point as to what's going to happen with their delivery revenue as well as their digital sales. So consumers and investors, consumers, analysts, all very confused on the call yesterday. I mean, analysts continue to hammer him on more details about this. He didn't really have a clear-cut answer. He kept bringing up things like, the 4-day work week that we're focusing on, and other random things. And I think that a lot of the response that we're getting is just a lot of zero clarity.
Yeah, it seems a little strange to me to shut down options to get your product.
Well, part of the reasons why, he mentioned that it was kind of complicated in these stores, right? When you're dealing with all those different delivery people coming into your store, picking things up, it's hard to kind of manage all that. It was a bad guest experience, according to him. So kind of focusing in on one and being able to partner with Grubhub to focus in, especially on the data of what customers are ordering, to focus in on what's working and make that guest experience much more streamlined would eventually be a plus. But in the short term, you're going to see what he likes to refer to as some noise.
Very expensive noise. But Shake Shack, I feel like it was so successful because of its exclusivity. It was exclusive.
Exclusivity.
Whatever. It's early for me, okay? But it was exclusive. It was Madison Square Park. There was a line across, a line around, the entire block. And then it spread out so far, so fast. I'm just not really sure if Shake Shack is still what Shake Shack used to be. It was more of an experience back in the day.
And to your point, this company was resisting the third-party delivery surge up until last quarter, and they finally caved and said, okay, we will partner with these companies. But for a really long time, Garudi and the rest of management were saying, well, we want to maintain the quality of our product, and we can't guarantee that if we're doing delivery through third parties. But look at, the companies just have to get in.
To kind of both of you guys' points here too, I mean, like at the end of the day, Shake Shack is a restaurant. And what is it? It's a burger restaurant. So I mean, I had this company, even after all this, it's still up 50% year to date. So I mean, you're talking about a company that is a burger restaurant and still, I mean, that's impressive growth. We're talking about a stock on a year to date basis.
But also, this is the worst day for this stock ever. So that's just the kind of move that we're seeing today, just represents how big of a concern this is. Yeah, exactly. It was a big run up, 82% before today's move.
So you gotta weigh all these things together, I'm just saying, you gotta shake and your shack. You
gotta
do
shake
both.
and shack it. Although I don't know how the shake would hold up during the delivery process.
That's also a good point.
That's
Maybe
the
they shouldn't
problem.
be so focused on the delivery anyways, because how many people want that? It's all melty. I've never actually ordered one.
I have not either.
So there you go. Just saying. All right. Well, while we're talking about the fast food space, and dare I say, Shake Shack is a fast food restaurant, I will. Alston McDonald's CEO Steve Easterbrook is now stepping down from Walmart's board, effective immediately. An SEC filing reads in part, quote, Easterbrook's decision to resign was not due to any disagreement with the company on any matter relating to its operations, policies, or practices. Guys, that may be so, but he also violated McDonald's company policy, so perhaps that played a role in either his decision to walk away or maybe pressure for him to walk away from the Walmart board as well.
There may have been some pressure. But we know very little as to what the motivations were behind this move. I'm sure it had nothing to do with Walmart or his work at Walmart or anything that he had contributed up to this point. But yeah, I mean, it's probably not a good look to have somebody who was kind of disgraced at McDonald's to still be on your board. I don't know where the pressure came from.
It's kind of the Me Too era, right? I mean, Ben, when we look at this, I mean, he had a consensual relationship with an employee at McDonald's, but he's the CEO. So, I mean, where we're at and today, there are policies in place to kind of prevent that. He knew it, the board knew it, so they parted ways. The board parted with him at McDonald's. But I mean, when we're talking about Walmart, entirely different company, different rules, different situation, but choosing to resign from the board regardless.
The way that the world is now, the pressure on these companies is very extreme.
Yeah.
You know, specifically with social media and the way that can just be direct. The consumer has just a direct line to the company. So I think Walmart probably just sat down with the dude and was like, you know what, bro, let's just cut our losses. It'll be easier. You don't want any more negative press. We don't want to get any negative press. Just go enjoy your life and continue to be a multi-millionaire.
Yeah, as we covered yesterday, I mean, 6 months of severance from McDonald's as well.
And free McDonald's for life, I heard, which is really nice.
Despite
That's a
everything.
joke. I don't know.
His family goes there. His family still goes to McDonald's.
They better.
He goes to McDonald's. And so, yes, I mean, just another, I don't know if there's another domino to come in all of this as well. I'm sure more details. As we said, we had some, there wasn't exactly full details about what's going on with Easterbrook there, but nonetheless, not on Walmart's board anymore. But I want to stick with the fast food theme here. A little bit of some serious and troubling news to get to. When we talk about the Popeyes chicken sandwich, we talked about the fervor over the return of that sandwich, and it took a very grim turn last night after a man was fatally stabbed at a Popeyes restaurant in Maryland. The incident reportedly started after one man accused the other man of cutting him in line at the restaurant, and Popeyes responded to the incident stating, "We are very sad to hear about the tragedy in Maryland tonight. We do not yet know whether this was the result of a dispute over one of our products or something unrelated, but there is no reason for someone to lose their life on a Monday night in a parking lot. Our thoughts are with the victim's family and friends, and we are fully cooperating with local authorities." Guys, I mean, local authorities did say that this stemmed from that interaction in the Popeyes and then spilled out into the parking lot. But I mean, we've talked about the risks associated, that this wasn't the only incident when it comes to customers getting in altercations at a Popeyes over this sandwich. I mean, we saw there were other episodes in Maryland. There were other episodes in Florida. I mean, I'm not sure how much blame is supposed to be placed on a company that knows that this product has seen such high demand. But I mean, nonetheless, it's not what you'd expect over a fast food product.
I think this is sort of one of those things we're kind of trying to balance as a society: security versus like the feeling of being free. So does Popeyes need to ramp up their security because people cannot handle their craving for this chicken sandwich? Sadly, that might be the case, but I think it's just unfortunate that people have, this person who stabbed this other individual for cutting him in line was probably just going to end up stabbing someone else for cutting him in line for God knows what else, because obviously this person is someone who would stab someone for cutting him in line.
So I visited several locations like we discussed yesterday, and at one of the locations I also witnessed a lot of patrons at the store getting a little restless because the waits were so aggressively long. They were there for 2 hours, and then some people started placing mobile orders and going up to the counter, and one man asked the lady if she was cutting him, and he got very visibly irritated at that. And so a lot of that was happening even in the location here. And so it's difficult when you're an owner of a franchise restaurant, a Popeyes restaurant, right? The company can only do so much to prepare you for a launch like this. You don't know how crazy the lines are going to be and how well trained the workers are. So is it Popeyes' responsibility? I think it's hard to put the blame on the company itself, but it is definitely something to think about.
It wasn't even that late. It was 7 o'clock. I mean, it wasn't late in the day. And we're talking about something that has been watched.
To be fair, though, if there are 2-hour waits, that's not what you expect from it's a fast food restaurant.
Yeah.
So maybe they need to hire more employees, stop trying to cut costs, and make sure you can expedite the food at a reasonable pace. Because if I'm waiting in line for 2 hours and it's supposed to take me 5 minutes, I mean, I'm not going to stab someone. I would leave the line. But that is something the company could fix.
I mean, the limit too is we talked about all the positives of this kind of being like a big social media wave. I mean, there are real aspects here when you think about the negative that could come from this by the way that the company might mismanage things as well when we're talking about it continuing to be something that people are watching. Nonetheless, I mean, the local authorities there still don't have a suspect in mind. They're asking people to come forward because there were obviously other people around there and still asking the suspect to turn himself in. But nonetheless, that is the news on the Popeyes chicken sandwich. Up next, the biggest movers on the day as a market takes a breather after hitting fresh record highs in back-to-back trading sessions. We'll have all the movers coming up. And a reminder to stay tuned to Yahoo Finance for an interview with Chicago Fed President Charles Evans. That's tomorrow at 9:45 a.m. Eastern Time. Let's check in with Scott Gamm on the floor of the New York Stock Exchange, looking at the big movers in the Dow. Scott?
Yeah, that's right, Zach. That is where the action is in this market because the broader indices are taking a breather after a record run yesterday. The best performing Dow stocks right now are names like Boeing, McDonald's, which is reversing from some of the big losses we saw in the stock yesterday, and then ExxonMobil is the third best performing Dow stock. Gains in ExxonMobil came yesterday as well, and then on Friday when the company reported strong earnings. Now, Zach, outside of the Dow, we're also keeping an eye on shares of Shake Shack, down 19%. This, of course, after the company reported earnings after the closing bell yesterday. Same-store sales, which is the metric we watch in a lot of these restaurant companies, rose 2% year over year, but that was a little bit below what Wall Street was expecting. Now, the stock is still up about 60% so far this year. And then speaking of earnings, we're also keeping an eye on shares of Uber, down 10%. It's almost 6 months to the day that Uber went public right here at the New York Stock Exchange. The company reporting earnings yesterday after the market closed. Now, revenue grew 30% year over year for Uber's most recent quarter, but the loss for the quarter was over $1 billion. And as you know, a lot of these new companies, these newly public companies, are under tremendous pressure to become profitable, Zach.
I'm taking another leg lower. I was expecting it looked like Uber was going to turn things around, but not so. All right, Scott Gamm on the floor of the New York Stock Exchange. We'll check back in with you later on. But just ahead on Wi-Fi PM, you've heard of robo-advisors and robocalls. But are robo-salad makers the next big thing? The founder of a new robot salad maker joins us for more on why it's a problem that needs addressing. We're back in 60 seconds. Good afternoon and welcome to Wi-Fi PM. I'm Zach Guzman, and joining me today is Yahoo Finance's Heidi Chung, along with radio show host and podcaster Ben Kissel, back in studio with us along for the ride. We got a busy act two to get to, guys, so no time to spare. We'll check the market action real quick off the top here. Now we've all pivoted into the green. Look at that. A big change on the day as the S&P joins the Dow and the NASDAQ in the green. We'll see where things go as we finish up here on Wi-Fi PM. Well, lunch is going high-tech in this week's Rise of the Robots. This salad-making robot from Chowbotics allows users to choose their own ingredients and view the nutritional details for each selection. The machine, which costs between $35,000 to $40,000, is currently being used at over 70 locations, including offices, universities, and hospitals. And joining us to discuss is Chowbotics founder and president Deepak Sekar. And Deepak, it's interesting because your company also recently launched Sally 2.0, which can also prepare other meals like yogurt and fruit bowls as well. So when we're looking at this, what was the main push in rolling this product out? Was it because humans aren't good enough at creating salads, or is there a different use case here?
The thing we hear from our customers is that they love the fact that robots don't need to sleep. They're available 24 hours a day. So we put these robots in hospitals where I have so many nurses thank me for giving them food late in the night and saving them from junk food from vending machines. Even in university, students love the 24-hour availability of these robots. And we find that helpful in offices as well, because once the cafeteria closes, you have the robot available for providing your dinner and food late in the night.
Yeah.
Deepak, when we talk about salads, though, we talk about the quality and the ingredients, right? We have to make sure everything is fresh. So how do you make sure you quality control all the ingredients in here? Even if something perhaps breaks down and things start to go bad in there, how are things like that managed?
Yeah, so the robot actually keeps food far fresher than a salad bar, because in a salad bar, the food's open to the air. So after a day or so, romaine lettuce in a salad bar starts turning brown. While inside Sally, inside our robot, the food's all kept refrigerated, and the containers are almost airtight, both top and bottom. So if you put romaine lettuce inside Sally, it stays fresh for as long as 3 days.
Wow.
So that's one thing we do. The other thing we do is our partners who manage the robot, they go in there once a day, sometimes even twice a day, to refill the food and make sure it's fresh. And because of these reasons, the food out there is really, really fresh, and that's something we pride ourselves on.
Hey, what's up, sir? So I just have a question regarding automation. Obviously, that's the larger question here. We're talking 25% of American jobs are going to be gone because of automation, specifically Black and Hispanic jobs. Up to 44% of Black jobs and 47% of Hispanic jobs are on the line when it comes to automation. Do you have anything set in place to offset the fact that many people, you say that these products are being used after the cafeteria closes, but at some point, there's just going to be no one in the cafeteria, and this will be the cafeteria. Do you have anything in place to sort of compensate for the jobs that will be lost?
We are actually finding we're creating new food service locations with these robots. So what I've found in the past year and a half of doing these robots is people have largely used it in places where they can't get fresh food right now. So in hospitals, there's no fresh food available between 9 p.m. and 6 a.m. And these robots provide food at those times. And the robots are not completely self-sufficient, so it still needs humans to prep all the ingredients for the robot and load it into the robot. So we found in the past year, quite surprisingly, that we are creating a whole lot of jobs because we are providing food at times when it's not provided right now.
Yeah,
we are putting these robots in new locations where they're not in right now.
And what's also, what would come along with that too, we hear this all the time, is also other jobs that might be ancillary to that, people needing to fix these machines, work on the machines, other things like that. But it's interesting because you're also teaming up with restaurants. So it's not just outside of the restaurant space or new places to eat salad. You teamed up with the Salad Station in the Southeast when we talk about a casual dining experience there. Is that kind of where you see this, if it is to fit full scale, where you see the profits here, potentially also signing up with a Sweetgreen or other salad makers, national chains as well?
Yeah, we've got a few major restaurant chains and as partners. And what they seem to want to do is, instead of putting these robots inside their stores, they want to put them in hospitals or universities or airports or offices close to their stores. Someone goes from the store once a day or sometimes twice a day to refill these robots. So it's almost like new locations for these restaurant brands.
Yeah.
And these locations cost an order of magnitude less than building a brick and mortar store. And these locations often tend to be more profitable, simply because if you build a brick and mortar store in a bad location, that's not good. But if you put a Sally in a bad location, you just, if Sally's got wheels, you just roll the robot over to some other location, which is more profitable. So the restaurant owners seem to like that for...
Yeah, Sally's a very portable salad-making robot, one of the most portable, if not the only salad-making robot I've seen before. But Deepak Sekar, appreciate you taking the time. Chowbotics, really appreciate it.
Thank you.
All right, well, speaking of salad, we're focusing on fintech unicorn Kabbage next. Lenders co-founder sits down with us for more on the health of small business and new competition with big banks when Wi-Fi PM returns. Welcome back to Wi-Fi PM. We got some breaking news regarding Walgreens. According to Bloomberg, the company is exploring a potential deal to go private. If it goes through, it could become the largest leveraged buyout in history. Bloomberg says the Walgreens has recently held informal talks with private equity firms. This, of course, would shake up the Dow, as Walgreens is one of its 30 components. You can see there, shares popping on the news, up more than 7%.
Right. Walgreens also replaced General Electric in the Dow in the summer of last year. Perhaps it's a Dow curse, I'm not too sure. But when we take a look at Walgreens as well as some competitors like Rite Aid and CVS, they've been able to really do well when it comes to their prescription drug sales. But of course, the challenge long has been that they're not utilizing their retail space properly. And they have a lot of that retail space, right? And so that has been a big concern as far as performance for this company specifically as well. And so I guess investors are liking the fact that this could potentially go private. Hasn't necessarily been doing so well in recent.
We talk about and we talk about being a kind of an easy interest rate environment. You would expect some of these deals to be going through. So maybe not that surprising to see.
Speaking of retail space, I was just thinking about this the other day in a Walgreens. For being a pharmaceutical store, for to be there theoretically to better help people get healthy, it's one of the most unhealthy stores I've ever been in. There's not one thing that's not in a bag. There's not one thing that's not processed. Maybe they should try to get healthy food in there every now and again.
I've seen a lot of retailers try and make that case a little bit weaker by shifting away from some unhealthy products. Interesting to see a lot of them kind of cut e-cigarettes from their stores as well. And we're talking about a product that has potentially
Don't get me going
no
on
longer.
those.
I know. But there we go. Walgreens Alliance. We'll keep an eye on the shares and see if things change there. But we're also checking out the unicorn making loan decisions in 10 minutes or less in this week's Startup Spotlight. Kabbage uses artificial intelligence to provide lines of credit to small businesses online and is backed by SoftBank's Vision Fund. The company's latest valuation stands at $1.2 billion, according to PitchBook. And now the company is taking on Square and PayPal with Kabbage Payments. Joining us now is Kabbage CEO and co-founder Rob Frohwein. And Rob, thank you for joining us.
Thanks for having me.
It's interesting because you guys made a name for yourselves when we're talking about small business loans, right? But now you're kind of expanding into all these different areas. So talk to us about why you want to keep pushing into doing more and more at Kabbage.
Well, it's really all about the customers. Customers are really looking to save a lot of time in what they're doing and also relieve the headaches of a lot of the other systems that are out there. So one of the great things in building Kabbage is that we built relationships with customers where customers come back 15 times over 3 to 4 years. We built a great brand in the small business space, so expanding is sort of a natural next step for the company.
Yeah, kind of building up that reputation with small businesses through loans. And now I guess it's not that big of a leap to shift into also trying to start this payment side of the business as well.
That's right. It's all about working capital. So what we realized over time was that when we lend money to small businesses, it's in small chunks. And that's really to fill those cash flow gaps. And so it's all about how they bring money in, how they spend money, and what they do with the money that's left over surplus. And so payments is the next logical step for us.
But Rob, when we talk about the payment space, of course, Venmo's PayPal, Square's Cash App, that peer-to-peer payment space is actually quite competitive. So how do you expect Kabbage to really stand out, I guess, from the bunch?
Sure. Well, first of all, we're not really focused on the consumer at this point. So right now we're focused on helping our customers accept payments from their customers. So they can accept payments. And by the way, we'll understand how this cash is moving in and out of the company. So we can say to a small business owner, hey, by the way, we know you're going to generate $10,000 in the next 2 weeks. If you're going to have lots of expenses coming up over those next couple of weeks, why not, take a short-term loan from us for 10 days, for 15 days, so that you can really carry that time through. So combining lending and payments together is sort of a natural way of thinking about it.
Maybe taking a step back from kind of the newer approaches your business is taking, you guys have provided $700 million of capital through Q3 to businesses out there. I mean, you guys are obviously clued into this thinking around small businesses. What have you been seeing in terms of maybe loans and borrowing and how that all ties into what small business owners are thinking about the current state of the economy?
Well, it's interesting. Last year we put out a total of $2 billion. This year so far we put out over $2.1 billion, as you said, $700 million in the third quarter. And so it's clear to us the economy is still running along, chugging very, very well. Our customers are performing well. They're borrowing from us. We're not seeing any lack of performance. We're not seeing any unsteadiness in our portfolio right now. So right now I think they're bullish.
All right,
Yeah.
still strong.
Yeah, very strong.
State of small business still strong. You heard it from Cabbage himself. All right.
Well, I just have a question when it comes to how do you know if a small business is going to be viable or not? I'm just kind of interested, like what metric you use to know that
All
this
the
isn't
technology
just,
behind it.
yeah, like with the AI and everything. How do you know like what business is going to succeed, or do you guys turn down a lot of small businesses, or how does that work?
Yeah, great question. What we do is have a small business owner land on our site, give us access to a variety of data sources. We make a very, very quick decision, but we stay connected to that data. Very, very important. Once they connect us to banking data, processing, shipping, social, accounting, once we have that, we're able to actually keep track of that business and understand whether that business is doing as well today as it was yesterday, and then tracking it into tomorrow and beyond.
Be very careful about what secrets you give to this man. You never know. He might be hopping into the small business loan space. All right, Rob Furlong, thank you so much for taking the time. Appreciate it. All right, well, some of the biggest names in global finance are gathering at the Greenwich Economic Forum to discuss trade, capital markets, and investing as well. And Yahoo Finance's Julia LaRoche is there live. Julia?
Hey, Zach, that's right. I'm here in Greenwich, Connecticut, and I got to speak to some pioneers in the venture capital space, Alan Patricof of Greycroft, Steve Case, the founder of AOL, who now runs the Revolution venture capital firm, and private equity executive Jerry Parsky, who runs Aurora Capital. And we talked about a lot of different things, but as you can imagine, the state of the IPO market came up. Should companies even go public anymore? And also WeWork and what happened there. So take a listen to what Alan Patricof had to say about that.
I think that everyone should read the WeWork prospectus if you can get a hold of it. It's 350 pages, and it's a seminal piece. About 10, 15 years ago, the SEC passed something which was called plain speech, which enabled you not to have stiff language, but to be more relaxed, like you were, talking to real people. And this is the absolute height of simple, with all kind of emotional appeals and adjusted EBITDA numbers that are mind-blowing. So I think that was a seminal event. It's worth reading to know this was, I guess it's the bottom of where you're going to hit. And from there on, I think it's having already a real impact on any company that's been in the backlog of companies getting ready to go public, and making them look again at how their corporate structure is set up, how their capital structure, how their cap table is set up, how their directorship is set up, and how they report their earnings. And I think there's going to be a lot more scrutiny about companies who really don't have an economic model that works yet, that has not been proven. Not they're making money, but the model itself doesn't show that it has an economic viability. So I think that is we're an important event. When I used to speak, but let me go back. When I started Greycroft in 2006, I said we didn't expect any company we had in the portfolio to get sold in a public offering because the IPO market had just disappeared. And it was true until, honestly, the end of 2018, we were 100% correct. Nothing went public. But we sold a lot of companies in private transactions. I have been saying for the last 6 or 9 months, I think we have changed. I think we're now at a period of time when the IPO market has opened up, and it closes very quickly, by the way. I think it's opened up, but it's going to be a little more discriminating than it was in the first few months of the year. And a lot of companies got out, and people are taking second looks and seeing if the emperor has clothes on. So I'm positive about the outlook.
Yeah, guys, I mean, the WeWork IPO debacle, certainly a case study that will probably be done in business schools for years to come. I know we all talked about it. We're still talking about it. So a lot of interesting insights there from really a pioneer in the venture capital space, Alan Patricof. Zach, back to you.
All right, Julia LaRoche, thank you so much. Appreciate that. And right after the break, with winter bearing down across the country, we're taking a look at the top-selling coat on Amazon, why it's not all about staying warm. Gotta look good, too. Right after this. Welcome back to Wi-Fi PM. While we were in break, sad news, the S&P dipping back into the red. So just when you thought we had all green across the board, things taking a turn. We'll see where things go as we approach 2 p.m. Eastern time. Well, winter weather is creeping in, and Yahoo Lifestyle has a prediction about this season's next popular coat. Joining us now to discuss is Yahoo Lifestyle editor Adriana Barrio-Nuevo. And Adriana, we have the coat.
Yes, we have it here.
In studio. And I mean, to be fair, it looks like a very nice coat. But why is this coat going to be the it coat of the year?
Yes. So last year was all about this oversized, bulky, pocket-filled, zipper-filled Orlay jacket, but this year we're seeing a trend. A lot of Amazon shoppers nowadays are buying this Velukner coat, and it's available on Amazon.com. It's currently one of the top sellers in the parka and down coat category, and really it's just a great bang for your buck.
Price point on
How
this?
much? It's $80 to $130, depending on the color that you get. You can get any color from classic black to camo to even bright pink. There's a plethora.
But when I look at coats like this, I want to know if there's down in it to actually keep me warm. So is there actual down in this?
Yes, there is. It's 90% down, and it's actually made with 700 fill power, which basically is indicative of how cold or how warm you're going to stay. Most higher end coats have anywhere from 700 to 900, and those coats can run up to a couple $100 up to $1,000, even more. So you're really, really getting a great value with this one.
I mean, Ben, you're technically the only person wearing a coat, jacket.
This is designer.
Yeah.
Subi.
Well, what I mean, you seem like a coat guy based off of that. I mean, this adds up to you.
That is a great coat.
I mean, $80
That is a heck of a coat.
To be fair, the best coat I've ever purchased, $40, so $80 seems like a very fair price point for
It is, and you're getting the down, you're getting a water repellent fabric on the outside, so even if it starts snowing or raining, you're gonna stay warm and dry.
But to be honest, when we think about Amazon reviews, right, there's a long been a debate about how legitimate these reviews are. So could this potentially be, Amazon pumping one specific product, do you think?
I mean, you could make that argument, but right now, over 58% of the reviews are 5-star. So we know a lot of people are buying them. Many of them are verified. So they're coming from actual shoppers that have bought this coat. And it's been around for over a year, so it's gotten quite a bit of traction.
Nice.
Yeah.
Is it mostly men or women?
It's a women's coat.
Okay.
Sorry, Ben.
That's okay.
We'll find
I think you're right, though. I think it's post-gender society. Unisex is the trend.
I'm from Wisconsin. What I learned how to do is you layer from the inside. You wear long johns, and then you can then you don't have to wear a coat at all.
Well, actually, this comes in a bunch of sizes. It comes from double XL, extra small to 3XL. So
there you go.
You've got options.
That is the nice thing about Amazon. I've noticed that they're very good about adding sizes across the board.
Large range.
It's odd, too, though. You mentioned different colors and the kind of the price ranging there. They're also very good at that, too, because they know which one's most popular.
Yes, and they know that people are going to buy it up. So get your coat.
Well, there you go. It's time. It's season. It's the coat season. And that's going to be the one. Adriana Barrio-Nuevo, thank you so much.
Thanks for having me.
Appreciate it. All right, well, let's check in with Scott Gamm on the floor of the New York Stock Exchange as we're continuing to digest this news about Walgreens. Scott?
Yeah, that's right, Zach. And the stock was halted briefly just because of this Reuters report suggesting that the company is in talks to go private. According to this report, it has held preliminary talks with private equity firms in what would be, if it happened, the largest leverage buyout ever. Of course, Walgreens did not respond to Reuters' story, so we'll keep following that. But immediately as this report came out, the stock surged about 7% and moved up to the top of the Dow leadership board. It's, of course, the best performing Dow stock right now. Now, we should point out that Walgreens shares are down about 9% so far in 2019, but when you back up a bit over the past 12 months, the stock is down over 20%. So when you have a stock like that that's been beaten down so much, this takeover interest is understandable just because the valuation is lower and any company that's weighing a buyout obviously wants to get a better price. Now, we should also mention that the company has faced tremendous competition from the likes of Amazon. There's also a lot of disruption in this space. You'll recall that rival CVS acquired Aetna not too long ago. So Walgreens, of course, does not have a big health insurance company under its wing. Now, as I mentioned earlier, Walgreens is a component of the Dow Jones Industrial Average. So if Walgreens were to be taken private, it of course would no longer be a public company, and that raises natural speculation as to what company would replace Walgreens in the Dow. You got to have 30 Dow stocks. All of this is premature, but it is of course natural speculation, Zach.
Scott Gamm on the floor of the New York Stock Exchange as we continue to watch those shares giving back a bit of their gains after that news crossed. But coming up, we'll speak with one of the companies partnering with Apple to combat California's housing crisis. The ticker starts in 2.
Good afternoon and welcome to the ticker on Yahoo Finance. I'm Akiko Fujita. We are breaking down the biggest stocks to watch today. A bit of a mixed picture in the markets. We are seeing the Dow up 75, the S&P 500 down, and the NASDAQ up 13. Let's start with our big three tickers. Uber laying out a path to profitability but fails to convince investors its plan will work. Peloton is dropping after emphasizing its focus on growth. And Shake Shack stock is getting grilled as restaurant sales underwhelm. But first, Uber. Shares there hitting a new 52-week low today. The ride-hailing giant plunging despite a narrower-than-expected loss and estimates topping revenue for its fiscal third quarter. Gross bookings also coming up short of estimates. Emily McCormick is here with me to walk us through the numbers. Emily, you know, the good news, I guess, the headline coming out of the earnings call was that now they've got a date, 2021, this path to profitability, and yet investors seem really concerned. Why?
Well, it's hard to really be convinced of that date just looking at these results. So one of the numbers that was touted was that adjusted EBITDA margin beat. And really, we did see that beat on the bottom line, but it was still a wider loss than we saw last year. So that came out to a loss of $585 million, while last year was $458 million in adjusted EBITDA losses. So seeing that start to widen is kind of hampering that credibility of the profitability direction of the business. And then on the other hand, we also saw that Uber Eats, which is the higher growth but lower contribution to overall sales, that gross booking actually decelerated. So to see that really high growth area start to slow down is also very concerning for investors.
You said that the executives did kind of lay out at least what areas they are looking at to maybe cut some of the losses. What specifically are they potentially looking to trim?
Well, what's nice about Uber is it seems like they are being a little bit more pragmatic in their growth strategy. So yes, they are the ride-hailing giant that is focused more on the international strategy when we compare it to something like a Lyft. But they did say that they are more than willing to exit markets where they are not seeing high growth, where they don't think they'll become either the number one or the number two giant in that space. We saw that earlier this year in September when they exited the South Korean market. They also said they'd be open to M&A for potentially gaining dominance in some of these international markets. We saw a lot of growth. Again, North America still being the biggest contributor there, but in Asia, that's their next largest growth area.
Yeah, this note from Wedbush and Dan Ives saying that we remain positive on Uber, but needs to execute flawlessly over the next 3 to 4 quarters to regain street credibility. I mean, that's definitely a tough line considering investors are, looks like, increasingly growing impatient.
I think so. And, you know, a lot of it has to do with the fact that Uber is just so far reaching, really has its tentacles in all of these different business areas. And I think really bringing down costs and that overhead is something that investors are really focused on. Probably the biggest bright spot in this report, though, was saying that the core ride-hailing business, that is adjusted EBITDA profitable. That's something that Dara Khosrowshahi, the CEO, really called out, was saying that ride-hailing in itself was covering these overhead costs. So if you pair away some of these other business components, then you do have a potentially profitable business.
And we've got Susquehanna cutting its price target to $31, but they say profit outlook is still a bright spot.
That's right.
Okay, great. Thanks so much for that. Well, there's something for the bulls and the bears in Peloton's first earnings report as a public company. The stock is currently under pressure. They're down more than 7%. The fitness company posted an adjusted EBITDA loss of $1.29 a share, missing analyst projections for a loss of 39 cents a share. But revenue more than doubled from the year prior, surging to $228 million. CEO John Foley says he is prioritizing growth over profitability on the earnings call.
We are within striking distance of profitability. It's a managed outcome. I believe if we pulled back on growth, we could be profitable tomorrow. But that is not what the board and the leadership at Peloton believes we should do. We think this opportunity globally is so big that we think we're right on the right balance of investing for future growth.
Inez Ferre is with me to walk us through the numbers there. Inez, some interesting stock reaction today. It was kind of up pre-market, but we've seen a huge slide since. Certainly doesn't seem like investors are liking that message coming from John Foley that they're going to prioritize growth over profits right now.
That's right. What he's saying there is that they still need to spend, and they need to spend internationally. They see a lot of growth internationally. They're going to be launching on November 20th in Germany. Certainly a lot to look at from their quarter that they've just announced, with the revenue that you just mentioned doubling from a year ago. Their loss came in at $49.8 million. That's about a $5 million improvement from the same period last year. And then if you're looking at their connected fitness subscribers, those are the ones who are paying, that's doubled to more than 560,000. Now you might say, oh, well, it may be a sort of halo effect from their IPO. And this was addressed in the earnings call, in which they said, well, it's certainly we saw a bit of a spike for a few days, but then that went away. So they're seeing growth on a lot of levels, even their workouts per month averaging coming in at 11.7 per month. That's a 31% increase from the same period last year. But what they're saying is that they're going to continue spending. I mean, they just also recently closed on the acquisition of Tonic Fitness. That's their Taiwanese bike manufacturing partner.
And Inez, our colleagues over on The First Trade did speak to Peloton's president, William Lynch, earlier on Yahoo Finance. Take a listen to what he had to say about investor concerns.
What investors can take a lot of comfort in is the closing losses with the growth. And anybody who's examining our business model can see that that ends in a very good place. We've got one of the most exciting business models I've seen in my almost 3 decades of working in consumer, beyond between the gross margins on the hardware and then the subscription and the membership.
So you hear William Lynch there saying, look, the losses are narrowing. We're on the right path. Don't worry. You talked about the international growth as one big factor that could lead to sort of the subscriber numbers increasing for Peloton. What are some other areas you think investors should be looking at?
Well, I think that they're of course investing in software, they're investing in music, they're investing in new hardware as well. But you also should look at this coming up this holiday season, what they talked about also in their earnings call. They're trying out in September, they launched this home trial where you bring a bike home for 30 days, and if you don't like it, it's for free. If you don't like it, you can return it. I think that that's going to be really interesting to see what the numbers come out like from that. And then also they're coming up with a promo for a bike for $58 a month, and that I think that will talk to a lot of investors' hesitation about that price point, that these bikes are so pricey. Well, if you space it out on a monthly basis, you may see a spike there. So we'll have to see what goes on in the next quarter. I think the next quarter will be interesting to watch.
Thanks so much for that, Inez. Well, our third ticker of the day is Shake Shack. Shares there are sliding after the restaurant chain reported disappointing same-store sales growth despite beating earnings expectations. Same-store sales growth for the year was also revised downwards to 1.5% from 2%. Jared Blickery is with me from the Wi-Fi Interactive board. Jared, there was a lot of chatter on this earnings call about the noise coming from Grubhub and some of these third-party apps. This was a quarter where they announced that exclusive deal. How's that weighing on the stock?
Well, you can see that right there. It's down 19%. This is kind of a disaster for the stock, and we'll get to the charts in a minute. They probably should return to same-store comparable growth by the second quarter of next year, but they're probably going to go negative in the fourth quarter, the current quarter. A lot of that has to do with what you're talking about, switching over to Grubhub. Even though they're only doing that in the current quarter, in the quarter they just reported, the third, a lot of the people they were using for that service, such as DoorDash, Postmates, they were intertwined with their point of sale system, and that became disentangled, and so they're losing customers over that. That creates the noise that you're seeing. And just look at the PE ratio here, 101. So anytime you have a high growth stock like this, you get some noise like that, it scares the investors. This is what happens to the stock. So here's what happened today, but we're going to take a look at what happened on a year-to-date basis, and we can see now that it has come down below 70 support. Now 70 goes back to even the prior year, and it's also below the 200-day moving average. Closing at these levels makes it a broken stock, so it's going to take some time to base, reform, and hopefully they return to growth sooner rather than later. Like I said, probably by the second quarter of next year.
Meantime, Jared, a lot of analysts who cover Shake Shack putting out some very bearish notes today. We had SunTrust slashing its price target from $102 to $85 a share. Stifel cut its own target of Shake Shack from $80 to $60 a share. What, aside from that third-party app concern, are they raising in terms of the stock's outlook?
Well, they face a number of costs, increasing labor costs, increasing food costs, specifically beef, and then increased delivery costs, and that relates to the Grubhub matter. So all that put together, we're just going to have to go through a period of consolidation, but already fast food stocks, QSRs as they're called, were under pressure. So we're going to look at this group in our heat map year to date. We can see there's a lot of green here year to date. However, if you change this to look over the last 2 months, we're going to see a lot of red, except for Papa John's and Domino's Pizza. Everything else has been sliding into the red over the last few months and getting particularly hit. And it has to do with the fact that a lot of these were high momentum growth names, and we know that they have fallen out of favor over the last few months as interest rates rise.
Okay, thanks so much for that, Jared. There is another stock that we're watching very closely, and that is Walgreens, and there's reports that it is considering going private. Let's go out to Scott Gamm on the floor of the New York Stock Exchange. He is tracking all the latest developments on that front. Scott.
And Akiko, when that Reuters report came out, the stock surged up about 7%. It was actually halted for a few moments. It has since resumed trading, and that gain has pared a little bit, but it's still at the top of the Dow leadership board. It's the best performing Dow component right now. This Reuters report saying that the company has reportedly held talks with private equity firms for a possible leveraged buyout. And if it did happen, it would be the largest leveraged buyout ever. Now, we know that Walgreens shares are down about 9% so far this year, but over the past 12 months, that decline is even steeper, to the tune of 20%. So naturally, when stock valuations come in, this takeover interest tends to heat up, and we're seeing at least speculation about that right now. Now remember, Walgreens is a Dow component, as we mentioned earlier, so if Walgreens were to become private, you would have to replace that stock in the Dow. Of course, you have to have 30 Dow stocks. So there's, of course, natural speculation as to which company would replace Walgreens in the Dow if it were indeed to no longer be a public company. Now, Walgreens has faced immense pressure from the likes of Amazon, which, remember, acquired PillPack in 2018. That was kind of Amazon's way of getting into the pharmacy space. Also, Walgreens' rival CVS acquired Aetna. So there's been a lot of disruption in this space, Akiko.
Okay, thanks so much for that, Scott. Well, Chinese President Xi Jinping speaking out on the very latest on trade tensions, saying at the China International Import Expo today that global frictions should be solved through discussion and cooperation. This comes as some Trump administration officials look into whether to remove some tariffs on Chinese goods as a concession to solidifying a partial trade deal. That's at least according to the Financial Times. The proposal could roll back tariffs on roughly $112 billion worth of imports, including clothing, appliances, and flat screen monitors. Joining us now is Mona Mahajan with Allianz Global Investors, U.S. strategist, and Ryan Payne. He is the president of Payne Capital Management. Ryan and Mona, always good to have you on.
Love being on with the two of you.
I know, it's been great.
Some positive news coming through, at least on the China front, or at least it appears to be positive. The Chinese are playing nice. The U.S. is saying they're optimistic. Have we turned a corner?
I mean, absolutely, right? I mean, we needed some clarity there. I suspected that we were going to get some clarity at some point. This is the first step where I think both countries don't lose face. And that's huge because capital expenditure is a huge component of GDP. And if companies know what's going on with tariffs, I mean, that could really, really impact GDP in a positive way here over the next couple of quarters.
Yeah, I mean, I think generally when we came into this phase one deal, it seemed like both sides were conceding things they were already going to do anyway. So the Chinese buying more agricultural products, the U.S. pushing back tariffs they were yet to implement. This new news yesterday is an incremental positive. So you're actually going to roll back some of the existing tariffs potentially. To us, that's marginally better news for corporations in particular.
Yeah, it does seem like at least one extra step than where we've been before. Ryan, having said that, I'm looking at your notes. You say bearish sentiment still prevails. Pessimism is the best kind of optimism for stocks.
There's nothing I love more. If you look at it statistically, when you have investors negative like they are right now, and you're at some sort of peak in the market, that's very, very bullish over the next 12 months.
Are they negative, though? We're talking about record highs this week on the Dow, on the S&P 500. Is that pessimism still there?
Well, you have to look at where money's flowing, though. Retail money is going into money market funds and bond funds at record pace, almost like we're back in 2009. That's actually crazy considering how well the market's done. That just blows my mind. It also speaks to, if the economic data keeps coming in better like it has, that's a lot of money that can come off the sidelines and come back into the market and push it even further.
And so where does that money flow into, and how do you position yourself?
Yeah, you know, it's interesting. One of the factors we're watching closely is this potential bottoming in PMIs. Historically, when that happens, what we see is this rotation that we're already starting to see out of defensives into cyclicals, not only in the U.S., but globally. So for us, you know, the U.S. near record highs. Other markets may play some catch up. So global equities continue to seem interesting to us. Europe and Asia in particular, if that trade deal goes through. And then perhaps select parts of EM also can be interesting. So, you know, we think there is some optimism going into year end. To add another stat to Ryan's, when markets are up 15% plus as they have been through October, the last 2 months historically have been up directionally.
So let's look ahead to year end. How much of the rally that we're likely to see, which it sounds like both of you are expecting, you're shaking your head. No, you're not.
Oh, no, I'm wildly bullish. I was getting excited.
And so how much of that is actually driven by some kind of trade resolution? How much of it is about the Fed pause, which it seems like they will pause, at least going into next year? How much of it is just about the economic data?
Yeah, I think it's all those things, but it all comes down to earnings, right? And we're already seeing this quarter earnings are coming in 75% better than expected for companies that have reported, which is better than the average, which is more like 65%. And I think that's going to continue because you have quantitative easing around the world, like you just mentioned, which is just huge. I mean, Europe and the foreign markets, emerging markets, all that stuff has to play catch up here because valuations are lower, but their growth rates look just as good. I mean, Europe's going to grow their earnings out just as well as the U.S. is over the next 12 months, yet you're getting a huge discount on those stocks.
Yeah, absolutely. And I think one of the differences between last year and this year has been the Fed. So last year, people are worried about another 20% decline in equities going into December. But what we had last year was a Fed that was kind of working against us. You could even argue they tightened rates one time too many. This year, we have the opposite dynamic. The Fed's in easing mode, not only on rates, but obviously they're doing some balance sheet increases as well. So I think that dynamic, the Fed, along with global central banks, has been supportive of equities broadly and risk assets broadly.
And so let's assume that post this conversation, there is some kind of trade deal that's there. It looks like Brexit, at least now we have a little more clarity, maybe not on the deadline, but that there won't be a crash Brexit. Now we're looking ahead to 2020. And Ryan, we talked about this a bit. There have been a lot of sort of these doom and gloom scenarios that have been put forward if, in fact, Senator Elizabeth Warren becomes the candidate, but also is elected as the president. We're still a ways out from the actual election, but how do you assess that, and how real is that risk when we're still in the very early phases of this election?
Yeah, I don't think it's that real, because I think you have to look at, first off, the great thing about Capitol Hill, there's huge bureaucracy there. So even if we have a change from Republican, Democrat, first off, the market does just as well under either. If you look at it historically, but then you have to look at all the gridlock. And that's why Warren Buffett always says, I never delay a business decision because what's going on in Capitol Hill. I think the bottom line is the economy's strong, consumers in great shape, earnings are going up next year. I think you got to ignore the noise of politics and focus on the fundamentals. And man, they're better than ever.
And Mona, are we seeing any trade happening on some of these political headlines? We're talking about the election, but also this impeachment threat.
Yeah.
What are we actually seeing in terms of the fund flows on the back of that?
Yeah, it's interesting because I think with a Democratic potential presidency, what we're seeing is three sectors that could be impacted: technology, healthcare, and financials potentially. I think healthcare is the one that's really in focus, or has been over the last 12-month period or so. That's an area where we think the fears may be overblown a bit. It will take tremendous amount of legislation to get a Medicare for All type program through, especially now, a split Congress. So we don't anticipate any near-term disruption around that policy in particular. We do think if it ultimately does play out, we will see some disruption in the pharma and biotech space. But I think for now, positioning for that is premature. I think, to Ryan's point, you position more on what we're seeing in the economy broadly.
Okay, Mona Mahajan and Ryan Payne. Good to have you both on.
Put the rosy-colored sunglasses on. It's time.
Coming up, why a crackdown on password sharing may be coming to the streaming wars. The CEO of the tech startup playing a major role in subscription billing from CBS to Starz joins us coming up next. Welcome back to The Ticker. As the streaming wars intensify, the subscription commerce market is growing more crowded. One tech startup is powering the subscription industry, working with companies like Sling TV, Starz, Showtime, and CBS Interactive to help businesses set themselves apart from its competitors. Joining us is Dan Burkhardt. He is the CEO of Recurly, and he is with me here at the desk. Great to have you in town.
Thank you for having me.
So we've talked a lot about what this crowded space means for the actual streaming services. What has that meant for your business?
Our business has seen a number of businesses growing over the course of the 10 years that we've been in business, and we've certainly seen companies take different tactics to grow revenue and recurring revenue. There's definitely a different kind of construct that's required for businesses to grow through winning over the hearts and minds of subscribers over a time continuum rather than the traditional e-commerce one-time sale that was employed in prior eras.
How much of this really just has to do with content, though? We talk so much about what the offerings are from a Disney, from an Apple TV Plus, in terms of the shows that are on there, but you're also focused on the actual model that brings more and more subscribers in.
True. Content is always king. That adage has not changed. What has changed is that there's a lot of work that's required to continue to renew and win over the hearts and minds of those customers. So content will always be something that drives initial sign-up, but then once that sign-up has occurred, those companies have to work hard in order to make sure that they're delivering a great experience over time.
What we've learned from all these studies that have been put out there is that users do have a high tolerance for multiple services, but that growth that we've been seeing from, or the growth rate we've been seeing from those like Netflix, are starting to decelerate just a bit. What more do you think these companies need to do in terms of the subscription model? You talked about maybe companies starting to crack down on password sharing, which is something that Reed Hastings has consistently said he's not interested in.
Mm-hmm. Password sharing is something that there's no right answer. It's all of these companies are interested in driving growth, and there's an appropriate amount of constraint that needs to be placed around rules of engagement. So multi-room streaming has been something that some businesses have gone after, and then sharing on multiple devices. And ultimately, there is going to be a continuum when you start to share across multiple households, perhaps guest homes, vacation homes. And then beyond that, there has to be some determination of how loosely or strictly do you enforce these kinds of regulations. Years ago, I was at eBay, and eBay knew that their commerce model required a certain amount of gray market activity. If they disallowed sellers from communicating at all to the buyers, then they would overconstrain the business and ultimately slow growth. So for every business out there, there is some happy medium, and ultimately it's a business decision.
We've talked about the big names like the Disney Pluses, the Netflixes, but what are some other streaming services you think that maybe perhaps are being overlooked but have a strong business model in place to attract more and more subscribers?
Well, there are aggregators out there, and then there are companies now that are producing original content, and then there are long-tail providers that are going very deep with specific content tailored to serve the needs and interests of specific verticals. And so that landscape is changing, and I think ultimately, at the end of the day, every single one of these companies that are providing a subscription model are in the customer acquisition and retention game. What happens in the middle, in between those two bookends, is this incredible amount of alchemy of different customer experience, discovery of content, quality of streaming. A lot of these things are extremely complex dimensions of execution. And so there's a lot that goes into making sure that you can continue to win over those customers repeatedly, month after month after month.
And you've got obviously a lot of visibility in the space, just given the partnerships that you have. I'm wondering how much of the bringing on new users on board will be contingent on some of the partnerships that we've started to see, whether it's our parent company Verizon working with the Disney Plus, those like Comcast who've come out and said, well, maybe we will offer our service for free initially. I mean, how much of that is going to be the game changer, at least in the initial phase of this crowded space?
Yes, certainly joint marketing bundles are common. We're going to see a lot of free trialing to the extent that these companies are looking to encourage trial and adoption in the hopes that they can convert those customers in what is called roll to pay, rolling into a paid subscription, is something that we will see continually across all of these services. So that first run experience, onboarding, whether you can discover the content that's compelling, whether you feel that there is a depth of content that's going to keep you coming back as a subscriber, all of these factors are extremely critical.
Okay, Dan, good to have you on today.
Thank you so much, Akiko.
Coming up, Bernie Sanders slamming Apple's $2.5 billion affordable housing pledge. One of the top executives from the nonprofit teaming up with Apple will join us to respond next. Welcome back to The Ticker. I'm Akiko Fujita. Let's give you a quick recap of some of the tickers we've covered in the show tonight. Walgreens seeing a pop following multiple reports that the drugstore chain has explored going private, holding preliminary discussions with some of the world's major private equity firms to potentially do so. If Walgreens proceeds, it would stand to be the biggest leverage buyout in history. Also in focus, Uber posting a loss of more than $1 billion in its latest quarter, fueled in part from expenses tied to stock-based compensation. Uber CEO says the company is now targeting to reach adjusted EBITDA profitability by 2021. We should point out the stock is down 9% and that lockup period expires tomorrow, so we could see some more action there. We also have been focused on Shake Shack. The fast casual restaurant company is tanking after missing estimates for revenue along with same-store sales expectations. Its guidance for full year same restaurant growth also coming in short of estimates. And let's check the closing price of oil. Crude there currently trading higher, up 1.3% at $57.27. OPEC forecasts its oil market share is shrinking and will supply a diminishing amount of oil over the next 5 years as output of American shale and other resources increases, or other sources increases. Well, Democratic presidential candidate Bernie Sanders is taking aim at Apple after the tech giant announced its plan with California Governor Gavin Newsom to donate $2.5 billion to combat California's housing crisis. Sanders criticized Apple, saying the funds won't fix the housing crisis and only turns the company into a real estate lender. In a statement, he said, Apple's announcement that it is entering the real estate lending business is an effort to distract from the fact that it has helped create California's housing crisis, all while raking in $800 million in taxpayer subsidies and keeping $250 billion to profit offshore in order to avoid paying billions of dollars in taxes. Joining us is Ray Bramson. He's the Chief Impact Officer at Destination Home. Ray, it's good to have you on today. Let me just first get your response to Bernie Sanders' comments there.
Well, Akiko, the housing crisis has been a long time in the making in California, and the homelessness challenge that we're seeing today is deep and wide. But I think what we see from significant investments like Apple coming to the fore and providing the leadership and support is that it's not gonna just be one organization or one company or one group that makes a change or difference. We're all gonna need to come together to work on this housing crisis and make a change in the long term.
Just to clarify here, Destination Home addresses the issue of homelessness in Santa Clara County, which obviously covers Silicon Valley as well. And the numbers on the front are quite startling, a 31% increase in homelessness over the last 2 years. How big of a dent does this money from Apple make in that number?
We have 9,700 people on the streets in Santa Clara County. And what we know is that we need more deeply affordable housing, and we need services and support to get people off the streets and help them in the long term.
Apple, as a leader making a $50 million philanthropic investment, is going to help Destination Home implement strategies that we've been working on for the past 10 years to fund new housing developments and to prevent over 1,500 families from becoming homeless next year. So it's a part of a much larger puzzle, but we need more leadership like this from our tech community if we're really going to get anywhere.
What do you attribute to that huge growth that you've seen in homelessness? Is it about the rising housing prices? Is it about the local economy? Because when you look at, people think about Silicon Valley, you think about all these very successful tech companies, no question that has raised the price of property in the area. But that alone can't be the only contributor to homelessness, right?
Well, it's not the only contributor, but it certainly doesn't help. From 2000 to 2014, rents have risen in the region by 24%, but wages for our lowest income workers have actually declined by 7%. So we're seeing a place where it's just unaffordable for so many folks. And then we have seniors living on fixed incomes, disabled adults, families that are working multiple minimum wage jobs that just can't pay their rent. So it's a huge challenge, and we know it's most pronouncedly felt by our lowest income earners.
So Ray, let's talk about the strategy that you've put in place here. Obviously, there are multiple layers to this. How important is that short-term housing, at least in the initial phase, and at least getting the homeless off the streets? And how effective do you think that's likely to be?
Well, in 2016, Santa Clara County voters passed Measure A, which was a $950 million affordable housing bond. In the last 2 years, we've got 21 projects in the pipeline and over 2,000 new homes. We believe that permanent housing is really the long-term solution, and we're working to get that done. We also know that lots and lots of people, for every one person we house, 3 people are becoming homeless in our community. And we know that with just a little bit of assistance, a lot of those families are actually able to stay in their homes. So homelessness prevention is another key factor in keeping people that are housed safe and stable over time.
Okay, Ray Bramson, great to talk to you today. I appreciate your time.
Pleasure. Thank you very much.
Coming up, why Adobe is getting unexpectedly optimistic about its outlook, plus how Marriott's earnings miss could be a warning sign for the economy. Stay with us. Welcome back. Let's get to our next group of tickers. Adobe is leaping after delivering a rosy outlook. Tapestry, the parent company of brands like Coach and Kate Spade, popping after its quarterly earnings, and Marriott's latest results could be a warning sign for the travel industry at large. But first, Adobe, the software company offering a strong earnings forecast for 2020. Adobe CEO says powering digital businesses and its cloud division will drive growth. Jared Blickery is back with me, and Adobe getting a near 4% pop on the back of that.
Yeah, pretty nice. Adobe has a history of beats and arrays. They did it this time, looking at revenue for the full year, pretty much in line with expectations, but the guidance on EPS was above expectations. You can see the stock is up 3.9% here, and here's what happened today. Nice gap up, came down a little bit, but holding on to most of those gains. Year to date, we can see the stock is up about 27%, but like a lot of other software stocks, just kind of fell off over the last 3 months here. We can talk about that later, but I would say going forward, they have a really strong industry-leading position in documents and creative software. They also are very strong in digital marketing. That is a more aggressively competitive business nowadays. And they also need small businesses and medium-sized businesses more and more for their software income. And so that adds a degree of cyclicality to the business. But getting back to digital marketing, there is a lot of recurring revenue there, so that helps smooth things out.
Jared, let's get back to that software play you alluded to. I mean, Adobe is up in this session, kind of bucking the trend, though, because we have seen other software names under pressure.
Yeah, well, we can see that today, kind of a mixed picture across the board. Let's go to the year to date, because software, for the most part, performed very well, except for our friend Slack here, of course, IPO'd earlier in the year. That's down 45%. But we can see a lot of names above 50% here, including Okta, DocuSign, Microsoft at 42%. But if we look at what's happened over the last 70 days, which is basically the beginning of August, different picture here. And that's kind of speaks as to the rotation we were talking about with respect to the fast food items. We've seen rotation away from some of the higher growth names. And so again, we see a lot more to the downside than the upside here. And that kind of is a headwind as we see interest rates rising here and some of these high floating, high velocity tech names coming under pressure.
Okay, thanks for that, Jared. Well, our fifth ticker is Tapestry. Shares of the owner of Kate Spade and Coach brands are popping after a fiscal first quarter earnings beat, but sales fell short due to weakness at Kate Spade. Emily McCormick is back with me. Kate Spade continuing to be sort of the weak spot for Tapestry. The company's pretty well telegraphed that the turnaround is going to take a while. Did we see any progress in the quarter on that front?
Well, the good news is comparable same-store sales declines were not quite as bad as expected for Kate Spade, but those are still down 16%, so still really seeing a massive slump. This is because of a couple of different reasons. I mean, number one is that product, just issues with really connecting with the modern consumer. Right now, Kate Spade's image is really sort of entrenched in that mid-luxury category that's hard for it to actually scale. So we're not really seeing it rise to the level of an LVMH, something like a Louis Vuitton. But at the same time, it isn't necessarily fast fashion, which isn't doing so well either. So I think really trying to figure out that brand narrative is very top of mind for the company. Something that they actually did last year, they did hire Nicola Glass. She's a Gucci and Michael Kors alumnus to come and try to revitalize some of the design, really revamp the handbags and accessories that are core to the Kate Spade product lineup. But we really haven't seen that turnaround actually manifest yet. And it's just something I think that will take time. But since we are seeing that stock pop because of that bottom line beat, it's something that investors seem to be a little bit more optimistic about. Stock is still down about 20% for the year to date, though.
You mentioned that the mid-tier luxury space that has been a bit of a challenge, at least in the home U.S. market. Right. What about on the international side?
That's a good question. So Asia represents about 30% of total revenue for Tapestry overall. And a lot of this is because of Kate Spade. That tends to do well, not only internationally, but with tourists that are visiting North America and actually making purchases when they're here. We're seeing that demographic actually taking a hit. That's something that's happened with other mid-luxury brands like Tiffany. That's why we've seen a lot of weakness on that front as well. Aside from that, something else that they noted was that tariffs were going to have an impact on margins because a lot of that manufacturing also takes place overseas in China where there is that exposure.
Yeah, and we've seen a lot of the apparel, and footwear and that kind of thing being hit on those tariffs that went in place in September. Thanks for that, Emily. Well, our sixth ticker of the day is Marriott. Shares of the hotel chain are jumping after beating revenue expectations. Marriott posted adjusted earnings per share of $1.47 on revenue of $5.28 billion. Inez Ferre is back with me. Inez, where is Marriott seeing the most growth?
Well, they said that they saw growth with their loyalty program, this Bonvoy, this loyalty program which they launched this year. They also have been just adding rooms, and this was part of their big 3-year plan that they have to add up to 295,000 rooms in the next 3 years. And this last quarter, they added more than 17,000 rooms, about 117 properties. Last month, they announced that they're acquiring the W New York Union Square Hotel, also the Elegant hotels. They also have sold the St. Regis New York Hotel, although they'll continue to manage that. But they did lower their key metric, their comparable revenue per available room. That's expected to be flat to up to 2%. And previously they had given guidance of a 1% to 2% growth. Their quarterly profit was down about 23% from the same time last year. This isn't, though, too much of a surprise to some Wall Street analysts, as they noted that Hilton had a similar view a couple of weeks ago, slower fourth quarter fee gains, and also those Hong Kong protests that have limited growth.
And how much of the numbers that we got today you think are reflective of the overall travel industry?
I think that they definitely had mentioned the protests, the Hong Kong protests limiting growth, and also that you just saw some, it's just a little bit of slower growth as far as across all markets are concerned. There was some interesting color that was given during the earnings call where one of the analysts had asked about the corporate rates negotiations that they were talking about and what kind of sentiment they had gotten from businesses. And executives had said that during their conversations with with American businesses, they did notice some apprehension that's related to the trade dynamics. Just apprehension. Their CEO saying that, look, if a trade deal goes through, even if it's small, it will be good. Right now, what they're seeing is a little bit of a cautiousness, but still going steady into 2020.
Okay, thanks for that, Inez.
Thank you.
Coming up, a new report exposes the decline of internet freedom around the world. Its author joins us with all of the details. That's coming up next. Governments around the world are increasingly using social media to manipulate elections and track their citizens. New research out from independent watchdog Freedom House found that 26 out of 30 countries they studied engaged in election interference online. And the report names China as the worst abuser of internet freedom for the fourth year in a row. Joining us is Adrian Shabazz. He is the research director for technology and democracy at Freedom House, and he's also the author of this report. Welcome.
My pleasure.
This is a pretty extensive report, and I would argue quite timely given the discussion that we're having here in the U.S. about the responsibility of social media companies, at least, to see a fair election. I want to point to a number first, though, where we saw you looked at all these countries and just sort of broke it down. 35% not free, completely free on internet freedoms, 32% partly free, and then 20%, just 20% completely free when it comes to internet freedoms. Where did you see the biggest declines?
So the biggest declines were in countries like Sudan and Brazil, and I think these are very different countries. One, of course, Sudan, where digital technologies played a very important role in bringing down an entire regime. And then Brazil, where they had the opposite effect, a very negative effect, let's say, in terms of electing a populist who was very skilled at using misinformation on WhatsApp.
So let's single out Brazil then, because we've talked a lot about how Bolsonaro got elected, really using the tools of the internet that existed. I think the number you point out in terms of the election interference that exists is quite alarming. What are some of the tools or ways in which governments are interfering and sending this message out using social media?
So it's been very interesting to see that, the more unscrupulous or sort of the candidates that are willing to bend the rules are using social media better. And I think that it's sort of contributed to a rise of populism and far-right movements all around the world, including in some really strong democracies. And it's sort of taken a more increased sophistication in terms of we know that populist forces are very good at spreading viral messages, but now they're actually manufacturing echo chambers from scratch and sort of building the networks that then disseminate a lot of these misleading messages.
How much of the responsibility to prevent that falls on these social media companies? There's obviously a lot of debate here in the U.S., especially around Facebook and whether they should be running political ads that they know are not factually true. What do you make of that debate? And seeing what's happening globally, how much more do these companies have to do?
Well, I think we need to find a middle road. Banning political ads altogether, I don't think is sustainable. And there are going to be some unintended consequences of how that favors perhaps the people that we don't want to actually favor. But I do think that there should be some type of fact checking, because there's going to be obvious cases where candidates are going to abuse the system for their own political gain. That being said, it's not only companies that have a role to play. And I think this is where the United States has really been a leader in 21st century innovation when it comes to technology and the private sector. But in terms of government and actual policy, we're still very much in the 20th century. All of our laws are written decades ago, and I think it really falls to government, but also to citizens to think about what is the future that we want to live in, what sort of new laws do we need to be put in place now so that our rights are actually being protected online.
Speaking of the U.S., you do highlight also the decline in internet freedom here at home. What was most glaring for you in terms of what you found?
It's been really alarming to see a rise in surveillance, particularly warrantless surveillance at the border and through with our immigration authorities. One thing that we've seen is, a 300% rise in terms of warrantless device searches at the border. And it's really concerning just to see that agencies of the Department of Homeland Security really, they have a completely different set of rules where compared to local police or even federal agencies. So I think what we need to do is take a really hard look at what our immigration authorities are doing, and to make sure that there's enough oversight and accountability for any wrong steps that they're making.
How much of this, not just in the U.S., but when you look globally, is also being enabled by just how much we're willing to give these platforms, whether it's posting photos and personal information, but now increasingly, biometrics are getting involved too. How much of that has made it easier for these governments to really kind of step in and utilize all that data to their benefit?
Well, it's huge, and I think the most concerning bit is in many cases we don't have a choice. These are all tools that we are forced into using not only for our political lives, for business, but even just in our personal lives. There really aren't the same types of protections for privacy when it comes to the internet that we would typically enjoy offline. And it's going to be really concerning, as you mentioned, with biometrics, but also the use of artificial intelligence to find patterns and give new powers to security agencies in a way that they've never had before.
And very quickly, you talked about the surveillance that's in place. 3 billion people globally being surveyed through social media programs. What's the most common platform that's being utilized as a result?
Well, it depends on where you are. Obviously, Facebook is huge around the world, but then if you look into China, it's a completely different set of platforms, or in Russia, for example. So I think, regardless, U.S. technology companies really have a responsibility to see the ways that their platforms are being misused by governments and give greater, empower their users, I would say, in order to protect themselves and their data online.
Okay, Adrian Shabazz, good to have you in studio.
Thank you.
Coming up, Boeing CEO may forego his 2019 bonus amid the 737 MAX jet crisis. Is it too little, too late? Plus, Alibaba's potential game-changing move for the mobile payments industry. We'll explain coming up. Let's check back in on Walgreens. We did see a big pop in the stock after multiple reports that the drugstore chain has explored going private, holding preliminary discussions with some of the world's major private equity firms to potentially do that. And we are seeing the stock up more than 4% right now. Walgreens would stand to be the biggest leverage buyout in history if it decides to go private. And it is our last tick of the day. Boeing Chairman Dave Calhoun telling CNBC that CEO Dennis Muilenburg has offered to forego all bonuses this year as the company struggles with backlash from the 737 MAX jet groundings.
Dennis called me Saturday morning, 10 o'clock, with the purpose of suggesting that he not take any compensation for 2019 as in the form of bonuses, which is, of course, most of your compensation. It came in two fronts. One, no long-term bonus. And three, no consideration for equity grants until the MAX in its entirety is back in the air and flying safely.
Yahoo Finance's Jared Lickery and Ez Frey and Emily McCormick all back in to weigh in. Jared, you'll recall last week, Dennis Muilenburg went through a very grueling testimony on Capitol Hill where he was asked repeatedly about that $23.4 million compensation. The fact that he's now offering to forego his bonus, how far does that go in terms of restoring the reputation of Boeing? Do you think that Boeing, those who actually ride some of these or who will be riding these jets once they get back into service, would actually, change their mind as a result?
Well, I think it's a step in the right direction. I don't think it goes nearly far enough. I wouldn't be against clawing back pay, but you look at the stock; it's practically bulletproof, still above around $360 per share right now. I guess there's really not much you can do to knock this stock down. So a little bit too little, too late. But that's just my opinion.
Emily, what more do you think Boeing needs to do to restore the confidence in their jets?
That's a good question. I think there is a lot of skepticism over both the stock and this corporate governance that we've been seeing. I mean, a lot of shareholders really dissatisfied with the response that we were getting from Muhlenberg after this testimony. We saw when the 737 MAX was still flying back in March, there was just a lot of concern and people not even wanting to take the plane, with these various airlines asking to have their flights shifted. So it remains a question of whether customers will have faith once this plane is potentially back in the air.
Let's go beyond the ticker now. Visitors to China can now access the country's massive cashless economy with Alibaba's Alipay. It is launching a new international version of its mobile payment app today. Inez, let me start with you, because those who have visited China will know that oftentimes you can't use cash. Everything is all about mobile payments. And then if you don't have a Chinese bank account, you can't actually register for those payments either. So how big of a game changer is this? Not just for the visitors, but for Alipay, who's really expanding their base as a result.
I think it's huge for Alipay. I think it's huge for tourism, for the visitors who go there and who, as you say, want to be able to pay more easily the way everyone else does in the country. So I think it's a huge game changer.
Jared, what we've seen with some of these Chinese companies is that everything is all connected, whether it's WeChat, where there's payments, there's social media, there's commerce on it. How much of this kind of move, you think, from a company like Alibaba maybe opens the door to American companies looking to develop these super apps?
Well, I think the ecosystem you see in Chinese apps is particular to the evolution of the way their smartphones evolved. I don't see that coming here. I think people are happy with having 100 different apps on their phone that track them. I know I don't, but hey, I'm not the norm here.
Okay, thanks so much for that, guys. Well, coming up, will Walgreens soon be going private? Stay tuned for the final round. That's coming up next.
everyone, I'm Jen Rogers in New York, and this is the final round. Stocks trying for new highs here with the Dow getting a big boost from Walgreens.
I'm Miles Upton. This as investors get more good news on the economy. ISM's services index beating expectations for October. We'll have more on that and all the market action coming up in just a bit.
Walgreens is jumping on buyout rumors. What's next for the drugstore giant, and who potentially replaces it in the Dow? We're going to discuss that. And Peloton crushed following its first ever quarterly report. Despite topping estimates, we break down what went wrong, plus Bernstein getting bullish on Beyond Meat. We discuss in the Analyst Rumble. With us now, Yahoo Finance's Brian Chung to talk about all of today's market action and the impending Fed speak. It's coming fast upon us. We are once again on record watch at the close. Any gain for the three major indices would be another record close. So you can see Dow and NASDAQ poised to close higher. S&P not quite in the mix right now. So, Miles, you talked about some better data that we're seeing. Is the better data, are we in like a pivot here?
Yes.
Or did we just get it wrong before?
No, I don't think we got it wrong. I mean, there were very, very concerning signals about the global and U.S. economy coming from all kinds of different points, mostly, survey data, right? So we should say survey data versus hard data. Surveys are, whether it's IHS Markit or Market Economics, ISM, the Fed itself, they call people up or they send them a piece of paper. They say, please fill this out. They aggregate the data, and here's what we get. So survey data were quite negative at the end of the summer. That has clearly troughed, I think, especially on the manufacturing side. We saw some indications in the IHS report this morning, Brian, that hiring in services is still a little bit tepid, and I think that is a cause for some caution at this point, but clearly it doesn't seem like the rate at which data is getting worse is accelerating, and obviously the stock market has started to sniff that out.
Yeah, and even at that point, when you talk about the tepid hiring, that could be just because of the really difficult labor market that hirers are trying to look in right now.
Maybe it's a good thing.
Maybe it's a good thing, exactly. So I think the Federal Reserve would actually point to that as maybe a positive sign. I think the services numbers was not necessarily a space that policymakers had been expressing or seeing any sort of concern. It was really on the manufacturing side where fixed investment is still something that the Federal Reserve has flagged and was kind of used as a reason to justify the rate cut that we saw last week. But look, I think at the end of the day, what we're seeing is that the concern over this recession, ever since the yield curve inverted in the summer, hasn't really come to pass. But another point to raise is that we shouldn't even be looking at equities markets to be looking at that type of concern anyway. I mean, look at, for example, Germany, right? Mm-hmm. Germany is categorically in a recession right now. And I think what we're seeing, though, is that in the DAX, you've actually seen, the index go up by 12% over the last 12 months. Compare that to the S&P 500 here in the United States, where things are rosy. That's only gone up by 14%. Yeah. Not much of a premium, I would say there. So if you're looking at equities, I think that there's a different story because the nature of this world, right? Money is flowing into equities because there's nowhere else to be making money. So I think that's something that to be watching as we kind of think about the recession concerns here.
It's interesting that you bring up Germany because as we've been seeing this pivot in the U.S. economic data and sentiment, I think a lot of people are also looking at Europe and saying, oh, well, things aren't as bad as we thought over there as well. And I don't know if that's some function of hard Brexit not looking as dire as it was before, some of the data coming out, or the fact that, look, we've got the backing of all these central banks as well. But the story seems to be changing, not just for the U.S., but globally.
Yeah, and for what it's worth, I think that some of the trends that we're seeing with the DAX, for example, in European equities is reflective of the fact that, again, it's hard to hide into government bonds and government debt because they're yielding negative rates right now. So that's why people are putting money there. But I think overall, it's just spelling this idea that monetary policy can keep the world just above water for right now. But it's really going to take some sort of fiscal stimulus to really get anything beyond that.
All I would say is that it's very hard, I think, in any situation to build a case that the stock market is definitely wrong. That's all.
Any case.
It's just like, oh, well.
That's an evergreen tweet. Right?
It's like, oh, well, I'm right. Financial markets are definitely saying there's no recession, but I know there's a recession. It's like, no. I think at that point, that case has sort of been put to rest.
Shares of Walgreens Boots Alliance are jumping right now. They were temporarily halted, volatility ahead of these reports that we got that the company had explored going private. And if this happens, Reuters estimating it would be the biggest ever leverage buyout. The company has about $17 billion in outstanding debt. Do an LBO. What are you going to lever this up?
This is the top,
even
right?
More. Money's cheap.
This is the top.
Go for it.
Sure.
Is it the biggest deal here? Would this be? We've been saying maybe WeWork would be the sign that we had hit a top. Maybe a deal like this?
Nothing rings a bell like an LBO, right?
Yeah, I guess so. I mean, I think when we talk about Walgreens, we have to understand that this whole space has really been fumbling around with what the best corporate strategy is for right now. There was the huge confusion around Rite Aid, where Walgreens ended up buying a bunch of those branches, but then closed a bunch of them because they realized that consolidation was the name of the game. It doesn't make sense to have a Walgreens competing against the CVS, against a Rite Aid at the same intersection in whatever suburban New Jersey town what have you.
You learned about the hoteling theory.
Yes, exactly, right? I mean, it's the same thing. I guess you might even call it the dominoes fortressing theory,
right.
Or the reverse of that. I think at the end of the day, though, this would be a humongous deal, but I have serious doubts that a private equity firm would be able to find a better story, a better narrative for Walgreens Boots Alliance, given the issues that they've had over the past few years. Keep in mind, this is an international company too, right? The Boots part of the Walgreens Boots, they've had issues and struggling with at what degree they should be consolidating in the UK as well.
I love Boots. Anytime I'm there.
More than Walgreens? It's just...
Yeah, I don't know. I'm not a Walgreens. I'm more a CVS girl.
I'm more of a Boots guy.
I'm a Boots girl and a CVS girl.
There you go. All right. For more today's market action, let's go to Scott Gamm. He's live on the floor of the New York Stock Exchange. Scott, from one Dow name in Walgreens to another, Boeing, they are leading the index higher today. What's the story there?
Yeah, Boeing was the best performing stock in the Dow for most of the trading session until, of course, the Walgreens report came out, and then Walgreens surged to the top of the Dow leadership board. But what's significant with the price action in Boeing today is that the stock is back near where it was trading in mid-July. Now, why is that significant? Well, that's when the Dow last hit a record high, prior to the record high we saw in the Dow yesterday. So the fact is that the Dow is continuing to reach new record highs because of the pickup in Boeing shares. Now, the news today we heard was that Dennis Muilenburg, who's the CEO of Boeing, who was stripped of his chairman role just a few weeks ago, will now give up his 2019 bonus amid the issues surrounding the 737 MAX jet. And remember, Muilenburg was asked about his pay in that fiery testimony on Capitol Hill that he had with lawmakers just last week. Now, Miles, the second best performing stock in the Dow today is McDonald's. It's up about 2%, reversing some of the losses the stock saw yesterday. Of course, yesterday was the first time that the market had a chance to react to the news we heard on Sunday that Steve Easterbrook, the CEO, was departing. Now, outside of the Dow, guys, we're also keeping an eye on shares of Uber. The stock is down 10%, at one point hitting a record low today. The company reported earnings yesterday after the closing bell. Revenue rose 30% year over year, which was a good thing, but of course, the net loss for the quarter swelled to $1.1 billion. So again, there's a lot of pressure for these companies, especially the newly public companies, to figure out some sort of path to profitability. That is the only word that the market cares about when it comes to these IPOs, and Uber is just not there yet, guys.
Scott, going back to our previous discussion, we were talking about Walgreens, what would happen, they go private. They would obviously leave the Dow. What would be your pick to replace them in the Dow Industrials?
Well, I mean, maybe GE, why not? That stock has been coming back for quite some time.
God damn.
Unpopular pick.
So traders have been joking about it, actually. Now, and the reason we joke about it is because, of course, GE was booted from the Dow in June of 2018. At that point, the stock was trading at about $13.60. Now, it's a little over $10 a share, so it's actually down 20% since then. So yeah, I don't know if there's any real case for GE coming back to the Dow. It's like, why replace a laggard with another laggard?
Right, well, I mean, maybe they could do like a 1-for-10 reverse split, get that share price back to 100. Of course, price-weighted index, we got to make sure we still have Dow 27,000. So all good stuff. Scott Gamm live on the floor of the exchange. We'll talk to you in just a bit.
So what would you go? I'm going to go. I think that it is a retail name. I know there's some healthcare in it, but they like to keep the index diverse and try and put in another retailer. I think Costco.
Great.
That's who should go in. Yes,
Okay.
Costco. It is different, so it's not just like we're putting another pure competitor to a Walmart in there.
Okay.
They have a different strategy. They've got the membership. So I feel like it's a different kind of retailer. They also have a good pharmacy business.
All right, so Miles.
Yeah, well, I was going to say Target because I think It should just go right with the number one competitor to Walmart and Amazon. Also, at $110 a share, it's right in that sweet spot of price weighted index. $299 a share for Costco is going to really change the weighting there. The divisor would obviously have to change. Target, I think the stock price is about $30 more than Walgreens, so it wouldn't have to change all that much.
Okay. Well, I'm going way out there. I'm going to say Facebook.
Wow,
because I think that the Dow takes advantage of this opportunity to understand that most of the stock market right now is tech companies. So put the big one, put the big controversial one in there.
There you
FB
go.
in the Dow.
Wow. I like that.
That's my call.
And really, we would, Amazon or Google, if they could figure out how to get around if they wanted,
right.
If they don't want to break out, have, their fewer shares and do it.
It's funny just looking at the Dow names, like
Google or Amazon.
I know they like to do it by industry, but just in terms of size, Dow, Travelers, Walgreens are all 50 billion and below market cap. What are they doing in there?
Not big.
That's why GE
Get them out.
GE is a $90 billion company.
Right.
General Electric could go in.
Give me some business with some size. It's the Dow Industrials. It's not $30 billion rinky-dink insurance.
I don't hate
Are you going to buy them? You're going to take them private?
Travelers is thrilled with me right now.
I don't hate the Facebook idea.
I think it would make sense. They have communications companies in there, right?
Yeah.
I would also say PayPal.
Verizon, AT&T.
PayPal, yeah.
Another like a
PayPal.
it's a tech company, but it's finance.
Okay.
This could go on forever. Shares of Peloton are down after releasing their
They should
first
go in the Dow.
quarterly financial results. Dogs of the Dow. Since going public in September, the exercise equipment maker doubled both its quarterly revenue and its connected fitness subscribers, and also projects full-year revenue to reach 1.45 and 1.5 billion, surpassing analysts' expectations. But that sounds great, right? That Peloton is trading lower than its IPO price today, falling as much as 6%. What's the story here? Is this just a factor of people are sick of IPOs? They don't want any of them losing money. They're not buying this story here. The call, why, when they come out and some of the numbers are actually good, 6 months ago, this would have been fine. If you, right after Zoom, this would have been okay.
You don't get to pick the macro environment you go public in, right?
Is this this is a good macro environment, right?
Not for these companies. Everyone has decided that they're paying essentially double the value. So Peloton is at issue right now. So they're still an $8 billion company. In a prior life, they would have imagined that they would immediately get 50, maybe 100% higher premium from the market for their future growth. And Peloton's a nice business, but it's not accelerating growth. Growth is still there, but it's clearly not an early stage business or as early of a stage in its business life as I think it had appeared to investors not too long ago. Yeah. And again, they can't change the fact that they're clearly caught up in all the other names that the market is soured on.
Yeah, and I think on the point about premium, there used to be this idea that an IPO would always see a first day pop when it would hit the market. But what we've seen is that given the changes that of scale of the companies that are going public now, underwriters have been getting these companies a massive amount of fundraising before they go public, to the point where the market takes these stocks down on day one. So I think that this is just part of the volatility that we should expect to see with future IPOs when we think about Airbnb, right? Investors are no longer convinced that this idea that there's going to be that pop on day one, and this is just an extension of that Peloton and the general IPO story of people trying to figure out what the actual price discovery of these things are. You can't just look at the earnings numbers anymore. This is really all about, if you're a tech software company, your monthly active users, your daily active users, these non-GAAP accounting numbers that honestly, it's up to you to figure out whether or not ups or downs are good or bad for the future of this business model. So I think for Peloton, this is just exemplary of the overall IPO story, which is, look, we need to figure out what the proper valuation of these companies are, because some people are getting a little too carried away.
And I know we all just canceled the recession and all the economic data is looking good, but this is an expensive product. And even if you go back to the part where you don't buy the product and you just get the digital subscription that they've been pushing, that's almost $20. I could get on Netflix and do sit-ups.
What did Bowflex sales do in 07?
I don't know, but I feel that's so expensive, right? Just for the digital part?
Look, last
week, think like Hulu or somebody else should get into this?
Last week we had that news, right, on Mirror doing fundraising. Mm-hmm. I just don't get it. The at-home fitness in general, I just don't get it.
You want to get out, go to the gym.
Right. So
I think there's got to be consolidation in the space.
At a minimum.
Peloton needs to buy
At a minimum.
By Hydro, the one. Have you seen that one?
Sure. Yeah. All right. Coming up here in the final round, Bernstein getting bullish on another Nouveau trade, Beyond Meat. We'll discuss that call in the Analyst Rumble. But first, let's take a look at where European markets closed on this Tuesday.
Time now for our Analyst Rumble. These are some of the biggest analyst calls today of stock names you know. And first up, Bernstein upgrading shares of Beyond Meat to outperform while keeping their target price of $106. Even though they expect more volatility in the near term, they believe the risk reward skews towards the upside at current levels. Funny, because at other levels we were getting a lot of, we'll just keep our price target, or we're going to move our price target and we'll keep our rating on the stock here. My take on this note is that so much is riding on the McDonald's part. Is that, as in somebody, when you read this, does that seem like a big risk to you that this is what a lot of it is about?
Yes, because Beyond Meat, as we've discussed many, many times, on a per pound basis, like in the grocery store, is much more expensive than real beef. And so one imagines that McDonald's is not paying $9 a pound to Beyond Meat for their burger. And they're probably not going to be paying the double per poundage basis or premium that, that Beyond Meat gets to real beef in the store when they go wholesale. So that is concerning. Also, I'm just surprised that we still are excited about assigning an 8 to 10 turns value on sales for fake meat. It's just surprising.
Yeah.
It's the market has cut the thing down 70%, and we're still like, well, 10 times sales is fine.
And you wonder to what degree maybe those crazy multiples are just due to the fact that this is the only plant-based meat company that you can publicly invest in right now. There is no Impossible that's public right now. So are people investing in Beyond Meat because they like the Beyond Meat business model and distribution channels, or do they like it because it's a bet on this entire industry? I think that remains to be a question. I think that when we talk about the correction that you may have seen after a lot of the IPO shares ended up coming out of the lockup, you still have these questions about what is the proper valuation. You still have those on the street that have a price range between $62 on the low end and $185 on the high end for where the stock should be trading as a price target. That tells me that there's still a lot of confusion about what the underlying value of this model is.
Well, and so stock comes public at 25, immediately triples on its first day of trading. Now it's at $82 a share, off of a high of 200 some odd bucks per share. My question is, who's the buyer out there that has had no Beyond Meat exposure that's now really excited about getting into the stock at 3 times the value that it priced its debut 6 months ago? That was May 1st. We were at Berkshire Hathaway, May 1st or the April 3rd, whatever it was. That stock went public, and it's only been 6 months. So who is now saying, okay?
Maybe you've been waiting this whole time?
It's like, right, like, is there institutional money? It's not in any index. I mean, it's not like in any indexes of size.
Yeah,
so.
I mean, the volume's been high, but again, that's because of the
Actually,
IPO.
it's in the Russell 1000 value.
There
index.
you go.
Seriously.
One other thing from this note that I
the
thought
value
Should be in the
was-
Dow.
should be in the Dow was not too exciting is that they talked a lot because so much in this note is about the McDonald's partnership and trying to get it, and they think that it could add 60% to Beyond's sales. Is that they note in here there are no long lines for the PLT that is the sandwich at McDonald's that they're testing out in Canada. No long lines, and they are cooking them on the same thing that they cook the meat on at McDonald's. So they can't advertise
that's
it
weird to me.
as a vegetarian product
That's weird to
in
me.
here. And it just it doesn't seem like a blowout success at all. Nobody's getting no long lines.
Because
no
everyone's out
fights.
there getting the Popeyes chicken sandwich. So, they're all.
Yeah.
Ironic consumption, to me, doesn't feel like the place you want to be playing as an
Don't
investor.
stick your neck out.
Right?
That's a good point.
Bernstein. Next, we're going to go to Cowen's Oliver Chen weighing in on the Real Real's third quarter results. The luxury consignment company posted another loss, but Cowen is encouraged by solid progress with automation, a lower customer acquisition costs, high customer satisfaction. Shares, though, are under pressure today. You can see them off some 13%. The issue, there's a CNBC investigative report regarding the company's authentication process. It's called The Real Real. And if stuff isn't real, that's going to be a big issue.
Not called
Real
the
fake.
It's called
Or that.
Real fake, or the fake real.
Yeah.
But
fake.
Brian has recently bought his
I have
first
recently
item
purchased my first thing.
on The Real Real.
Yep. I got a sweater. I saw it at the store, and the price tag was way too ridiculous, and I found it on The Real Real, and I was like, all right, let me give this a shot. It hasn't come in yet, so I can't verify the authenticity of it quite yet.
But even when it comes in, you won't be able to tell if it's real or not, right?
Look, I know my French sweaters when I say
Okay.
that. So I think that when it comes to this company, that is definitely a concern because there's so many different types of brands that they're consigning from, right? So they're all luxury brands, but there are a lot of luxury brands out there. So how do you identify what's a real, Gucci loafer or a real Birkin bag, right? You have to get the different standards for each of those companies. This is different than what I'm familiar with, which is consigning sneakers online through StockX. I mean, there's only Nike, Adidas, and maybe 3 or 4 other names that you really need to be familiar with in terms of what's real and what's not. So on the other hand, though, I have a serious doubt that Wall Street's going to be able to parse out what is the proper valuation of this company based on what their consignment practices are, because that's such a unprecedented thing to see before in the market. So at the end of the day, I think the most important thing for The Real Real is really their curation of the items that they have on the site. So for me, I looked at a sweater that I saw in the store, didn't know it was on The Real Real, Googled that item, and then found it on the website. So I think for people to become aware of The Real Real, because I didn't even know before you mentioned it in a previous show, they really need to get the items up so that you get that SEO when people are searching for these items online.
Before you buy anything, look for it on The Real Real. I take from this note the higher convergence between buyers and consigners. I predict that Brian will be consigning on The Real Real soon after he gets his first item. That's the ecosystem. You buy and then you sell, buy and sell.
Right.
And they do a lot of the work for you.
Nice. I can't wait to see that sweater.
Yeah, I'll wear it on air.
Hopefully you wear it on the show. Coming up here on the final round today, investors looking for a big holiday shopping season this year. Will the consumer follow suit? What it means for Walmart, Target, and of course Amazon we'll discuss. But first, take a look at some of today's trending tickers right here on Yahoo Finance.
It's the most wonderful time of the year, the holiday shopping season, also the most important for pretty much any retailer. Our next guest says U.S. consumers are driving the economy forward through this rough patch of economic growth. And joining us now is Quad Cities Investment Group investment advisor Mark Revachesky. So, Mark, this consumer, so much is riding on their back. How wide do you think they're going to open their pocketbooks this Christmas and holiday season?
Well, I think the fundamental structure for continued strength in consumer spending is still there. We've got relatively high consumer confidence. We've got a labor market that's the strongest in 50 years. Unemployment rate 3.6%. Annual wage growth around 3%, still near a 10-year high. We're averaging around 167,000 new jobs a month. So I think the fundamental structure going into the retail holiday shopping season is still quite strong. And we are hearing some optimistic commentary from some of America's largest retailers, Walmart, Target, Amazon. I think a couple of weeks ago, Apple even gave some positive, optimistic commentary for the holiday shopping season.
Now, Mark, it's not often that we get a guest on our program who is based in Iowa, one of the states that has been directly impacted or kind of been discussed most often as facing the impacts of the U.S.-China trade fight. So just thinking about your local economy and how the Midwest, I guess, feels about a lot of this macro data we're pointing to, does it seem like the trade risks are perhaps being underpriced by the market, which, as far as I can tell in the last couple of weeks, has kind of moved on from worrying all that much about the trade war?
Well, what we're seeing here in the Quad Cities, it's a very business and kind of combination of business and agrarian. And one of our biggest employers in the area is John Deere. The challenge the Quad Cities has been facing with these trade disputes is because the local economy is really being hit by both of China's key primary targets. One, the U.S. agricultural industry, and second, the U.S. manufacturing industry. So those are two components that really drive a lot of the economic growth here in the Quad Cities. We have the Quad Cities is really split down the middle between the Mississippi River. There is an economic component, but it's surrounded by a lot of agriculture. So this U.S.-China trade dispute has been challenging. What we're seeing, though, is we continue to see this ebb and flow of good news and bad news with President Trump and China. Hopefully, phase one of this dispute gets resolved in the upcoming weeks, I believe on November 17th. But until we kind of start to see some finality to this resolution process, I guess you could say we're optimistic, but we would like to see some closure.
Hi, Mark. Brian Chung here. So on that point, you mentioned that there's kind of the two fronts on agriculture and also manufacturing. Someone pointed to a lack of business fixed investment for the reason why the Federal Reserve needs to make some cuts here. But I'm wondering, from your view out there in the Quad Cities, has a 25 basis point cut really done anything to, push some of these farmers or some of these business owners to invest that money into that new John Deere tractor or into another crane? Or is it really not making that much of an impact?
It helps. Certainly the last 3 consecutive rate cuts by the Federal Reserve does kind of induce capital spending by farmers. But with local farmers and even a lot of manufacturers, the main thing are these tariffs. And of all the uncertainty, will there be further escalation with these U.S.-China trade disputes? I think initially during the trade dispute back in kind of the latter part of 2018, I think a lot of manufacturers, maybe even John Deere, were absorbing a lot of these tariffs to begin with. But as time goes on, those costs are increasingly being passed on to the consumers in form of higher retail prices. And then you add the strain on the agricultural commodity prices. So farmers are really getting hit on both sides of this spectrum with respect to the U.S.-China trade dispute. I think there's an easing of apprehension with hopefully this gets resolved in the upcoming weeks. But until we really see some final resolution, I think there's still going to be some.
Mark Revachevsky joining us from Davenport, Iowa, Quad Cities Investment Group investment advisor. Thanks so much.
My pleasure.
All right, coming up here today, we'll have more on the final round. Plus, we will head to the Greenwich Economic Forum. What are Paul Tudor Jones and Ray Dalio saying about the markets and the 2020 election? We'll have more on that right after this. Hello everyone, Miles Ubman here in New York. This is the final round on Yahoo Finance. Stocks looking for new highs here. The Dow getting a big boost from shares of Walgreens. We'll have more on that in all of today's market action coming up in just a bit. Plus, vertical research analyst Daryl Genovese says Virgin Galactic is a once-in-a-lifetime opportunity. He will make the case for our final round call of the day. And is now the time to plow into some of those value names. Tim Rutterow of Mount Lucas Management will make the case. And yes, Crocs are back in vogue and shares are jumping this year. CEO Andrew Rees will join us to discuss what to expect this holiday season. Joining me now, as always, my co-host Jen Rogers, also joined today by Yahoo Finance Chief Fed Correspondent Brian Chung. 25 minutes to go in today's session. Let's take a look at where we stand right now. The Dow and NASDAQ currently at record levels. If we close right here, the S&P down 2 points, though not a whole lot going on with the headline indexes today. For more on today's market action, let's go to Scott Gammon, who's live on the floor of the New York Stock Exchange. Scott, let's talk about the electric vehicle space. Some news there today. What can you tell us?
Well, that's right, Miles. I actually wanted to start with Uber because it's actually the opposite situation from the record indices. We've got Uber shares near a record low. The stock is down almost 40% since its IPO, just about 6 months to the day when Uber went public in May of 2019, right here at the New York Stock Exchange. And by the way, the lockup period expires tomorrow, so that could bring additional volatility to the stock. But right now, we've got the stock reacting to the earnings report that we saw yesterday after the market closed, and it was, of course, a net loss totaling $1.1 billion, although CEO Dara Khosrowshahi said on the earnings call that the company is targeting EBITDA profitability for the full year 2021, but clearly judging from the stock's reaction today, the market doesn't seem to buy that, although revenue growth was at 30% year over year, which is actually better than a lot of the FANG names we've been seeing in terms of their revenue growth. But nonetheless, Uber shares at one point hitting a record low today. Now, we know Uber is investing in self-driving cars, and today we actually got news from NIO, which is a self-driving car startup, or it's an electric car startup in China. They're going to be collaborating with Mobileye, which is now owned by Intel, to actually bring self-driving cars to consumers in China. So that could be a pretty big opportunity there. NIO, by the way, is listed here in the US at the New York Stock Exchange. The stock is up about 32% today and is trading just over $2 a share, guys.
All right, Scott Gam, we'll talk to you after the closing bell.
Some of the biggest names in global finance are gathering today at the Greenwich Economic Forum, and Yahoo Finance's Julia LaRoche is there now. Julia, you had the chance to sit down with Gerald Parksey, Alan Patricof, and Steve Case. What they have to say? What's the headline?
Hey, Jen, that's right. Well, there are a lot of headlines coming out of the Greenwich Economic Forum today, and a lot of big names speaking, including the panelist that you just referenced, who I spoke to earlier. And, you know, one of the big takeaways I'm getting from here is that they're talking a lot about capitalism and how to fix that, and that's been a big trend just throughout. But the panel specifically was about venture capital, private equity, and the revolution there. But we also, you know, got into the economy, and interestingly enough, Jerry Parsky, one of my panelists who runs a PE firm in California, sees some dark clouds there. So take a listen to what he has to say about the future of California.
There are some dark clouds coming from California that I'm not sure people on the East Coast fully appreciate. I chaired 2 commissions for Governor Schwarzenegger, kind of California's answer to Donald Trump. But the commissions were one on tax reform and one on public pension reform. And the unfunded liabilities in California, health care for public employees in 2010, that's school districts, cities, counties, state, $118 billion. For CalPERS and CalSTRS, the state obligations, and the University of California, about $70 billion of that. These are unfunded liabilities. They're liabilities that will become due. They somehow don't appear on the state budget. They just they evaporate. And so we came up with one simple recommendation. We said, we think that what you ought to do is pre-fund. We're not going to advocate changing the defined benefit plans to defined contribution plans, which perhaps we should have. 7 Democrats on this commission, 7 Republicans. I chaired it. And I thought, my goodness, if we recommend that change, it'll be 7-7. Why have 7-7? So one simple recommendation, and that was pre-fund your obligations. And oh, by the way, for this $75 billion that's going to come due, we did a kind of an actuarial study and came up with, if you set aside $1.6 billion a year for about 14 years out of a budget that was then $125 billion, that the earnings, 4 to 5%, on that, and accumulation of principal, would fund these obligations. So the Republican members said, great, go ahead, Jerry. Go talk to the Democrats. You know them so well. I said, okay. I went over there and they said, I'm sorry. We can't support that. I said, well, why? They said, well, we have other priorities for this 1.6 or 1.7 billion you want. We'll deal with the future. I said, well, wait a minute now. You want me to get up as a chairman of this commission and say that you have a higher priority than ensuring your union members that they're going to get their health care? Oh, you can't say that. Why not? That's what you're doing. Unanimous recommendation. Nothing has happened. Nothing has happened to deal with that. That $75 billion is now approaching $175 billion and growing. This is a cloud that is hovering over California, and it will impact the economy. It will impact people's willingness to stay. And you couple that with a tax system that drives people away, and this is a cloud coming, and you have to be really careful about it.
Yeah, quite an ominous warning coming from Jerry Parsky, who runs Aurora Capital. And guys, I'll also point out that he was the Assistant Treasury Secretary during the Nixon administration when he was only 31 years old, the youngest in history. But now he's in the private equity space, of course, and has some serious things to say about his home state. Jen, Miles, back to you all.
Julia LaRoche live from the Greenwich Economic Forum.
All right, and coming up here on the final round is now the time to plow into some of those value names. Tim Rutterow of Mount Lucas Management says yes. He'll join us to discuss. But first, let's take a look at some of today's winners in the Dow Jones Industrial Average.
Let's take a look at some of today's winners and losers. Stocks in the red. Check out Uber. The ride-sharing giant reported a quarterly loss of 68 cents per share for the third quarter. Said it's going to reach profitability by 2021. However, gross bookings and trip totals fell short of analysts' expectations. Shake Shack, shares of the burger chain, plunging today after reporting restaurant sales at locations open for at least a year rose only 2%. That was in comparison to the 2.5% that was forecast by analysts. Stocks in the green today. Adobe, after the software company offered better than expected earnings guidance for 2020, citing brand strength and market share for its cloud software products. And Tapestry, shares surging after the luxury fashion company, you remember it when it was Coach, beat earnings estimates by 3 cents per share and reported stronger than expected comparable store sales.
Still not into that name change.
I can't, it's hard to.
Can't get behind it.
It's hard.
Can't get behind it. All right. We got stocks all-time highs right now. A great year for the market nears an end. So what does 2020 have in store for investors? Tim Rutterow is the president and CIO at Mount Lucas Management, joins us now to discuss. So Tim, let's just kind of start with, we got the market at all-time highs yesterday. On the one hand, that's great, record highs, love to see it. On the other hand, are there things that we are looking past right now that concern you about the market or the economy or the setup right now?
The number one problem in the market right now is that everybody's bought chicken equity. They bought things that look like bonds. Things have been highly correlated with bonds. And that's left a tremendous number of stocks in the wake. And one of them was announced today, Walgreens.
Yeah.
Right? Why did Walgreens announce that they're thinking about going private? Let me give you an idea. Realty Income Trust, which is one of the most popular stocks around right now, ticker symbol O. It's a dividend play.
Yep.
Right, it's up a lot this year. Has a PE of 62, right? Their largest tenant by far is Walgreens, has a PE of 8. So the PE of 8 is paying rent to the PE of 62. That's because people have piled into the 62 and have forgotten the 8, which is why they're thinking about going private. And this is all over the place. We're We're going to have a transit of Mercury in a couple days. Mercury is going to transit across the sun. Opportunities to buy value are about as frequent.
Okay.
I mean, it's just very rare. I mean, I'm old enough to remember 1999. This looks a lot like that.
Well,
it's a little different.
When you look at market cycles where value has been a big outperformer, hasn't been great for what it says about the state of the economy and the cycle. It usually indicates that we are towards the end of a bull run or a bull market or an economic expansion.
Things are a little different this time, I think. The value stocks are unbelievably correlated with the bond market. I can walk in the morning, look at what the bonds are doing, and know exactly whether value stocks are going to outperform or underperform. And I think that's really the key. I think if you get a growth burst here and rates back up a little bit, value is going to really fly. You've started to see it. You see it today.
Yep.
Look at RPV, real value, the pure value play in the ETF space is up about 60 basis points today. Why? Because bonds are down. And it's almost a one-to-one correlation. It's amazing.
Do you like this Walgreens news? Do you think it confirms everything you've been saying?
Absolutely. What we haven't seen, we've been doing concentrated value for about 20 years. And one of the drivers for our returns historically has been acquisitions. And there hasn't been a lot of that. But you have to wonder with some of these unicorns not producing what we thought they were going to produce, whether people will circle around back to what has traditionally happened in the private equity space, things like Walgreens, buying cheap stocks.
So on the macro scale, what is the next big event that you're paying attention to? Everyone's been talking about the trade deal, but it seems like we've been talking about, is it on, is it off, is it on, is it off, even within the context of this phase one deal. Is that the biggest story in the macro environment right now, or are there other things in the next 3 to 6 months that you think are going to be the bigger story?
The trade deal is important. Christmas is important to see whether or not the consumer endures. Everybody's saying that the consumer is carrying this the consumer always carries the economy.
Right. That's our job.
Yeah, right. I mean, and Goldman had a report today looking at, people are concerned about CapEx.
Yeah.
But CapEx is a lousy predictor of economic growth.
What's the one indicator you look at?
Consumer spending,
Yeah.
which is very strong. And employment. Employment's unbelievably good. I mean, my wife and I do some charitable things that are where we interview sort of 18 to 24-year-old kids who have problems. And what we found is in the last 5 years, none of those kids had jobs 5 years ago. They all do now, every one of them.
So it seems
it's a big change at the very lowest level, at the anecdotal level.
So right, because that's kind of the stuff that Jay Powell has been talking about, and Fed officials have been beating their chests on a little bit. They're saying the people who were left behind after the crisis, the most vulnerable parts of the labor force, are finally starting to participate in this expansion.
Go into Starbucks 7 years ago and everybody has a college degree, some of them with graduate degrees. Cycled through. It's different people. They're out in the work, they're out in their chosen jobs, and you're moving different people in. It's fabulous.
So then I guess it sounds like no recession in your eyes next year.
I don't think so.
All right.
No.
Sounds good. Tim Rudrow, have you back. Mount Lucas, Management President and CIO. Good to talk to you. Talk soon.
Thank you.
Coming up, we've got the closing bell on Wall Street less than 10 minutes away. First, though, the Fed speak ramping up big time tomorrow. We have our chief Fed correspondent with us, and we will preview all the speeches right after this.
back to the final round here on Yahoo Finance. Taking a look at the markets right now. Dow and NASDAQ set for record closes. The S&P 2 points lower on the day. If it does not get back into the green, we will not get a third straight record for the S&P?
Yeah,
at least the second. I think it's the third. All right, let's get back to some real stuff. That's the Federal Reserve. Brian Chung, tomorrow you will be speaking with Chicago Fed President Charles Evans. When you look at the composition of the Fed right now, the dot plot, just the range of speakers, right? Where does Evans sit in that? And I guess as you would rank, fantasy power rankings here of Fed officials, where do you feel like Evans is falling in terms of his influence with the FOMC?
Yeah, well, he's definitely been a dove over the course of this year. I believe he's supported every single one of those he has supported every single one of those rate cuts this year. But for what it's worth, every single Fed speaker so far since the Fed cut rates by 25 basis points last week have said we're basically on pause. So last night in New York City, I had the chance to talk with Mary Daly, who's the president of the San Francisco Fed, and I asked her directly, I said, look, we've cut by 75 basis points, and it seems like Fed speakers have said we're going to pause now. And the only reason why after 75 is because that's the same amount that they cut by in 1995, 1996, which they commonly reference back to when they say this was the solution, this was the remedy to avoiding a recession. But beyond that, we haven't really seen anything, quite frankly, between the September and the October meeting that would tell us that things are getting any better. So I think it remains a question as we get to that last FOMC meeting in December in a few weeks about what is the next policy move going to be. For right now, it seems like all the policymakers, and I would expect maybe even Charles Evans tomorrow, will say we're on pause for right now.
I'm just curious, as you talk to, I guess maybe Fed officials aren't the right people to get this info from, but just thinking about strategists, economists, people who follow the Fed closely, what prompted the whole mid-90s obsession thing? I mean, I know there's a number of analogs economically that you could say, we've heard it looks like 1998 for a long time. Bond yields going up a lot in 2018 looked a lot like 1994. I mean, I understand why the analogs are in place, but it seems like everyone has coalesced around this idea, right? That just look at the 90s and you're going to know what this Fed does.
Well, it's a credibility thing, right? The Federal Reserve needs to be able to message to markets that they're going to stop. And the only way that they can do that is by pointing to some reference point in the past and saying this is a solution because it's worked in the past, because the U.S. economy didn't end up seeing a recession until a dot-com bubble in the early 2000s. So that's the real point here. But I mean, you raise a good point, which is that this is different than 1995. 1995, 1996, the risks at the time, actually stock markets were near all-time highs there too. So it's the same thing from an equity standpoint, but different qualitatively because they were facing the long-term capital management issues and then the Russian issues. There was no trade issue at the scale that we've seen so far. And also interest rates were double what they are now.
I mean, irrational exuberance, Greenspan's famous speech was in December, I think it was December 95.
Right.
Or December 96.
Before they did the third of those.
Yeah, I mean, it was like the S&P almost tripled after he said, how can we be sure that irrational exuberance hasn't creeped into the market? And so it is kind of it's just amazing that everyone has gotten to just look at what Greenspan said. That's what Powell's going to do.
And at the same point, I want to say that the Fed will be on pause, but it's not the same pause as they did before they started cutting rates earlier this year. What they are saying is that it's a pause on further rate cuts because Jay Powell said we're basically on pause in the press conference last week, but he said we're not looking at all at a rate increase. So if anything, it'd just be further accommodation, but just when does that happen? We've seen some notes that say no change for the entirety of 2020. Well, you had those same people calling for further rate cuts in 2019, so it really remains to be seen. I think what we've seen is that the dot plots have become largely irrelevant. Yeah. We asked Mary Daly about that yesterday and saying, hey, so the dot plots told us that there could be the possibility of some seeing case for a rate of no cuts at some point. She was saying that was 2 meetings ago. Right. The pivot that we've seen from the Federal Reserve has been so dramatic this year that you cannot reference 2 meetings ago with the same relevance that you can now.
You should ask Evans about the Evans rule. What happened?
Maybe I will.
What happened to that one?
I only have a few minutes with him.
That's ancient history, man.
It is, but
2012.
Maybe I'll hit him with that
6.5% unemployment. We can't cut rates or can't raise rates until unemployment's under 6.5%.
All rules are gone. All curves are different.
What a world! All right, be sure to tune in to Brian's interview with Chicago Fed President Charles Evans tomorrow morning. Catch the conversation right here on the First Trade on Yahoo Finance, 9:45 a.m. Eastern. Brian, enjoy it. Talk to you tomorrow.
Yep. See ya.
Coming up here today on the Final Round, we'll have a closing bell on Wall Street, plus our call of the day. Vertical research analyst Daryl Genovese calling Virgin Galactic a once-in-a-lifetime opportunity. We will talk about the call right after the break.
Welcome back to the final round on Yahoo Finance. You're looking at live pictures of the New York Stock Exchange and the NASDAQ market site with the Dow and the NASDAQ on track for new highs here, record closes. S&P probably not going to be able to eke out another record here. You can see it's down just fractionally. I'm Jen Rogers with Miles Udland. Joining us now is Heidi Chung. So I look at this market here. First of all, we have to point out this Walgreens news one more time because Walgreens leading the Dow right now. It's up about 2.5%. News that maybe this company wants to go private.
I'm now convinced that it should be a good deal.
After
Tim Rutterow told us, trades at 8 times earnings.
Yeah.
And you look at some other names in the Dow. I mean, his discussion of kind of traditional dividend payers, and he mentioned, Realty Income, ticker is O, trades at 50. I immediately punched up P&G. That trades at 75 times earnings. Like, I know there's a reason why you put a premium on the business of P&G, but sure, maybe it's not so frothy if you get Walgreens for. I mean, PE deals now are like basically 10 to 12, right? So it trades at 8, sure.
Okay, so GE gets booted from the Dow in the summer of 2018. Walgreens comes in. If Walgreens leaves, who's going to replace it?
We have
we had our takes. What's your take? What's your take?
Yours.
I didn't
You're the new guy. You're the new
tell
kid.
you ours.
Think of it. Tell me yours.
No. Because then we're going to color. Then we're going
Chipotle.
Oh, I like that. I actually like that.
Great.
But you know what? It's too expensive, right? Because they've never.
Yeah, it's
had
like a $700, $800 stock. It's a problem.
We at Costco.
I said Target. So we all went consumer. We all went consumer.
People like the consumer names in there.
You can use one more.
So here we are. We're record highs. I look at what's gotten us here today, and again, it's not the likely culprits. You can be at all-time highs, and you can have Amazon down a little, and Facebook down a little, and Apple down. Is this the continuing rotation? Again, seeing financials here higher, industrials, materials, that's continuing.
I think that's the story here, that it's a broad-based rally at this point, right? It's not just tech leading the way higher. We have industrials, one of the best performing sectors this year as well. So I think when I think about all-time highs, I get antsy because I'm like, are we going to get a correction? Are we going to get a pullback? But the VIX is at sub 13. I think things look pretty good. We have the semiconductors up 22% this year. Like I said, materials, industrials, energy today. I mean, things look pretty good. So does that mean more record highs throughout the rest of the year? I mean, I hope we get a trade deal, right?
I also agree with you. We can just keep
smirk.
We can just keep rotating our way through records here.
Yeah.
Keep the churn up. Real estate can be down. It's down 1.7%. But if you keep taking your turns, you can keep going higher. Or you can get old leaders can get back in action as well.
I mean, I think what people, in my view, get wrong about all-time highs is that markets making new highs necessarily set you up for some sort of
decline,
reversion to the market doesn't have to trade at any level, right? So it's not it's not mean reverting, right? It could just the market can trade wherever it wants, and the market over the last few months has shown a tremendous strength, actually. If you really look at where we were at the end of the summer, we had a great run, but there was so much concern about the trade fight. There was so much concern also that the Fed was not going to follow through with correcting its mistake, which it obviously acknowledges it made a mistake last year. The Fed has not let the market down. Trade has, I think, as a result of the Fed, become less of an issue for investors because they now believe if Trump screws up again on trade, Jay Powell will save him because he basically kick-saved him. If you look at you can kind of line it up that way. I think the market sees it that way. And also, there's a large belief that there won't be a downturn next year. And so, earnings haven't been quite as bad as feared. All these things add together for a fairly positive view. Market doesn't, it's not that it has to go up 5 or 10 more percent. You don't have to be Tom Lee saying it's going to be 3250 by the end of the year, but you can say the market at 3100 is fine.
Yeah.
Let's get the read from the floor of the New York Stock Exchange. Go to Scott Gamm. Scott, on this Walgreens news, what are they saying on the floor? The idea that we could have some M&A activity in here, some LBO activity, could that be an overall catalyst for this market?
Well, look, Walgreens was the best performing stock in the Dow today, Jen. In fact, it surged to the top of the Dow leadership board when this report came out that the company was possibly exploring a possible private equity deal which would take it private. Now, this is just a report. The company hasn't confirmed it yet. But look, Walgreens shares are down over 20% over the past 12 months. So when you have a stock like that that's been beaten down so much, this takeover interest is natural because anyone taking it over obviously wants to get a good price. Some of the other gainers in the Dow today, Jem, were Exxon, which was up today. It was up about 2%. It was also up yesterday amid broader optimism surrounding the Saudi Aramco upcoming IPO. And then it was up last Friday when Exxon reported better than expected earnings. Boeing was also a gainer in the Dow today. McDonald's as well, reversing some of the losses the stock saw yesterday when the market first had a chance to react to the news we got Sunday, which was the departure of CEO Steve Easterbrook. Now, we did have the Dow close at a record high today. It also closed at a record high yesterday, so the bar really wasn't very high for today's session to get to another record high. All we really had to do was close in the green, and we did that by about 30 points. But there were some laggards in today's session as well. Visa, Pfizer, and Coca-Cola, although all of these stocks were down less than 2%, so the declines were relatively muted in the Dow. Now, we should also note the surge in the 10-year Treasury yield back firmly above 1.8%. Remember, last week, after the Federal Reserve cut interest rates, we saw yields actually move below 1.7%, but they snapped back. And when we talk about record highs in stocks, the last time we saw major records across the indices was in late July when the 10-year yield was trading at just above 2%. Well, now it has not reached 2% since that time. So traders down here tend to look at stocks in relation to interest rates, guys.
Scott Gamm, we'll talk with you tomorrow.
All right, time now for our final round call of the day. Today we're looking at the first call we've seen on Virgin Galactic. That, of course, Richard Branson's space exploration company didn't go public. It was made public out of a SPAC last week. Stock right now traded at $9, $9.70 a share. Vertical Research is out initiating coverage of shares of the buy rating, calling it a one-of-a-kind opportunity to invest in space tourism. Joining us now to discuss is the man behind the call, Darryl Genovese. So, Darryl, thanks for the time. And I want to just start with your overall view right now on what the opportunity ahead of this company is. I see you got three parts in the note. What excites you most about what you see for Virgin here?
Yeah, you bet. Thanks very much for having me on. I think, this one touches a bunch of favorable investment themes, including growth in the high net worth consumer segment, which is growing at 2 to 3 times GDP, experiences over possessions, which is a theme that we've seen consumer investors and investors broadly gravitate to over the course of the last couple of years. Pioneering technologies, a socially important mission, specifically space. The U.S. Commerce Department estimates that the commercial space industry is going to expand at a 6% compound annual growth rate over the next 25 years. That would take it to about 4 or 5 times the size that it is today. This is really the only pure play space company out there right now, and so I think that combination makes it attractive, as well as having very favorable economics and a scarcity value, because, like I said, there's really no other way to play this. Maybe there will be one day, but right now this is kind of the only game in town.
A great note. I loved all the pictures. Really, very infinitely readable here. I want to ask you about the idea that it is substantially uncorrelated with macro trends. This stock. Why is that? Just because there's so much talk right now about what is going on with the macro environment. Why do you think that this stock could be okay regardless of what happens?
Well, there is one caveat. That's kind of the view over the course of the next year or so. Eventually, like any consumer discretionary type of opportunity, the broader macro picture is going to play a role. But just if you just think about what's on tap for this company in 2020 and the last couple months of 2019 here, it's really all about just getting this thing up and flying, right? They've got this spaceship, right? This space travel system that they've designed, that they've manufactured a couple of them. They're going to be, there are a couple more coming over the course of the next few years. But But really what they need to do is they need to take it from being a flight test program, which it's been up until this point, right? They've demonstrated, their ability to go do the mission a few times. They need to get final sign-off from the FAA. They need to restart ticket sales. And they need to, go fly the thing to space, and they need to do it in a safe and efficient manner. If all those things happen, then I'm confident that the stock will move higher because the underlying economics of the business are very favorable. You're going to have something like 70% incremental EBITDA margins as they grow. And you have a situation where, since they're the only provider of this service, they're going to be capacity constrained, at least for the first few years, kind of regardless of what happens with, actual commercial activities here in, call it the next 6 to 12 months.
Hi, Daryl. So obviously, the space race is extremely hot right now. Sir Richard Branson is not the only person trying to explore space. We have Jeff Bezos of Amazon, as well as Elon Musk of Tesla. So you mentioned pure play earlier. Why should investors take the risk of a pure play like this company instead of investing in, say, Amazon or Tesla, in your opinion?
Well, I mean, this is and look, I mean, I don't cover Amazon or Tesla. Those are different stocks in different end markets, and some people may be able to build a compelling investment case around it. But what I think are the most attractive pieces of the opportunity are the sort of those that I've laid out already on sort of the favorable investment themes, favorable economics, and then you're really getting it at a very attractive valuation here too. And I think if you look at where we've set our price target at $20, it's about a double from where we are currently. I think the reason why the stock is down here at $10 is that there is this tail risk, right? The tail risk is that they crash one of their spaceships and then need to take a few years off from commercial activity as they go, sort of reevaluate the design. But we think that the market has placed too high a probability on that actually happening. And specifically, the reason that I think that's happening is because of the space shuttle program. I think most people that are sort of unfamiliar with what these guys are doing, if they're trying to assess the probability of failure, they immediately look to the thing that's the most familiar to them, right? The space shuttle program was the longest running space program. It was the most recent space program for the U.S. And the space shuttle crashed twice out of 135 flights, which is a pretty high crash rate.
Yeah,
right?
well, so then I guess
that's an appropriate one to tie onto here.
Yeah, so in your work then, Daryl, what have you used, I guess, as sort of some bogeys or some things you've tried to get a sense of what the safety profile really should be for this company if it isn't anything like the shuttle program from a safety perspective? Well,
if you want to take a worst case scenario, which is what we sort of did in the note, we would look at the X-15 program. The X-15 was a joint development and test program conducted by the U.S. Air Force and NASA back in the 1950s and 1960s. The crash rate on that was about 1/3 of what it was on the space shuttle program, and the X-15 program really flew a mission that was much more comparable to what Virgin Galactic is doing, right? They took a B-52, which is a large fixed-wing military aircraft. They put about a 25,000-pound, rocket-powered space plane under the wing. They flew it to altitude, and then the X-15 flew up to space, right? And it accelerated to Mach 7, and then re-entered and landed, horizontally on a normal runway, right? That's essentially what Virgin Galactic is now doing, right? And only, the X-15 program was 60 years ago. Right, so they have lessons learned from that program and a lot of other things that have happened since then. We have the benefit of new technologies, and so I would say that to put an X-15 like risk profile on Virgin Galactic's program is much more appropriate than a shuttle risk profile, but is probably still more of a worst case scenario. I mean, a commercial airplane crashes roughly once in every 5 million flights. And so, I mean, it's probably, their risk profile isn't going to be as good as that, but it's probably somewhere in between the X-15 at about 1 in 200 and that, the number that I just described for commercial air.
Do you think
commercial air travel?
That any reason that this company is misunderstood might be because it didn't go through the traditional IPO process after WeWork? A lot of people have been pointing to that, saying, look, the public markets can figure out when something isn't right. Going through the SPAC way, a back door, do you think that that's hurting the stock?
Yeah, I've heard that argued. It's hard for me to get behind that idea. I mean, this company is pre-revenue. We have a good idea of what their cost profile has looked like over the course of the last couple of years. Anyway, no, I don't really think that that's the case. I mean, I think a lot of what they're talking about, a lot of the components of the investment thesis, are things that wouldn't really be obvious from the filings associated with a more traditional IPO process anyway.
All right, Daryl Genovese with Vertical Research Partners. Really appreciate the time. Talk to you soon.
Thank you very much.
Match Group third quarter earnings hitting the tape, and let's go to Emily McCormick in our newsroom for a breakdown. Emily.
Well, Jen, it's guidance that's really stealing center stage here, and that disappointed for the coming year and quarter. So the company said fourth quarter revenue is going to be between $545 million to $555 million. That came in below expectations for $560 million. It also gave a forecast for adjusted EBITDA that came in below consensus expectations. This was mostly because of an increase in legal costs. Remember that earlier this year in September, the FTC actually sued Match Group and IAC over potentially deceiving consumers into paying for the subscriptions for some of these dating platforms, including Tinder, Hinge, and making it difficult for them to actually cancel those subscriptions. Turning to the reported third quarter, those results did top expectations, although this guidance is eclipsing those results. So revenue for the third quarter came in at $541 million versus $540.7 million expected, and then GAAP earnings per share of 51 cents topped expectations for 41 cents expected. We also saw overall subscribers continuing to grow, those up 19% to 9.6 million. Tinder is still the growth engine there, comprising about 60% of total subscribers. Tinder now has nearly 5.7 million subscribers, up by 1.6 million over the comparable year ago period. So mixed report here for Match Group. We are seeing shares sell off about 5.5% in late trading. Back to you.
Match shares down. Emily McCormick in our newsroom with the results. Coming up, forget going to the dentist office. What if the dentist came to you? Floss Bar is doing just that. We talked to the CEO after this. On-demand dentistry may be the latest work perk making its way to your office with the help of Flossbar, a new dental hygiene startup. Joining us now to discuss is Eva Sade, Flossbar's founder and CEO. You dropped out of Wharton Business School, you left a job at Bridgewater, and now you're bringing dentists to the office. How did you decide that this was the business opportunity for you?
Sure. I mean, I'm sure it sounds eclectic, my background, but I've always been really interested in the science of healthcare. Like your mouth is this giant hole in your face with concentrated blood vessels and bacteria, not to make it gory.
Yeah.
But few people realize that it's highly connected to heart disease, stroke, and diabetes if you've got pretty bad oral health. So I figured that fact was important. Plus, it's a quadruple industry puzzle. Which I'll tell you about.
Yes, please. What is the quadruple industry puzzle? People don't like it.
People, yes. Okay.
Is that part one?
Number one, people don't like going to the dentist. That would be my one top part of the puzzle.
Part two, dental insurance doesn't do anything. Would that count?
Well, you'd be surprised. So let me walk you through it. Okay. So you've got consumers, right? In the middle of this, you've got a service. So I'm doing a square.
Okay.
On the top here, you've got consumers, consumerization of healthcare, patients having more power, all of that stuff that's happening in the healthcare industry. And so if you look at consumers, they're not going. They're scared, it's painful, they don't have time, it costs a bunch. And so in that industry, they're getting much more demanding because you got seamless, you got handy cleaning your house, etc. So patients. Next, you've got employers. Labor markets are tight. And so employers need to compete not just on salary, but also on benefits programs. And so they're also facing high healthcare costs. And so they care about utilization of preventative care. Now you got the insurance companies. Insurance companies are competing on cost from each other and getting commoditized. And so if they're getting commoditized, they want to add value, meaning they want to bring cool programs. And then you got the last ones, which are the dentists. And the dentists are some of the most in-debt students in the country. They come out of there, and I think they've topped the charts. And so they come out of there, they want their own office, they want their own practice, but they're paying about $180 a pop in advertising costs to get a single patient. So put that all together, mobile dentistry is ripe in the industry because it brings it to people at work, endorsed by the insurer using the dentist.
I have a question about how it actually works of getting all this stuff to the office, because when I go to the dentist, there's the x-ray machine and I'm on this weird chair and there's like the spit thing next to me and there's all, like it's very elaborate. I'm looking at the video here. It seems like a lot of stuff has to come with someone who is going to be cleaning my teeth at work.
Well, the military has been doing this for a while. If you think about the portable equipment they use in remote areas to check the soldiers' teeth before they deploy, they've developed all of this portable equipment that you can take into the workplace. And so in the video, you see we bring a dolly, basically roll a dolly into the freight elevator and pop the stuff up. Or we've got a vehicle fleet for like large industrial sites, so we just drive in there. So it's become pretty compact because of military innovation, and now we're bringing it to civilians.
Looking at the dentists that you use, are they employees of Flossbar? Are they contractors? Are they gig workers? Like, how does that work?
So they're gig workers. So it's all about the gig economy, because if their office isn't full, they have actual spare time, or their hygienists have spare time. So it's actually all four sides of this market are our clients. Like our goal is to get these people matched with corporations so that they can do work. So you can think of us as a marketplace that then is also a tech/logistics company in its own way. Like the hardest part of this is lift and shift. I mean, you've got 60 pieces of equipment that you need to bring to a workplace. What part of the market is going to go do that itself? None. We're gonna go do that and then match them all.
So it mostly works if you have it at scale at somebody's office. Are you at Can I just call them and have them come to my house?
I mean, you could. I just calculated it would be like...
How much is it going to cost? That's what's going to be my question.
$500 a visit for it to make sense.
That's a high net worth.
What if I went What if I went to Jen's house?
Could we get it for $250? each?
I mean, we could talk about it.
Sounds like
Talk about
basically we just need like a team.
Yeah, we need like 4
5
people.
or 6 of us.
To get together. You should talk to co-ops, like different
Great.
buildings.
I like this.
I know, it really does solve a lot of problems.
The problem is you still have to go to the dentist.
Yes, right.
Which
That's-
would be the main issue here. Because I don't want to go to
Can
the
you
dentist.
solve for that problem?
Make it better.
Well, we make it fun. It's a branded approach. So all of the dentists and hygienists go through a branded training program. So we teach them not to, like, no upselling, no surprise fees, no shaming people. So there's like a code of ethics we abide by in terms of our brand. So we do that. Plus we look at them working, and if they're mean, they're out after a while. So.
Right. I mean, that seems like an opportunity, I guess, beyond dentistry, right? Like in healthcare, to have doctors think about that stuff
Is that what you
differently.
wanna
Are you
do?
thinking about that beyond just the dental space, but like how medical professionals can approach patients now?
Well, I mean, there's a lot of companies already doing that and going to the workplace. I mean, for us, I want to stay in my lane and focus on dental, not, spread and then go compete with One Medical or something like that. Like, FlossBar is a dental company. But there's actually a lot of chairside services dentists can do. So if you think of telehealth, I mean, why can't a dentist be the technician for a vision exam with a remote optometrist? Why can't they do a hearing test? You've got the patient in the chair. And so there's a ton of opportunity to cross-utilize resources, and the medical market's already doing it.
Cool. I think we should try it.
Sure. I'll go for
FlossBar
it.
CEO and founder Eva Sade, thank you so much for joining us.
Thank you.
And coming up here on the final round, we'll have what we're watching tomorrow in the look ahead. Plus, the latest tech worker craze has man's best friend outnumbering actual human children in the city of San Francisco. We have that story right after the break.
And now here's Miles with a look ahead at what will be making headlines on Wednesday.
Well, a favorite pastime among market watchers is trying to call the top. Almost all of these calls, of course, end up being wrong by definition. But with stocks at record highs, you know the top callers have just been waiting for the perfect moment to pounce, and your local pharmacy may have provided that opportunity. On Tuesday, Bloomberg reported that Walgreens has been reviewing deals to go private in what would be the biggest LPO in history. Now, back in 2007, TXC was taken out by KKR and TPG for $45 billion. That was about a year before the crisis. Walgreens right now has a market value of $57 billion. So I guess the question then is why do big takeouts signal to some investors that a top might be in? Well, almost all mergers require a lot of optimism from all parties, but the bears argue that optimism only shows up right before the cycle is about to turn. Massive LBOs also require lots of debt. I mean, it's right there in the name, leveraged buyout, and then loading up a company with debt makes them more vulnerable in an economic slowdown. Now, of course, those looking for tops will find them anywhere, and it's not like we haven't had signs of excess over the last couple of years, right? We've got Bitcoin, weed stocks, fake meat, and so on. But if Walgreens does indeed proceed with trying to go private, don't be surprised to see the bears start to get a little bit more excited, arguing that this time really is the end of all this. Now, turning to the calendar for Wednesday on the earnings front, Roku, Square, Expedia, and Canada Goose are among the notable companies set to report their quarterly results. One big Jen Rogers trade there, I think. And then on the economic data side, we'll get the latest read on worker productivity in the third quarter. And in the Fed world, Yahoo Finance's Brian Chung will interview Chicago Fed President Charles Evans at 9:45 a.m. Eastern right here on The First Trade.
San Francisco is now home to more dogs than children. And you have Silicon Valley to thank for that dog friendliness of the city. Policies are increasingly popular at tech companies that let people bring their dogs, like Lyft and Airbnb, while Googlers or Google employees get to bring their dogs, and there they are affectionately dubbed Dooglers.
They also get their own badges with their photo on it. It's very cute.
Does it go on their leash?
I don't know where it goes, but they have their owner's telephone number on it. It's very cute. You probably can't see it from over there, but look at it.
Oh, you put it up if you can see it. That's our friend's dog.
Bruce, a corgi?
I don't know which
Bruce is a
camera.
dog.
Bruce Wayne is a corgi, and he's
Bruce
adorable.
Wayne. So this is
I
nothing.
I feel like we're spinning this too favorably to look at how great all the dogs are.
I've been trying to get
San Francisco is uninhabitable for children is the real story. It's too expensive, there's not enough housing, there's no schools, the teachers can't live there. That's the real story.
But it has always been like that. That's what. So this dogs overtaking the kids.
Right.
Is interesting, but there have not been a lot of children in San Francisco since the 1960s. It has been declining.
You grew up in a child desert in San Francisco.
I did. I had nobody to play with, and I can tell you on Halloween, nobody comes to your door.
Really?
You have to all go to one neighborhood.
So do you drive over the bridge to go trick-or-treating?
No, you go over to another neighborhood that's 10 minutes away that everybody goes to, but nobody's trick-or-treating around all the neighborhoods, just where all the adults are. You only have to go, I'm looking at a story here in HuffPost from 2012, and San Francisco had the lowest percentage of children of any major city in the country.
I remember writing stories in 2015 about the teachers couldn't afford to take jobs at the San Francisco public schools because they couldn't live within shouting distance of the city, so it wouldn't make sense for them to be able to actually work there.
But it's a great city. It's still really nice.
It's so great that no one's there.
That's why all the dogs love it. You want to go walk your dog on Crissy Field to the Golden Gate Bridge. Coming up, more on the final round. Plus, they're back. Yes, Crocs, back in vogue, and shares are jumping this year. We've got CEO Andrew Rees on what to expect this holiday season. We're going to be back right after this.
back to the final round. Miles Zeldin here in New York, joined today by my co-host Jen Rogers, also joined by Yahoo Finance's Heidi Chung. Let's take a quick look at where the market settled on this Tuesday. We've got record highs for the Dow and the NASDAQ. The NASDAQ there up 2 basis points. So not a whole lot going on today in the macro market. Of course, Walgreens shares popping a little bit on that report that they are exploring a potential takeout. We'll have to track that story in the days ahead. But the S&P, by virtue of finishing lower, not making, of course, a new record as all 3 majors finished at record highs on Monday. Also want to bring in here Yahoo Finance's Brian Sozzi and Andrew Reese, the CEO of Crocs. Crocs is fresh off a strong third quarter earnings report. The company focusing on clogs, sandals. Andrew, thanks for stopping by because I've heard a lot about Crocs over the last couple of years, and I remember when I went to college getting Crocs to go in the shower, and I was like, sure, like that was the whole, that's it, right? We're not going to need them for that, but it's really become, I think, part of the culture at this point. What's been the story with Crocs over the last couple of years that's got us to this point?
So it's been a major turnaround, right? So a few years ago, Blackstone made an investment in the company. We put new management into the company, and it's been a really major turnaround. What we did is we went back to our DNA, back to our core clog, which is what we have here in front of us today, and really try to bring that to life and make that relevant for today's consumer. We didn't have a problem with awareness. You were completely aware who Crocs was. Yep. You saw this shoe, you knew exactly what it was. What we needed to do was make it relevant for you, make it relevant for other populations, and that's what we've done through a variety of things. Collaborations, the Jibbitz, which allow people to personalize, and it's been a really great run recently.
How do you explain your strength in the wholesale accounts? Because I talk to a lot of retailers, and department stores are really, really struggling. But I see your results in the most recent quarter up pretty significantly.
Yeah, so the most recent quarter, we're up 20% in aggregate revenues. And if you look at our comps in our own stores, we were up high teens in terms of comps. So unheard of in the retail environment today. And that's all about pull, right? So we're creating pull with our consumers, and we're creating pull with our consumers by making this product relevant, making it desirable. And if you make it desirable and our wholesale accounts are getting sell-through, well, they want more.
Why do you think they're choosing some of these clogs over a pair of Nikes?
They're choosing these clogs for kind of a couple of key reasons. They're super comfortable, they're super versatile, they resonate with them because they did wear them, a lot of our new customers, when they were young, so they're familiar with the concept and with the product. And I think this personalization trend is a very, very important trend. So we look at personalization, it's a global mega trend. People across the world want to personalize their product. They can do that with Nike ID and some of those other concepts, but it costs $150, $200, it takes 3 weeks to come, right? So with our Jibbitz, you can buy a pair of clogs, and then you can buy the Jibbitz, and you can tell a story on your shoe instantaneously, right? And then a week later, if you want to tell a different story, you can tell a different story.
I see you buying those, Heidi.
I know, I'm
I see
curious.
it.
I mean, young people are buying these clogs once again. Are they staying relevant because of the different collaborations you're doing with Post Malone and Vera Bradley and all the other big department stores?
Yeah, the collaborations have been very, very important. And so over the last year, we've done probably 12 plus collaborations. We've got another significant roster of collaborations planned for last year. And the diversity is really important, right? Post Malone, Luke Combs, Balenciaga, Vera Bradley, Pizza Slime, so streetwear brands. We're appealing to we're engaging lots of different consumer groups. And there's a little bit about the polarizing nature of the brand and the polarizing nature of the product. It makes it interesting for other brands to collaborate with us. Also, the shoe is a canvas. You can do many different things with the shoe, right? We can color it, we can graphic it, we can add Jibbitz, we can make it tell a lot of different stories. So it's a really fun place for brands and individuals to collaborate.
I always think of this when somebody has a hot product or a hot trend, because it's exciting and it's great. It's been doing really well, but trends come and they go. So how do you prepare for, let's even say it's hot and it's the coolest thing for 5 years, but how do you prepare for what's an inevitable downturn in the excitement around a product?
That's super important. 100% agree. So we've really focused on our core clog and the Jibbitz and the personalization. We've also been focusing very significantly on sandals. So a lot of the same material types, a lot of the same technology that we put into these shoes, and we're kind of known as a summer brand. We have a definite skew to the summer, summer time period. So we've been really focusing on expanding our sandal line and improving the awareness of our sandals, and that's been having significant traction. This last third quarter is our 11th quarter of significant growth in our sandal business, and so as we think about the evolution of the company, we think sandals will be a very big business for us in the future and will allow us to complement the clog business.
What does the holiday season look like for you? Holiday shortened season, some retailers I sense are getting a little worried. What does it look like to you?
Absolutely. You lose a week over last year. So we're not that worried. We see very significant traffic increases in our stores, on our website. So we're pretty optimistic. I see you've got the line clog.
They're furry, they're soft.
Yet,
So the line clog is really a great augmentation for us. You know, we're taking that summer business into the fall, and that's a fantastic gift item.
Yeah, I don't think they're my size.
Well, and
Well, we can get your size. That's not a problem.
Miles gets mad when I try the shoes on without my socks.
These don't need socks.
It's not sanitary. Andrew, thinking about the price point of clogs, you know, I think part of the appeal might be that someone who's a teenager doesn't have a lot of money can go get their own pair, right?
Incredible value.
And does it, to you, does it keep that flywheel of interest going, knowing that someone doesn't really have to think too hard about whether they want to buy a pair of Crocs?
We think about our brand as incredibly democratic, right? So the people that buy it are highly affluent to not so affluent. They are urban versus suburban. They're in this country versus other countries. Incredibly democratic, and we want to keep it that way because we want as many people as we can to be able to buy into the brand, and so that's really important. So price point is critical, and this shoe unfortunately lasts forever, right? You are never going to wear this shoe out. So if we're going to do business based on you needing another pair of shoes, we're going to go out of business really fast. We need to make you want another pair of shoes, and that want is color, it's graphics, it's collaborations, it's season right, it's a lot of different things that we do, and so that's absolutely a critical part.
What's your projection on the turnaround in the Asia business?
The Asia business has been our slowest business to turn around. I think we talked recently on our earnings call that we will turn that business around. We'll see growth in that business in 2020, and then we'll see acceleration in 21. So we've done a lot of the work and put in place a lot of the strategies, the product, the marketing, the key team members to be able to do that, and we see that coming around in that time period.
How important is the Visco girl right now?
The Visco girl. So I think she's important to us, but she's not our only customer by any stretch of the imagination. If we look at the teen customers that are buying into the brand, the Visco girl is one segment, but there's a lot of other girls who are maybe on volleyball teams, on softball teams, and who have a different perspective other than just being a Visco girl. But it's a component that's working for us.
Apparently, Visco mom is also now going to be
Visco
girl.
I tried to get
I don't even know what
Visco
that
mom,
means.
but it was
I don't
taken.
see any Hydro Flask. I mean, you got
All right, Crocs CEO Andrew Rees, really appreciate you joining us. Thanks.
Thank you so much. Appreciate it.
All right, and coming up here on the final round, we'll have what you missed on a busy day here in Yahoo Finance. We're back right after this.
Weight Watchers announcing third quarter results, raising full year 2019 earnings per share guidance, but the earnings guidance is disappointing investors. Take a look at the stock right now in after hours trading. You can see it's off nearly 13%. Brian Sazzi, you've covered this company closely. What do you think is going on right now?
Yeah, interesting quarter. So it was good to see them beat on earnings, a little light on revenue. The subscribers at 4.4 million was down quarter over quarter. I think this stock historically trades off the subscriber numbers, and I think that's what it might be happening here. I'm talking to CEO Mindy Grossman tonight, so I will get to the bottom of it. I will send you a tweet on it.
Well, and it looks like the studio subscriptions continue to be a drag there. So obviously digital is where they want this business to go, but actually going into a Weight Watchers location and being a member, Studio Plus digital subs, 1.3 million in the last quarter. It was 1.4 million a year ago. So continuing to see people leave the physical footprint.
There's a lot of competition out here at the end of the day. Even a company like Peloton, I know we all joke around, but that app is still attracting a lot of eyeballs. People are on it. And I think that's not a direct competitor to an app like Weight Watchers, but it's still in the mix.
Brian, but what did you say looking at just the year, right? The third quarter would probably be the weakest for subscriber numbers.
Yeah.
Right up into holiday season, though, the fourth quarter, we're probably going to see a bit of a boost, no?
The big quarter, it's all about that guidance coming off of the fourth quarter into that first quarter. January is diet season. Is when we all make resolutions. That's when the stocks like Planet Fitness and Weight Watchers, to a lesser extent, they should take off.
And that stock crashed after its first quarter result. It pre-announced its first quarter earnings last year. And it's gotten off the mat since then, but it feels like there's still a little bit of a drag.
And there's a lot of investments going on here. We talked to Mindy Grossman at our All Market Summit recently, too. They're investing in a new app. They're putting a new headquarters out in San Francisco to build out their tech talent. So there's a lot of things going underneath the surface to set them up for, I think, for a better 2020 than what they saw in 2019.
Look forward to hearing what she has to say in your interview. Brian Sazzi and
Talk soon.
Heidi Chung, both of you guys have a great evening.
Yay, thank you.
All right, time now for all the best moments that you missed today right here on Yahoo Finance.
For day traders and for very short-term folks, the market looks a little frothy here. But I think on the intermediate term, say 6 months plus, history is pretty clear on this, that new highs in the U.S. market typically beget better than average returns 6 months out.
I think there's a chance to break some glass here in a positive way. I think we do have some momentum, and to me, we have people that can add our knowledge and our expertise to the IndyCar folks here.
I don't see a green light on this company until they really sort that out. I don't care what their guidance is. They can say whatever they want. A lot of times, tech companies you're just kind of doing that and hoping.
She is the only candidate on the left right now who's running a very, very strong campaign. The markets better get used to that idea and figure out what that means.
And we got some breaking news regarding Walgreens. According to Bloomberg, the company is exploring a potential deal to go private. If it goes through, it could become the largest leveraged buyout in history.
Apple, as a leader making a $50 million philanthropic investment, is going to help Destination Home implement strategies that we've been working on for the past 10 years to fund new housing developments and to prevent over 1,500 families from becoming homeless next year.
I think the fundamental structure for continued strength in the consumer spending is still there. I think the fundamental structure going into the retail holiday shopping season is still quite strong, and we are hearing some optimistic commentary from some of America's largest retailers.
Coming up, he's the most successful IndyCar team owner ever. So what does Roger Penske do for an encore? How about buying the world's most famous racetrack? We're going to hear from Roger after this.
Penske Racing is the new owner of IndyCar. Penske, one of the biggest names in racing, is acquiring IMS from Holman Company, which it owned for 74 years. The assets include the Indy Motor Speedway, IndyCar Series, and IMS Productions. Roger Penske joined Yahoo Finance earlier today to talk about his big purchase and the future of motorsports.
You know, I think I got to go back probably to 1951 when my dad took me to Indianapolis when I was 14, and I had a chance to, I guess, inject this sport into my blood and to think about, you know, so many years later and the success we've had at the track. And quite honestly, 6 weeks ago, the Holman George family approached me concerning my interest potentially about buying the Speedway. It was something that wasn't on my radar at that point, obviously, but because of the long history we've had, I think we've owned tracks before. We had a public motorsports company that we sold to ISC in the past. So I think the domain knowledge we have, and obviously my understanding as a team owner, this was a great opportunity for us. It's an iconic asset for me, for our family, and I think worldwide it's the biggest sporting event with over 300,000 people. So, when you got domain knowledge and you have interest, and let me say this might be a dream came true after many years.
Roger, you talk about the fan interest, but of course live TV ratings are an issue for all the major sports now, even the NFL, which some people think maybe peaked in 2015. What do you make of where fan interest is for IndyCar, and what can you do now to grow it? Because there are some concerns that maybe ratings haven't been as good in the last few years for these races.
Well, Dan, I'd have to say quite differently. With IndyCar, our ratings were up. We had a broadcast partner in 2019, NBC, both on network and on cable, and that's been a big plus. Obviously, from the standpoint of our fan base, it's gone up almost at every single track. And again, on the Indy 500 weekend, we have between 250 and 300,000 people for that week, and also the race. So attendance, I think the social media piece has gone up, lots of interaction. We've raced at COTA, the Formula One track. We went back out to Monterey, California. So the schedule is about 17 races. We got a lot of date equity. I think the teams are stronger than they've been. We got a lot of new young stars. So I think we're getting in at the right time. And I know with the people that we have, and they've got a great team here at IndyCar, which has brought this thing to the next level. So quite different than maybe some of the other sports. I think this is a business that has short races. I think the duration is key, the excitement. I look at the demographics in the pit area and the people that we bring, lots of young people interested in this sport, and I think that's going to be key to our success, whether it's on TV or radio or in the social media or being at the event yourself. I think it's a real opportunity for the future.
Now, Roger, you also own an IndyCar racing team, and then you also have business interests over in NASCAR. And I know a lot of people say, well, look, NASCAR and IndyCar aren't necessarily competitors, the way that some people frame it. But I'm just curious what you'd say about whether there's any conflict with you owning the IndyCar series and also owning an IndyCar racing team. What's next for you in that sense?
Listen, that's amazing. I've gotten that question, I think, once an hour here over the last 24. So you're right on pace. Look, from my perspective, I've probably been a team owner in IndyCar longer than anyone else there. I think I've got credibility with the teams. I've always been a strategist on the box, calling a race. I'm going to step back from that, just as I do in NASCAR. I'm not involved down in the pit from the standpoint of strategy, obviously from the financial aspect of it, and maybe as you hire a driver, things like that. But I'm going to step back because this commitment that I've made is much bigger than just running one team or one car on race day. What I want to do is help bring another engine manufacturer in and do things that'll make the team stronger. And even potentially, as we've set this up from a financial perspective, we have the IMS Productions, we have the Speedway itself, Indianapolis Motor Speedway in one entity, then IndyCar will be in another one. And hopefully, as we get together the teams with full transparency, we can get some ownership as they have in NFL and other sports, that have associations and multiple locations to race in. So I think there's a chance to break some glass here in a positive way. I think we do have some momentum, and to me, what I've got to do is take our people. Remember, we owned the Michigan Speedway, owned California Speedway, so we've had that domain knowledge, and we still promote the race for the Detroit Grand Prix in Detroit. So we have people that can add our knowledge and our expertise to the IndyCar folks here. So quite honestly, you'll give me a report card on that, everyone will, maybe at the end of 2020.
Trump. That's going to do it for us here in New York. We've got record highs at the Dow and the NASDAQ, a bunch of earnings after the bell, leading to some sharp declines. Weight Watchers could be a story tomorrow. And don't forget Walgreens, hey, could be going private. I'm Jen Rogers with Miles Udlin. Final round on Yahoo Finance.